Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. It's looking better. It is looking much better. And we'll tell you why over the next 1 hour or so right into market opening. I'm Prashant. With me, my colleagues Nigel and Sonia. Guys, hi, good morning.
Hi, good morning. Anything can look better than what we saw yesterday, right? I mean, and of course, everyone's hoping that the dips get bought. But let's see, we have a long day ahead. But the good part is there's a gap up opening expected.
Well, that's right. And we'll need to build on from there, which will be very, very important. And a big day coming up for the markets. And later tonight, a big day as well for the Olympics when India plays that crucial semi-final.
Okay, absolutely. And I think let today in the market also be a bit of a semi-final.
Big day.
You know, absolutely. So let's rewind the clock back as we always do and tell you what you need to know as we begin another session, right? What was the big worry on Friday and which kind of triggered all this mayhem and sell-off in the US and then in Asia yesterday? It was the jobs number, the labor market data, which had weakened so much. So I want to start with a data point which is right in the opposite direction of that data point. And this is the ISM Services Index, which is now rebounded in the month of July to 51.4. This is strong data as opposed to the weak labor market data. You know, if you look at this, all subcomponents expanded. And you also had the employment index within the ISM Services Index, which actually rose, which expanded. This is in contrast to the labor market data, which spooked markets, sort of sparked off recessionary fears, etc., etc., etc. And I think that is basically something which provided a sigh of relief for markets. Remember, in the US, it's not a data-heavy week. So this is one of the few data points which we are going to get. And this came like this. Remember, services is about 55-60% of the US economy. It's much more stickier as compared to manufacturing. And this number shows that you know the economy is fine. I mean, it's not showing any recessionary trends. Now, and price action reflected in this as well. I'll get to the price action in just a bit. But one more thing, you also had the Chicago Fed president who was interviewed on CNBC. We'll play out the sound bites in a bit. And he said he kind of did not rule out any emergency rate cuts and emergency measures. But he said it doesn't look like the U.S. economy is in a recession. But he also assured that if the economy deteriorates, Fed will, and I quote, fix it. Now, we've seen the Fed trying to fix the economy many times in the past. Not the economy, but the markets more so. Last, of course, was trillions being printed during the COVID emergency, and before that, during the global financial crisis, and so on and so forth. So there was at the margin this which played as well. So what did the equities do? You had the US market, which ended down. S&P was down 3%. Nasdaq was down 3.4%. But the point is, from the lows, there was a sharp recovery. And that's the next graphic. So S&P bounced 1.3% from the lows, and the Nasdaq recovered 3% from the intraday lows as well. You had the CBOE Wix, which closed last Friday at 23. Pre-market US, it had jumped to 65. It finally fell and closed at about 38. So 23 on Friday, 38 as of yesterday's close as far as the US is concerned. Bond yields ended absolutely flat. The 10-year lost 1 basis point, so no incremental pressure there. We left off at about 3.78% last night. Now, you know, the point with regards to the US session that I want to make is, you know, yesterday in Asia, it looked traumatic. It looked uncontrolled, unhinged, right? I mean, the way markets were selling off, circuit limits were being hit, etc. By the time it got to the US session last night, it was much more orderly. I mean, if you read global stuff, a lot of people are talking about it being a more two-way market. There were lots of sell orders, but there were a lot of bids as well out there in the market. Even though the S&P ended 3% lower, the Nasdaq ended 3.5% lower. It was a more two-way market. It was more orderly. There were exits, but it was orderly. And I think that is important to note. Now, the other talking point, of course, yesterday was the yen. And yen did not sort of break levels. It hit about 142. And then it paired gains to 144. So it depreciated. The yen depreciated against the dollar to about 144 by the time things ended in the US. And this morning, Nikkei is seeing a sharp rally. I mean, it's basically recouping almost all of yesterday's 12.5% losses. And we'll talk more about that. That's, of course, a live market. So we'll have to look at rates as we come along. I think, and it may be it perhaps is early. It is early because we've just had 1 or 2 days of panic. But maybe the bulk of the panic is done with what we've seen last night in the US and the way the market sold off in the US. The panic is done. I mean, you know, hedges and hedge funds, etc., would be out. Large financial institutions who had to forcibly unwind would be out. Retail is a different matter, especially with Japanese money, etc. But I think for once, for the time being, that panic kind of situation perhaps may be behind us for global markets. Now, just to circle back to the levels, it would be great if the Nifty defends yesterday's lows, which is 23,894. It's the nearest level. Strong support below that at 23,628. What is that? It is the 38.2% retracement of the rally from the lows of the election low, which is the 4th of June, to the recent high, which is 25,000 plus. That number is 23,628. And watch for a positive daily close, which should give us the first indication that maybe we are getting past this. Unlike the Nifty, Bank Nifty yesterday already retraced 50% of the rally from the election lows. So it's a much more weaker setup there. On the way down, 49,718 will be an important support. And below that, the Nifty Bank will see support coming in only at the 61.8% retracement, which is 48,858. GIFT Nifty comes up on your screen. It should give you an indication of the start. 200 points higher, right at the word go. I'm not expecting a huge V-shaped one-way kind of a rally, but the point is maybe it's more stock-specific, more discerning. Everything got ignored with the global sell-off, and I think it's maybe time to get back into stock-specific opportunities and situations and look at it as a more normal market without all the panic we've seen over the last 48 hours. Sonia.
Oh, absolutely, and there was a lot of panic, right? So it's really a relief to see this 190-point up move on the Nifty. But you can't rule out volatility in this market. At least that's one thing. Remember, the India VIX had a huge spike up. It's at a 1-month high. So some more volatility is something that you can perhaps expect. Let's also tell you what happened overnight, right? I mean, the Dow was under a lot of pressure, so no two ways about that. The Dow was down about 1,000 points in trade, and there was large selling by foreign investors in our own market. So if you look at it, FII sold 10,000 crores in the cash markets yesterday. The good part in all of this is that crude prices have fallen. So NYMEX is at a 6-month low now on the back of recessionary fears, and falling crude prices is always good for a market like India. So keep that in mind. This morning, a lot of the Asian markets have opened with big gains, right? So the Nikkei market is up 10%. It's regained all of its losses. The US futures have recovered as well. So there are some important questions that I'm asking. One is that will the dips get bought? In all likelihood, it will, given that there is some green on the screen. So perhaps you should go out there, get your shopping basket ready and look for opportunities that maybe you didn't get a chance to invest into when this market was, rallying. Also, is this the first real correction in a longer bull market, which means that could this correction extend further? If it does extend further, then perhaps the best thing to do would be to wait and watch. These are a couple of, questions that need to get answered. But for now, there is a big rebound in the Asian markets. Remember, there were historic losses yesterday. The Nikkei is up 10% now. And let's not forget that give and take everything, right? The Nifty has given you a 12-13% compounded return over the last 15 years, despite a pandemic, despite a war, despite a financial crisis. So just keep that in mind when you look at steep losses, and perhaps there's no need for any kind of panic.
Well, that's right. Let's look at the trade setup then. And there are signs that the global markets, they are stabilizing, at least this morning itself. You have the Asian markets that are trading in the green, and the CBOE volatility index. It ended much higher in yesterday's trading session in the United States, but it came off close to around 40% from the peak of the day. So that's good news. The Indian markets, well, they've been outperformers. I say that because the Indian markets, well, you've corrected close to around 4% from the peak. But you have markets like the Kospi that's down close to around 8%. And you have the other Japanese markets and the likes, the Nasdaq, that's down more than 10 to around 15%. So that's why India has been outperforming. And I expect the Indian markets to continue to outperform from here on. In terms of the domestic queue, you'll have the Nifty Financial Services Index that will play out to weekly expiry as well. But let's get to the other data points. The FIs, well, in yesterday's trading session, the long position, the net long positioning has come down to around 1.1 lakh contracts because they unbound some long positions and they added short positions as well. So from close to around 1.5 lakh contracts, that's down to around 1.1 lakh contracts. The client positioning, well, there has been some covering of shorts. Remember the client short positions had moved to around 87,000 odd. Well, that's gradually come down lower. So there are signs of short covering from the clients as the markets have seen a bit of a dip. In Friday's trading session, we ended lower. Even in Monday's trading session, we ended lower. And that's calling for some short covering from the client's positioning. I'll view this positively because they have been getting the direction of the market right. Yesterday, it was a weak session. So the call writers, they came back into play. And because of the kind of call writing that we saw, we did see the PCR come down to the lower end of the range. Remember, at around 0.65, 0.7, normally you see the Nifty see a bit of a bounce back. And the reason we came down to this level is because yesterday the 24,500, 24,400, 24,300 call, all of them, they did see a fair bit of writing. Now this 24,200 call, well, these call writers will get a little bit nervous because the GIFT Nifty is suggesting a gap up and those writers could be in trouble. So we'll have to keep an eye on this strike, whether we see some unwinding at this particular strike. Moving to the levels then, well, the Nifty, we're seeing a bit of a bounce today, but you'll say that, a fresh breakout will come about only once we get to the 20 DMA, which is quite a distance away from where we are currently. Support levels, 23,800 is rather important. The 50 DMA as well comes in around there. And yesterday as well, we went to close to that level. So that's the important mark on the downside. The 100 DMA, well, if that 23,800 breaks, then we'll see a further downtick. Since today's the Nifty Financial Services Index expiry, let's look at a couple of strikes. Well, we had the 23,000 call that had a fair bit of open interest built up. The premium ended at around 29, but at some point of time, it was close to around 150 to 200 odd. So the crucial resistance level on the Nifty Financial Services Index is 23,200. This starts in the green. We need to build on from there and take out those crucial levels.
Okay, thanks a lot for that. So lots to watch out for as we begin a brand new day of trade. And thankfully, as we've been telling you, there is some relief that we're looking at this morning, especially across most, global markets. But on the equities front, we have first up a comment coming in from Mahesh Nandurkar of Jefferies, who says that the higher risk of a US downturn now factors in a 132 basis points Fed rate cut by December 2024. The consequent US dollar weakening should augur well for Indian stocks on a relative basis. But on an absolute basis, the risk is on the downside, given one of the longest streaks of the bull run, unsustainably high domestic retail flows and potential capital gains tax hikes in the future. They maintain a defensive stance and their preferred large cap laggards are private lenders, staples, L&T and two-wheelers.
Okay, this is another interesting view. This is Victor Schwetz of Macquarie, who says that given the sell-off in Asia and the spike in wicks above 50, the question is what dangers are investors facing? Does it require joining the stampede or create a buying opportunity? Victor says the sell-off was precipitated by a confluence of events. That is perception that the Fed is behind the curve, investor concerns that the tech bubble is bursting, third, potentially disruptive unwind of the yen carry trade, and authoritarian regimes view such volatility as evidence of fragility of the West, potentially encouraging geopolitical adventurism. Although stampedes are inherently unpredictable, they are viewing this as closer to irrational, thus creating buying rather than selling opportunities.
Okay, and let's also get you some money market views because the rupee has been hitting new lows as well. Abhishek Goenka of India Forex and Asset Management says the rupee has underperformed amidst broad dollar weakness. While until last week it was the best performing Asian currency, it has slid into the middle of the pack with the ringgit, Singapore dollar and offshore Chinese yuan overtaking it. With high carry and low volatility was the beneficiary of carry flows. Hence, he expects the rupee to continue to underperform amidst risk aversion, but does not see a runaway depreciation. In the medium term, the rupee is expected to trade in a range of 83.40 to 84.40.
On bonds, Vishal Goenka of India Bonds says that extreme and violent price moves marked trading across assets in global markets in the past few trading sessions. What started with Bank of Japan's move last week quickly transformed into yen currency unwinds, resulting in shock asset price moves across bonds, equities, forex, and spikes in volatility all across. India remained fairly insulated so far, and he expects the RBI to stay on hold and vigilant at their policy announcement due on Thursday. He expects bonds to face resistance this morning, with a bounce in Japanese equities and the 10-year benchmark bond yield to trade between 6.86 to 6.92%. Also anticipates global volatility to continue this week as well. Well, that's lots of views, and let's get some more with Daniel DiMartino, Booth, CEO and Chief Strategist at QI Research. Daniel, great to have you with us here. Good morning. Appreciate your time here on CNBC TV 18. So is the global panic done for now, Daniel? Simple question.
I think it is. I think that there was, I think the pendulum swung too far and that the sell-off was too deep. And this is what we anticipate and expect. This is how markets behave at these kind of big inflection points. We saw the same type of behavior in 2000. We saw the same type of behavior in 2007, going into 2008. Markets trade in a very jagged fashion as the economy is turning. And I think that that's where we are right now.
Okay, but what about the whole issue with the yen carry trade and what's been happening with the Japanese market, do you think even if we see a bit of a pullback and the worst is over, we could be heading into a very volatile phase globally? And if that is the case, then how does one approach markets like India?
Well, I do think, and I was trying to say that I was expecting a lot more volatility going forward. We know that more than half of the positions that were short the yen at the beginning of July have been since worked off. So we can say that we're more than 50% of the way through the unwind of this carry trade. But I think that there are so many different things going on in the global economy right now that the base case is going to be for continued extreme volatility. We have to remember that there was a day last week that the Nasdaq QQQ, the Nasdaq 100, was up 5% in one day last week. So again, I expect this volatility to continue as there are so many different sources right now that are feeding uncertainty.
Hi, Danielle. Good morning. I recall the last time we chatted, you said maybe the US markets is towards the last leg of its rally. And you got it right, seems like, because post then the US markets have corrected. But the two markets you were positive on, one was the Mexican market and the Indian market. How do you approach both these two from here on?
Well, right now, the Mexican market is a bit riskier, much riskier because of the potential for contagion from the U.S. hard landing recession and how that's going to be affecting that country. I have high hopes that the new president will implement long-term good strategies. We're still long-term positive for Mexico. We certainly think that the peso sell-off has been overdone just in the last few days. But I think that you'll have a little bit more stability, if you will, in the Indian market going forward, given how closely Mexico's and the United States economies are tied to one another.
So from the emerging market basket, India is still the top pick?
India is certainly, I think, one of the better picks right now. Remember, the MSCI Emerging Markets Index today sold off by 4.2%. So to your point, you have to be very choosy with where you are within the emerging markets complex. I don't think that at this juncture you can just own the broad risk asset at this point. You have to choose.
So with all the volatility that you're expecting, Daniel, is the up and up, continuous up move. I mean, India and US have been the two best performing markets. I mean, actually throw in Japan there as well. Do you think that phase is kind of broken, or what's your view?
Yeah, I think that we have seen the highs for the market. We've seen more than 100,000 job cuts announced over the past 4 months in the United States. Last week, we had a very large announcement out of Intel Corporation, almost 20,000 jobs. Today, we had one from Dell Technologies, I believe 12,500 positions. So I think that the market is beginning to recognize recession. We saw the yield curve uninvert it was just a hot minute today, but boy, that really got the market's attention. The fact that the 10-year yield was finally where it should be on the yield curve, if you will, the yield curve steepening. So I think we're getting enough signposts to suggest that if the U.S. is going into recession, that we've seen the best we're going to see out of stocks.
All right. Thanks a lot for that, Daniel. Always appreciate your time here on CNBC TV 18. Let's slip into a quick break. On the other side, our list of top 10 stocks is coming up with our entire research team, so don't go anywhere.
Godrej Properties, all of them seeing losses of between 5.5% to 6.5%. Railway PSUs are bearing the brunt as well. IRFC, Ircon, RVNL down at least 25% now from the peaks that they made last month. Defense PSUs, a similar story playing out there as well. Mazagon Dock, Cochin Shipyard, Garden Reach, all of them ending lower, almost 5% or more. And metals having a meltdown in today's session. The metals index also was down nearly 5%, 6.5% lower for SAIL, similar for Nalco and Jindal Stainless, 7.5% lower in today's session. So all in all, red across the screen, and there was no sign of any sort of support at lower levels.
My wife, for instance, and she's been such a big contributor in what I've become eventually. I think some of the soft skills actually, and these are aspects, and the ability to without getting sort of stressed, being able to manage many different things. I'll just give you one example. When I was a CA, typically, and many of the advisors, the Indian Economic Service actually are women. They would be in a meeting with me maybe at 3:30, 4 or something, and they'd get these calls actually, and they would be, because they're in a meeting with me, they would be, declining those calls. If the call comes twice or thrice, I knew this was actually either their kid or their mates calling basically for what needs to be made for dinner. Yeah. And so because that's exactly what, my wife, so when I was at ISB, it's the rare occasions when she was not instructing our kids or the maid to actually say what needs to be cooked. My kids would call me up. I would be at a loss actually.
Believe in your strength, right? What is your strength? Carry that, right? It is your deep technical knowledge, your perspective, because that's where the new ideas generate, right? So keep focusing on that. That is one thing that will give you a purpose. Second thing is networking, right? Network with people whom you come across, building the network where you can share your ideas, express them, thrash them out. That is one thing which is going to be very, very helpful as you go ahead. Third thing, I will have to say that keep learning, right? Our industry is about change. It's just a lot of innovation every day. Even actually, sometimes it is impossible to catch up with everything. So keep learning. Wherever is an opportunity, learn it, right? And the last but not least, resilience, right? Don't get disheartened by a failure, right? Failures will happen. Learn from it.
One particular moment, so I actually come from a very humble background. My father lost his father.
Welcome back to Bazaar Morning Call. We'll expect a gap up opening today after a strong rebound that we've seen in the Asian markets, and that green is really coming as a big relief given the kind of setback that we saw yesterday. But our research team is standing by with a list of top 10 stocks for the day. ONGC is the first one on our list. Let's find out why you should be tracking that one. Sonal, good morning.
Good morning, Sonia. Well, ONGC reported numbers which were better than estimates. Margins were higher largely because of lower operating expenditure. The profits lower than estimates. That is largely because of lower other income on a quarter-on-quarter basis, higher depreciation and higher tax rate as well. But if you look at the numbers on a quarter-on-quarter basis, revenues were up 2%, EBITDA increased by 6.8%, margins came in at 52.7% versus 50.2%. Profits were down 9.4% for the reasons that I mentioned earlier. But these are better than what the street was working with. Crude production and gas production, both of them have declined 2% on a sequential basis, slightly better than street estimates. The conference call is at 3:30 p.m. today. We'll get more idea about discoveries and also the production from KG Basin. Jeffrey says the numbers were better than what they had estimated. They have a buy with a target price of 390. Crude also has recovered a bit, so expect some green on this stock today.
Okay, thanks a lot for that, Sonal. Well, let's hop across to Rima, who's here to tell us about Bharati Twins, who had reported their numbers. Morning, Rima.
Hi, good morning. So let me start with Bharti Airtel, where, some would say it's in line. Some are saying it's a slight miss on the margins. So the company has reported a consolidated revenue growth of 2.4% in line with expectations, but margins at 51.8% fall short by about 30 basis points. Again, not too much of a miss, and the miss has come in on the enterprise business. The India mobile business has reported a revenue growth of 2.1% ahead of what its peer Reliance Jio has reported. Margins have expanded by 50 basis points. The ARPU growth is modest. From 209, it's become 211. But remember, the big ARPU jump is only going to come in Q2 once the tariff hike takes effect. Subscriber net adds at 2.2 million. So on the whole, it's not a very exciting quarter. But, considering that, the whole market is going to be in the green, I'm going to go with green for Bharti Airtel because there's nothing so bad in the numbers, for it to, come under severe pressure. Profits, though, have jumped up by more than 100%, boosted by an exceptional gain. Here, the conference call is at 2:30 p.m. Bharti Hexacom is again slightly lower than street expectations. Revenue growth of 3.7%. Margins have declined by 120 basis points quarter on quarter. Profits, if you adjust for the exceptional gain, are down 13% on a quarter-on-quarter basis. And this is a stock which has outperformed its run-up since its IPO earlier this year. So, it's slightly lower than expectations. Back to you.
All right. Thanks very much, Rima, for that. So that's Bharti and Hexacom in focus today. But more numbers. Tata Chemicals, Deepak Nitrite, Sonal is here with details. Sonal, good morning.
Good morning, Prashant. Well, for Tata Chemicals, it was a big decline on a YY basis. If we look at the EBITDA, that was lower. Operating profit margins at 15.1% versus 24.7%. Profits were also down by 67%. But what was the positive? The positive is that margins have recovered on a quarter-on-quarter basis. They have come in at 15% versus 13%. And in their commentary as well, the company says that their India business demand was quite stable across all end-use industries. In America, demand was flat. In Europe, they experienced muted demand. But they were facing a big competition coming in from Turkey in terms of dumping at lower prices. That they think is going to end soon because of global problems and freight cost issues as well. So that is a positive there. For Deepak Nitrite, it was a good set. On a YOY basis, the revenues increased 22%, EBITDA 47%, margins improved around 300 basis points, leading to a profit increase of 35%. This was led by the phenolics division. So while the advanced intermediates saw an EBIT decline of 42%, phenolics saw an increase of 137%, and that is the reason we saw that beat on numbers today.
Okay, thanks a lot for that. Well, Vamakshi is also joining in to talk about Schneider Electric, BEML, Triveni Turbine. She has her hands full this morning. Vamakshi, good morning.
Good morning, Sonia. Let me first start off with Schneider. The company reported a good set of numbers. Revenue was up nearly 20%, and this was largely being driven by strong sales growth as well as better mix of transactional and services segment. EBITDA margin too saw an uptick of almost 380 basis points to 13.8%, driven by a better product mix, order pricing and operational efficiency. Resultantly, the net profit surged by almost 40% on a YOY basis. The order inflow too was healthy, up nearly 19%, coming in at 531 crores, with good momentum seen across ordering activity across all the segments. The order backlog resultantly came in nearly 16% higher. BEML, on the other hand, reported a weak set of numbers. Revenue grew by almost 10%, but this is much lower as compared to what the company had guided for. They had guided for 20 to 25% growth in the top line for FY25. EBITDA loss of 50 crores is what the company has reported, the same as the same quarter last year, and they've also reported a net loss of 70 crores. Order book saw an uptick of almost 21%, of which nearly 3,400 worths of orders are executable in the current year. So overall, a weak set coming in for BEML. But lastly, let's focus on Triveni Turbine. It's a strong set, beat across the board. The company has reported the highest ever quarterly revenue, EBITDA and order booking. Revenue saw an uptick of 23%, largely being led by the domestic business mix. EBITDA margin came in nearly 180 basis points higher. It came in higher than estimates as well. Net profit saw an uptick of 32%. They've also managed to report the highest ever quarterly order booking of 636 crores, and this is largely being driven by exports, but domestic order booking was rather muted on account of the elections. But overall, good set for Triveni Turbine as well.
Thanks a lot for that, Vamakshi. Well, let's wind this down then with Sudarshan, who's here to tell us about a few more stocks that he's tracking. Sudarshan, take it away.
Morning, Nigel. So we'll start with V-Mart Retail. On the bottom line, company has reported profit against loss in the same quarter last year. Profit has come in at rupees 12 crore versus loss of rupees 22 crore. Revenue was up 16% and margin has expanded by 500 bips year on year. Even internals are looking strong. Same store sales and same store volume both were up 11% each. Footfall has risen 36% and sales per square feet per month was up 13% year-on-year. And for Lime Road business, losses have seen a sharp reduction. On year-on-year basis, losses have reduced by 60%, and on a sequential basis, it has come down by 15%. For Aarti Pharma, I'm going with green just because of healthy revenue growth. Revenue has increased by 21% year-on-year, but margin was lower both year-on-year and sequentially. EBITDA was up 14% and profit has increased 18%. Guidance for FY FY25, company has maintained it. It expects EBITDA growth of approximately 10 to 12%, and it aims to achieve long-term goal of about 15% annual growth in the next 3 years. So I'm going with green for both V-Mart Retail and Aarti Pharma.
Okay, V-Mart Retail and Aarti Pharma. Thanks a lot for that. Here's a quick recap of our top stocks. Stocks with positive news flow: ONGC, Bharti Airtel, Tata Chemicals, Deepak Nitrite, Schneider Electric, Triveni Turbine, V-Mart Retail and Aarti Pharma. While stocks with negative news flow, there's Bharti Hexacom and BEML. The good part, though, is that crude prices have fallen, and that's always good for a market like ours. So Manisha Gupta is joining in to tell us the latest in the commodity markets overnight. Manisha, good morning.
Morning, Sonia. Thank you for that. Well, yes, the commodity has seen a pause after the sell-off that we saw in the markets yesterday. The crude oil prices did hit a 7-month low, but we've seen nearly a percentage point of gain come in for the Asian markets right now. Well, there are concerns about weak oil demand. The geopolitical tensions in Middle East, though, also add to uncertainty. The area that has continued to decline and has extended further decline today is the metal prices. Poor demand, rising inventories, weak economic data, sell-off in other asset classes, recession concerns in U.S., almost everything seems to be weighing onto this space. So from its highs in this year, most of the metal prices now are down by 15 to 25% on the lower side. Markets will, of course, watch out on how the stability comes back in the global market. But until then, there is really no reason to buy into metals. Further declines, almost by 0.5 to 1.5% down across sector.
All right, Manager, thank you very much for that. I mean, Chinese data, terrible. We look at the PMI numbers, big contraction there, no rebound. And China, of course, the margin is the big incremental buyer still across all commodities pretty much. We take a break. Amnish Agarwal at Prabhudas later is going to be joining in with more fundamental stock analysis. Stay tuned for that.
And just completed school. I was the first person in my clan to go to university. So when he first came to campus and I took him to the library, the Vijay Kelkar library there, I remember him actually being very emotional and saying, at least in my next life, I get the opportunity to study in a university like this. So that moment is something which is etched in my memory. I'll be absolutely honest, I did not even know what a chief economic advisor is at that time. If somebody said I'll be X, Y, or Z, or even executive director, I don't think even I knew what the International Monetary Fund was.
I came here in 1991. 1991, that was my first year of college. I came here for Inter-IIT. So I remember this campus especially because this is one thing that I think especially the women need to hear. So I was, good in table tennis, but I became the captain because my captain dropped out. And I came here and we were playing and I won the first game. And then all the men started booing me.
Are you serious?
Yeah. And so I realized the power of mind, right? Like I was better than the player that I played against, but I lost. And I think that was my first lesson that I learned, which is that, you might be better, but sometimes, your circumstances make you believe you're not, and therefore you lose. So I think that's one thing that everybody needs to do, and I think coming back to this campus...
We have to correct that. We have to give it a big round of applause now to make up for what happened in the past.
Yeah, but my coach also gave me gajar ka halwa, so it was okay.
Today, she is the director for the mission that actually saw India's first private rocket being launched. So tell us a little bit more about that, Saranya, and what, you did that all under 30?
They gave me an opportunity to be the vehicle director for the mission. So it was a huge learning for me to build. We started off the company by at least when I went in, I didn't know anything about the rocket building. So to building a vehicle which can actually fly, it was amazing.
Not just actually fly, it's actually flown.
Yeah.
So congratulations to you and to the entire team at Agnikul. I know for many of the students here in the room, you're a role model, but you talked about Naveen being the initial role model for you when you got started. But let me end by asking you, who do you look up to today? Which are the companies that you respect and admire? And, is there anyone in specific that you like to emulate in your style of working?
With the one individual that I have, I wouldn't say seen in very close quarters, but
You see, Bharti numbers were quite good, and the main thing is that the ARPU increase which has happened. So I think from the medium to long-term viewpoint, Bharti continues to look as an interesting stock plus. I think as the time goes by, I think the growth will be there and the stock will continue to make new heights.
Okay, that is on Bharti. Given that we've had such a big fall, Amnish, what is your view now on how to approach some of these large cap names, whether it's banks, IT stocks? If this dip continues and you have to buy into it, what would your shopping basket look like?
You see, first of all, my view is that the yesterday's dip is more like temporary. There is no inherent change in the fundamentals of India as a market or as an economy. And this dip is related to the global geopolitical uncertainty plus you can say the expected change in the global capital flows. While it can have impact in the near term, but I think in the longer term, the fundamentals, they will remain intact. Now, at the current juncture, I think we have seen yesterday a big cut across, you can say, sector, whether it was banks, whether you can say your cap goods were there, autos were there. So I think very broad spectrum of stocks which have seen big cuts. So I think there is no specific name, I would say, in terms of, say, shopping basket. I think all the frontline companies where the fundamentals look good, whether these are, for example, like Reliance, the frontline banks, you can see the frontline stocks in the capital goods. Okay, FMCG companies, they didn't, I would say, correct. Even the large cement names like your Ultratech and Ambuja. And then you can look at, say, some of your names like even the port companies. So I think one should look very broadly because the fundamentals, there is practically no change. So there might be near to medium term volatility that can't be ruled out. But on the lower levels, it be, I think, a good time to go for the companies which are well placed, where the balance sheets are strong and the business mode continues.
Specifically, Amnish, hi, morning. Autos, right? The Nifty, I'm looking at the Nifty Auto Index. I think it's seen one of the sharpest cuts. Closed at 24,700 yesterday. The high on Thursday was almost 27,000. So from 27,000 to 24,700 in 3 sessions now. What's the big fear here? And what do you do here? What are your calls?
You see, I think auto is having two things. First of all, we have seen that particularly the PV market is showing some signs of a slowdown. If you exclude, say, M&M, look at all the other PV companies, I think in the last 2 to 3 months, the sales growth there has slowed down considerably. That is one. Secondly, if you look at, say, past year or so, many of these auto stocks, they have given even up to, say, 60 to 80% returns. And the third is, if you look at the geopolitical situation, whatever happens in the commodities, and particularly if you look at the large company like Maruti, so there will be impact of, say, the currency volatility also in some of these companies. So that is one reason we might have seen, you can say, some sort of a pressure in some of these stocks. But I think barring Maruti, where we will have to see how the Japanese yen, I would say, stabilizes and other things go, I think that there is no big change in the fundamental for rest of these stocks. And after, I would say, reasonable correction, I think some bit has happened today. There might be, you can say, a little bit here and there more. But I think the calls practically remains the same. In the long term, Maruti continues to look good. M&M continues to look good. And among the two-wheeler stocks, Hero is the stock which we have been liking.
Okay. No, I mean, that's one space which has seen a fair bit of damage. The Nifty, I'm just looking at the last 3 days, is down 4%. The auto index is down 8.5%. So, the damage is much more. There's information at the bottom of the screen as well. Sources are telling CNBC TV 18 the government is weighing an option if if an option can be given to stick to the old capital gains tax regime for real estate, so if you, it's like the old and new regime, and the government prefers grandfathering be given till 2024. So these are important flashes which are coming, which we will address in just a bit. No decision has been made, but from a real estate perspective, I think it's going to be such a big thing if this were to come through. A lot of angst after the change was made about removing indexation benefits. But let's focus on the market, stay with the markets. Anuj is here with how he's looking at the market. Anuj, good morning.
Good morning, Prashant. You and I both were there when we had this 2008 kind of play out. And if we had this kind of screen, global screen in 2008, the Indian market would have easily fallen 10%. But it's the strength of the inherent strength of the Indian market that we actually fell the least. If you look at our peers, and after 10,000 crores of selling, Nifty fell 2.7%, which is really par for the course. And as I said, in 2008, in such a scenario, we could have easily fallen 10%. Now, for the morning, at least the cues are looking slightly good, in a sense that it looks like we are in for some short covering bounce. Whether it sustains or not is the big question. The put-call ratio at the zone of 0.72. Global screen looking much better today. Of course, the big question will the recovery last? And the most important cue last night was the US CBOE VIX. Intraday, it went to 66 from, I think, 23 or thereabout. And then it cooled off and closed at 38, signaling some kind of intermediate bottom in the US market. I think that's the cue that the Japanese market and the Asian markets are taking, with the US futures also being up. And most of the markets today are up. Look at that number, 10,074 crores selling by FIIs, but all of it dollar to dollar absorbed by DIIs, 9,100 crores. FIIs also sold in cash in index and stock futures, 2,400 crores in index futures, and sorry, they bought in stock futures about 1,390 crores. In terms of positioning, 11,000 long contracts were cut yesterday, and about 23,000 shorts were added, which means that we are now at 60% net long. Remember, we were at 1.88% net long. We are now down to 60% net long. And in terms of contracts also, it's about 1.1 lakh contracts. Coming to levels now on the Nifty, the first resistance would be 24,300 to 24,350. Yesterday's double top on the intraday chart. And then 24,450 to 24,550. That's where option writers are placed. And that's where the most important level, the 20-day exponential moving average, is also placed. Support comes in at 23,900 to 23,950, and then 23,400 to 23,500. And the bank Nifty has been quite weak for last few days. It closed below 10, 20, and 50-day exponential moving average, and just somehow defended the 100-day exponential moving average, which is the support, by the way. In terms of resistance, 50,500 to 51,000, and then 51,300 to 51,500 is the kind of resistance that I'm looking at in this market. Quickly leave you with the quote of the day, and that would come up for you on the screen. This is interesting. I don't know who's written it, but the quote is good. When shifts and transitions in life shake you to the core, see that as a sign of greatness that's about to occur.
Okay, thanks a lot for that. Very helpful there. Sane advice coming through both on the markets and on life, as always. Thanks, Anuj, for that. Well, Amnish Agarwal is still with us, Head of Research at Prabhudas Lilladher. Amnish, I wanted your thoughts on ONGC, the numbers, the stock, and as a long-term investor, how do you approach it now?
You see, in the overall volumes has not been there much, and given the fact that the stock has seen a big rally in the you can say last 12 to 18 months, the stock seems to be, I would say, fairly priced. So in comparison to your oil, the companies, in comparison to ONGC, we are more comfortable in Oil India, where there's more production going to increase because one of their oil fields has gone live. So there will be some volume growth over the coming 2 to 3 years. So we are preferring Oil India over ONGC. It is not going to be very encouraging in the near to medium term.
Okay. Thanks for that, Amnish. Have a good day. Thanks for joining in. Let's talk about BLS International now. The company reported a strong quarterly performance with the margins at a multi-quarter high. Profits jumped 70%. Their visa and consular revenue also witnessed a strong growth. Shikhar Agarwal, the Joint Managing Director of BLS International Services and the Chairman at BLS E-Services, joins us now. Shikhar, thanks a lot for joining in. You know, in your visa and your consular business, you saw a very good growth. What led to that, and what kind of sustainable growth do you see for the rest of the year?
See, definitely, if you see in the visa and consular business, we grew 35%. And, if you see at the EBITDA level, we grew 70%. Even the margins now has grown to 27% from 21% earlier. So definitely, I think the levels that we've achieved is sustainable. This is the new base of the company. We've been talking about increase in margins from the last few quarters. That has been, there have been variety of factors for that. Change in partnership model, increase in service fee, new contracts at higher service charges. So definitely, I think those are the factors that have led to increase in margins. And if you talk about increase in revenue, we've had a volume increase as well, 18% volume increase in terms of visa numbers, from new contracts and existing contracts. And I definitely feel these levels are sustainable.
Okay. Hi, Shikhar. Good morning and good to see you. And as always, you've completed the iData acquisition, right? And that was likely to help you in terms of market share, I think, in the European region. Could you tell us what will be the financial impact that we start seeing from Q2 onwards? If you could quantify it with some numbers, because on a quarterly basis, it'll start giving you some numbers.
Yes. So Nigel, the first quarter numbers definitely do not have iData consolidation. We completed the transaction on 10th of July. Last year, calendar year, iData follows a calendar year. They did a revenue of around 300 crores and an EBITDA of 144 crores. So definitely, I think that could be maintained this year. So on a quarterly basis, I think 25 to 30 crore of EBITDA would probably be added. So I feel that that will start coming in. And as economies of scale come in, we combine both of our offices, in different geographies across the world. We also impart certain knowledge from our operations to them. Cost comes down, revenue increases. We expect increase in revenue and profitability also to come in from iData.
Got it. Okay. All right. The other positive was the margin expansion. Is there any one-off in the overall margin expansion, and can you maintain these sort of margins?
Nigel, if you see last few years, BLS International, the margins have been growing constantly. So last year we reached 21%, which was an uptake of 500-600 basis points from the year before. Now in this first quarter itself, we have reached 700-600 basis point increase in margins. I think a couple of factors that have led to this increase is that we have got increase in service charges from new contracts that we are winning at a higher service charge. Existing client governments, the retenders also at higher service charges. We have also transformed our business model in certain countries where because of local laws, we were operating with local partners and there was a profit sharing. Now we have taken over with the change in laws in those countries, particularly in countries in Middle East like Saudi Arabia, in certain Latin American countries. So that has led to an increase in margins. And I feel definitely this will be sustainable. And our endeavor, as always, will be even to take it further, increase in margins.
Okay. This cash on the books, right? Almost 1,300 crores. Any kind of use for that in this year? Any acquisitions that you're looking at? If yes, what are the geographies? What's the domain? And any timelines?
See, the cash on the books is before the acquisitions were announced. So this was the end of first quarter. I think in July, we've already paid for the acquisitions that we did of iData. And in BLS E-Services also, we've announced the acquisition of ID-List Loan Solution, which is a 200 crore company, where we were acquiring 55%. So certain cash will be utilized in that also. So after that, the cash that will be left and the further cash flow that will be generated in the next 1-2 years will be further used in, we are looking at more acquisitions in the near future, and looking at the growth of the company and reinvesting the money also in further geographical expansion, new contracts that are poised to come, technology, and also dividend to the shareholders.
Okay. All right. Useful. Thank you very much for joining us with that commentary. Appreciate you coming on with all of that. Shikhar, appreciate your time here on CNBC TV 18. GIFT Nifty will come up on your screen. Just take a quick look at what the start is looking like. We'll also just put up what the Asian markets are doing. And then we'll slip into a break because we also want to get you the technical trading ideas with our experts in a bit. So 200 points still higher, 24,295. Yesterday, we started 400 points down on the Nifty, and then it looked like it was steadying a little bit. 24,300 was being defended. Then within the next 30-40 minutes, 24,200 was broken. A bit of stabilization, and then of course in the second half, you lost some more. So finally ended, I think, about 700 points, just under 700 points lower after starting with a 400-point cut. So you're going to start to recoup some of that this morning. I wanted to look at Nikkei and what that is doing, because yesterday that market lost 12.5%. Not so much the Japanese equity market, but what was happening with the currency there was a big reason why global markets were in a bit of a dizzy. That currency is rallied from 162 to 142 yesterday, and right now you are having the yen is lower, the dollar is higher, so 145.56 is what you have on the USD JPY. We'll take a break. We are back with, of course, our technical trading experts. So some calls coming your way in a bit from now.
As part of my work in CII, what I truly admire is Mr. Uday Kotak. I think he has built a franchise in a bank that is truly outstanding. And to do it in one generation, and the quality of talent and the kind of ownership that that talent takes is remarkable.
Finance Minister Nirmala Sitharaman is just a few hours away from marking a new record. The CNBC TV 18 coverage of the Union Budget starts right now.
Hello and welcome to CNBC TV 18 Motilal Oswal Budget Headquarters. Markets have not just grown, they've broken several records in the last 25 years. India's contribution to increase.
Welcome back. News at the bottom of the screen. The Japan Finance Ministry and the Bank of Japan are going to hold a three-way meeting this morning at 11:30 a.m. That is the news which is coming through. Will they take action? Remember, all this basically started with the bank. I mean, markets were not expecting the Bank of Japan to do anything last week, or maybe it was the week before, but basically a few days ago, I think it was last week. But what the Bank of Japan did is they did a hawkish hike. And that raised expectations that, while the rest of the world is waiting for rate cuts, Bank of Japan is essentially on a hiking spree, or will be on a hiking spree. But with all the turmoil that we've seen yesterday, I think that is extremely unlikely that they will sort of continue to hike, through all of this. They'll have to sort of acknowledge what has happened to the yen, and of course, to the equity market as well, and the panic that it has set off around the world. Would they do something is essentially the question, especially with the yen moving 20 handles from 162 to 142 yesterday. Will they step in some way? So we'll know more during the course of the day. I think this is the first concrete central bank sort of regulatory announcement which is coming from global markets. People were yesterday talking about the Fed, but so far, nothing. Mitesh Thakkar and Sudarshan Sukhani are with us with what they'd want you to do in terms of trading setup and trading strategies. Gentlemen, good morning. Good to have both of you here. Mitesh, what is your sense? Is the panic for now done? The worst of the panic, let me put it that way. Volatility, yes, will continue. And how would you trade it?
Morning, Prashant. My sense is that yesterday we got what I will call as a weekly gap. And that could, be something which could be a trend changer for a medium term. So unless until the gap gets filled, which means that the Nifty starts scaling beyond the previous week's low of 24,700, I think that's a respite then. But if that doesn't happen in the next few days, I think there's a good chance that we will see slightly lower levels, and this correction could be a bit more deeper than what we have seen till now. So it could be if we give it about 2-3 weeks kind of perspective, it could be down to about 26,400, 500 zones. So slightly negative. Today we are seeing some kind of a positive gap up opening, given the fact that the Asian markets have rebounded well. But in the immediate term, again, 24,500 or 540 zone would be very important on the Nifty spot. And I think as we get closer, we should see higher supply emerge. And clearly, I think, if we see on the hourly chart that the market is not sustaining around those levels, I would even want to get into short positions. A lot of stocks have broken down, given some kind of short-term trend reversal signal. So the overall bias is that this correction could be slightly more deeper, though today could be a day of pullback.
What about individual stocks? Right, Sudarshan Sukhani is also joining in, so let's get his view. Sudarshan, hi, good morning. Do you think that the worst of the fall is behind us, or could there be some more? And what's the way to approach individual stocks now?
Sure, good morning. I'm not sure what worst of the fall means. If it means that the volatility that we saw is behind us, the answer is yes. The extreme volatility that we have seen is unlikely to be replicated soon. That was unusual. But the decline probably has not come to an end. We have started a correction. That correction has also entered into a seasonally downtrending period, August and September. So I don't think the downtrend is over, but probably it will be much more orderly than what we have seen in the last 2 days. So to that extent, it will be easier to manage. So that is the view, that we're probably looking at lower levels soon enough. For the day, there is a relief rally, and even when there is a correction, since the overall trend is up, relief rallies could easily be bought into. So buy a dip today and keep it intraday. We'll see what happens tomorrow. Now we are talking about stocks. Stocks are a mixed bag. I have Balkrishna Industries, which is an intraday short, the stop above 33.62. Then Dixon is an intraday short with a stop above 12,112. And there are two buying opportunities. Keep them as positional buys, and both come from the FMCG sector. Hindustan Unilever with a stop under 26.67 and Tata Consumer with a stop under 11.82. But remember, they are not today. They are for positional trades.
Okay, and Mitesh, what about you?
I have more of sell calls. The only buy on the list is Asian Paints with a stop at 30.63 for targets of 31.50. And on the sell side is, I would want to use the bounce back to possibly look at some weak stocks which could decline further. Ambuja is a sell around 640, 645 range. Keep a stop at 656. Look for targets of 615. Concor around 990 could be a good shot with a stop at 1020 for targets of 935. And IRCTC sell around 935 with a stop at 955 for targets of 895.
Okay, all right. Mitesh and Sudarshan, thank you very much, both of you, for joining in with that perspective. We'll take a quick commercial break here. We're going to come back with the pre-open rates. We'll also propose sale of ICICI securities, and we put the focus on falling oil prices. That's the silver lining in all of this for a market like India from a real economy perspective, and maybe for some stocks as well. Stay tuned, that's coming up.
GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
buy there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Great way to celebrate our own 25th year with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record.
Well, it may not be prudent to celebrate too early because we are seeing a bit of green on the screen, but then we could also see a lot of volatility given, the kind of turbulent global cues we have upon us. Sneha Seth, the derivatives research analyst at Angel One, is with us. Sneha, hi, good morning. How are you approaching the markets today and what are the stocks to look at?
Very good morning, Sonia. If we look at yesterday's selling, I think we may see continuation of this selling pressure going ahead. Looking at especially the IBs, which surged more than 40% yesterday, now trading around 20% and above levels. So at present, I believe the gap zone around 24, 350, 700 should be acting as a resistance. On the lower side, any correction below 23, 900. That can bring index at least towards the 89 EMA, which is placed around 23,400. So I would suggest that anyone who is holding any long position should prefer, exiting their longs in case of any bounce back. And someone who wants to go ahead and long, I would say wait for some more time, avoid any kind of a bottom fishing at present. In individual counters, I have two sell calls. The first one is on ICICI Bank. If you look at this counter, it has been recently in pressure. Yesterday also we have seen addition of short position. So I believe we may see a continuation of selling pressure at least towards the 89 EMA. So I would recommend selling with a strict stop loss of 1190 and the target expected will be 1150. Apart from this, M&M is a sell. Again, this counter in last 3 sessions has, added decent short positions. I believe we may see further selling pressure. So I would recommend selling with a strict stop loss of 2734 and the target expected will be around 2547.
Okay, thanks a lot for that. So those are some calls coming in from Angel One. But here's also one equity market view for you. Lawrence Belanco of CLSA says that the Nifty has outperformed by falling less. Nevertheless, in absolute terms, the index is now testing support provided by the 50 DMA at 23,905. He also says failure to hold this level would leave the Nifty vulnerable to drop back to the upper boundary of the March to May trading range of 22,775 to 22,800.
That is some distance off if it were to come to pass. But that's somebody whose technical views are closely watched. I want to just put out Victor Schwetz, who's also a very closely followed macroeconomist, and he's of course with Macquarie, who says, it's a commentary about the recent sort of events. He says, given the sell-off in Asia and a spike in wicks above 50, the question is what dangers are investors facing? Does it require joining the stampede or create a buying opportunity? Victor says that the sell-off was precipitated by a confluence of events, that is, perception that the Fed is behind the curve, investor concerns that, and I quote, tech bubble is bursting. Third, potentially disruptive unwind of the yen carry trade, and authoritarian regimes view such volatility as evidence of fragility of the West, potentially encouraging geopolitical adventurism. Although stampedes are inherently unpredictable, Victor says, he's viewing this as closer to irrational, all of this sort of panic and mayhem, thus creating buying rather than selling opportunities. So that's a broad sort of global view which is coming in from someone who tracks this stuff pretty closely. Nigel.
Okay, all right. Well, let's focus on the oil and gas space. Then we have Prabal Sen, who joins us to help us out with a quick take on how things are shaping out there. Hi, Prabal. Good morning, and thanks a lot for joining in. Well, we had ONGC's numbers. As per your reading, how was it, and what's the view on the stock from here on?
ONGC, I think operationally the numbers were broadly in line. In fact, EBITDA was probably a bit ahead of our as well as the street estimates, from what I reckon. On the net earnings line, obviously, there's a few line items that we'll have to still look at in the call. I think depreciation plus exploration write-offs were perhaps a bit higher than what we were anticipating. So for that reason, net earnings probably missed estimates a bit. As far as the stock is concerned, I think, we've maintained this for a while that it's a very binary situation as far as the stock is concerned. If the KG Basin asset performs as has been guided, and from H2 onwards, the YOY growth actually starts to come back in terms of overall production numbers, we see no reason why the stock cannot, continue to outperform even from these levels. But if there is disappointment on that front, there is, a little bit of a downside risk that can actually emerge, because at the end of the day, the main thing that has driven the stock up has been the optimism around, reversal of the last 7-8 year trend of declining production in the standalone numbers. So to that extent, I think that is the main monitorable that we'll continue to look at and continue to track. And that is what, we would look forward to in terms of management commentary in today's call, I think, which is scheduled at 3:30. So for now, we continue to be positive. We believe that, if that production growth comes through both on a standalone as well as on a consolidated level, I think the stock stands to probably perform well from here on.
Okay, all right, Prabal. So KG Basin is something that we'll track. For the time being, you continue to remain optimistic on prospects. Also, I wanted to ask you about IGL and MGL. Both of them saw a beat on the margins. But do you think there's a risk on the volume parameter from here on? And what's the view on both these two names?
So I think, firstly, as far as volume growth is concerned, particularly if the moderation in, the LNG prices continues to be there. And very clearly, if you look at global estimates of LNG supply additions, there's probably around 170 to 180 million tons of fresh liquefaction supply that's expected to come online in the next 4 to 5 years. So to that extent, if you look at demand additions, most estimates will be between 25 to 30 million tons. Now, the timing of the supply additions may not coincide with the way demand grows, obviously. So there could be probably a bit of tightness still in this year and part of the next. But from a 5-year perspective, LNG supply, I think, is looking to be in surplus, which is obviously good news for gas consumers here. Because at the end of the day, whatever growth has happened in domestic supply, we still will continue to import between 45 to 55% of our requirements from the LNG route. So I think from a margin and pricing power perspective, we remain fairly confident that the CGD companies will continue to do well and continue to perform strongly. Our pecking order, I think MGL we probably like a bit more, because valuations we believe are much more attractive, despite the fact that now earnings growth as well as volume growth for MGL is now coinciding with their larger peers, while their margin strength, I think, continues to remain probably better compared to some of their peers. So between MGL and IGL, we will continue to prefer MGL at these levels, but on the whole, the CGD space itself, I think, looks pretty good to us from a pricing and margins perspective.
Okay, thanks a lot for that, Prabal. Have a great day. That's the word coming in on some of these oil and gas stocks. But let's get to the market now. We have a market that's opening in less than 10 minutes from now. And looks like it's going to be a decent opening. 130 points in the green for the Nifty. Let's see whether we can build on to our gains or not. Sudarshan Sukhani is back with us. Sudarshan, what's the big call at 9:10?
Consider buying Tata Consumer Products with a stop under 1182.
And Mitesh, what about you?
I recommend selling into Concor around 990 for targets of 935.
Okay, Nimesh is also with us. Tell us about the standout brokerage report of the day. Nimesh, over to you.
Hi, Sonia. Morning. So today's standout is on Birla Soft. An interesting upgrade from Macquarie. They've upgraded the stock to outperform from neutral.
and they've retained a target price of 720. But they believe that after the recent correction, remember the stock is down 15% in the last few days, they see a good entry point into the stock at these levels. While Q1, revenues declined 2% quarter-on-quarter, management did cite delays in terms of project ramp-up in the manufacturing and healthcare vertical. However, Q2 could be much better according to the management, and they see a better revenue performance and deal wins as well. In fact, Macquarie says that they see a trigger for EBITDA margin to recover back to 14 to 16% and an improvement in the sequential growth as well. So post the recent correction, a good entry point according to Macquarie, and hence they've upgraded the stock now to outperform with a target price of 720 on Birlasoft.
Okay, all right. Thanks very much for that. Nimesh, thank you for getting us that view on Birlasoft. Tata Chemicals is the other one we want to shine the spotlight back on again. Sonal is here with that. Sonal.
Well, Tata Chemicals numbers looked weak on a YOY basis. There was a revenue decline, then EBITDA decline. Revenues were down 10%, EBITDA declined 45%. The margins were lower by almost 900 basis points. Profits were down 67% as well. But the positive this time is that there's a quarter-on-quarter recovery in margins. Margins came in at 15% versus 13% on a quarter-on-quarter basis. Now, if we talk about the segmental breakup, the basic chemistry business saw revenue growth of 17%, but EBIT there declined by 62%. In the specialty products, revenues were down 1.6% and EBIT was down 8% as well. The net debt has increased and the company says that is because of working capital requirements. In their commentary, the management says that in India, demand was stable across all end-use industries. Demand for flat glass, container glass and solar glass is robust. In America, demand is flat, but in Europe, it's muted. But a positive comment came on Turkey because Turkey, remember, had been dumping a lot of soda ash at lower prices, leading to lower pricing. They say that competition from Turkey may decrease due to higher shipping costs. So that's a positive. Net debt increased because of higher working capital loans and capitalization of leases. So it's a weak number on a YOY basis, but sequential recovery is a positive. Also remember, Tata Sons has become debt-free because of some receipts they have from TCS, and this indicates that there's no IPO for Tata Sons which is possible, which they would go ahead with. So the Tata Group also is in focus.
Okay, all right, Sonal, thank you very much for that. Something to keep an eye out on. But Sonal, tell us about Deepak Nitrite as well.
Well, Deepak Nitrite, good set of numbers. This is after a long time because remember, phenol spreads have been positive. The commodity cycle has turned a little bit in favor of Deepak Nitrite. Even quarter on quarter, there has been a recovery and it was led by the phenolics division. Overall, revenues were up 22%, EBITDA was up 47%, margins higher by 300 basis points, and profits also, they went up by 35% to come in at 202 crore rupees. If we talk about the segmental performance, for the advanced intermediate segment, the revenues were flat on a YOY basis, but EBIT declined by 42% to come in at 66.5 crore rupees. If we strip off the one-off item in the last quarter, the EBIT is up 23% on a sequential basis. So that is a positive. Phenolics saw good growth. Revenues up 37%, EBIT up 137% to come in at 207 crore rupees. And the conference call is tomorrow. We'll get more details on demand and general recovery in the chemical space as well.
Okay, thanks a lot for that. Well, we just have about a minute to go for the markets to open. And remember, yesterday was a very steep fall, but this morning looks like the market could open in the green. What's leading from the front is the laggards of yesterday. So all of your global facing stocks, even something like an ONGC numbers were above street estimates. So the stock is up 1.5%. Apart from that, Adani Ports, Hindalco, Maruti Suzuki is coming back, after yesterday's fall. Biocon has some news flow going for itself. So that's in the news as well. And then you have a lot of these other auto stocks that are not looking too bad either. So just remember that this is a market that has started some sort of pullback or correction. Today, maybe you could see a relief, but there could be a lot of volatility as well because global news flow is not great. Yes, there's been a pullback in global markets overnight, but we've still seen some deep damage in the last couple of days. So yes, we might be getting carried away with this 120-point move today, but we need to sort of realize that there could be a lot of volatility.
I mean, you could say that a correction is a correction, as I think Sudarshan and Mitesh both said. But I think there is an orderly kind of a correction, and these panic 600, 700, 800 point. I think the panic bit is what as we've been saying, perhaps maybe behind us. But expect lots of volatility, and these things when they happen, they take time to finally settle down. You should be ready for that. I think at some point you'd lose that starting 100-point advantage. Perhaps you'd go in the negative, then you'd have a sharp bounce again. But, you know, that's the way the market starts to find its feet back again, even if you're entering or you're rather finishing something on the upside and starting maybe a more sideways kind of a move. But the point is, it'll be good if this sort of panicky, sharp moves, 3, 4, 5% kind of moves, we put that behind. Well, market open on your screen. The first trades, 160, 170 points higher, I think is where we are starting on the Nifty. We'll have the 240 points actually. So 24,300 plus. This is around the level where we started yesterday. So, you know, straight off after the close on Friday, we started at about 24,300 and we are back there at this point in time. So about 285 points in the green, 1% plus. Bank Nifty is starting about 0.9%. Of course, Nifty Bank has been much weaker. At yesterday's low, the Nifty Bank took support of the 50% retracement of the rally, which began on the 4th of June low, the election day low, to the all-time high. So we've already retraced here on the Nifty Bank, 50% of that entire move. Mid-cap index is starting 2% in the green. That's good. 56,986. I mean, even if large caps do what they do, if broader markets are more robust, I mean, you know, it's you'd find more people looking upbeat rather than downbeat. Advanced decline is good, 344 down, and about 1,400 stocks which are higher at this point in time. So a good-looking start with about 290, 300 points on the board, 24,345.
Okay, and you know, the 24,300 is something that the market has now conquered yet again. Sensex back up 930 points. So one up day, one down day, a lot of volatility. But today, the market is in the favor of the bulls for sure. Tata Motors is your top gainer, up almost 4%. ONGC as well, after the good numbers, up about 3%. Adani Ports, L&T, Maruti Suzuki, Tata Steel, a couple of other names that are surging this morning. On the downside, barely any stocks. Apollo Hospitals, SBI Life and H2L. Apart from that, you have, you know, a lot of stocks that are in the news in the broader markets. But for now, the start is looking very good.
Well, that's right, Sonia. And just take a look at a few stocks. You have V-Mart Retail. The stock is flying away. It's up more than 10%. We're talking about a wobbly market. The street likes those numbers. The margins have expanded by 500 basis points. So good going out there. They reported a profit that compares with a loss. Another stock, cash market stock from the broader markets, is Indraprastha Medical. Well, out there, those numbers look quite good. And it seems the street likes it because that stock as well has opened up with a big gain. I think it's up close to around 15% as we speak. It was, I think, locked up and now it's moved higher. Indraprastha Medical is the one that we're talking about, 18% higher on that name as well. So good up move is what we're seeing on that stock. Zomato, back to its winning ways. The stock is up close to around 5%. You have PFC as well that's bouncing back after the sharp decline we saw yesterday. So that stock is higher. Godrej Property is up 4.5%. So good move on that one. And these metal-related names as well that got spanked yesterday, well, they have pulled back a little bit. You have SAIL that's up and about in today's trading session. Marico, though, that stock is under pressure. It's down closer to around 3% odd. But a good start to the trading session. The Nifty is up more than 250 points. You'll want it to build on its gains. And the broader markets, an exact opposite of what we saw yesterday. When we started our trade yesterday, you had only 150 stocks that were advancing and all the other stocks were declining. Today, you have only 150 stocks that are declining. So the advanced decline ratio should come up for you. Good looking. Let's hope we build on from here. Prashant.
No, absolutely. You know, Nigel, Motherson is the top volume-led gainer across the board at this point. Stocks at about 184 and volumes are very, very large. So there's a 5% gain. Mazgaon Dock is coming up with a 3% gain. You mentioned PFC. PFC is about 4.5 higher. REC is also up about 4%. It's actually giving up some gains, but 3.6 odd higher on REC as well. There is Cera Sanitary Ware, which is jumping another 7%. Cera was up strongly yesterday as well. You know, Friday's close on the name was 8,900. Yesterday's close was 9,400. And stocks at about 1,080 right now. And volumes are also not bad for this point in the day. We've got IREDA, which is up 4.5%, 250. I'm not sure what's happening with Lux, but again, you know, from 2,070 to about 2,400, you know, Friday to today. So that's a big mover yesterday and on the upside and today as well. So these stand out because market's been down otherwise. NBCC is up about 3.5%. Stocks at 174. Bombay Stock Exchange is up 3%. So it's been, BSE has been all over the place. I mean, the recent low was 2,100. Then it rallied to a high of 2,600. And of course, yesterday it fell to a low of about 23.40 and coming back up a little bit right now. We had the management of BLS in the morning. BLS is up 6%. It's off the highs though, BLS, but it's still got solid gains. That's Bombay, London, Singapore. Yeah, that's one. So 372 on BLS. Brigade is up 5%. Stocks at 1176. Titagarh is up 4.5%. Hudco is up 3.6%. Schneider is up 7.5%. Is it reacting to earnings? I'm not sure, but that's a large move on a large stock coming through. KPIT, HBL Power, EMS Limited. I could go on with what's happening out there. Market breadth is also very, very positive.
Just
as you
one more
highlighted.
stock, Gokuldas. Just want to highlight that stock. You know, we'll try to reach out to the management as well. I think Bangladesh, I'm looking at the 2022 numbers, and Bangladesh contributed close to around 11% of the total global exports in the apparel segment. And that's where Gokuldas, caters to. So because of that, it appears the street senses that there could be an opportunity. 11% of the total contribution came in for Bangladesh. So I guess that's the reason why that one is flying away, up close to around 8%.
Also, just want to mention two sets of stocks. One is the real estate names are all rallying this morning. We were just reading about that possibility of the government preferring grandfathering till July 2024 as a relief to counter the removal of the indexation for real estate. The decision is not finalized just yet, but the possibility of that indexation relief is something that's getting all the real estate stocks up and about. And Prashant was talking about Motherson Wiring. Good set of numbers, more on that later. But the revenue growth of 15%, EBITDA growth of 15%, profit growth of 21%. So Motherson Wiring is up and about on that.
Gokuldas, we'll try and have the management join us on the air because the incumbent Prime Minister has been deposed. I mean, she's out of the country now, Sheikh Hasina. The government's gone. And of course, a new government will be formed in consultation with the army. But generally, I mean, is the interpretation that there is more certainty and operations were effected and they kind of are back on track now? So of course, I mean, market is collective wisdom. So this is being read as positive, certainly positive. 9.5% now on Gokuldas exports, 1,010, 1,015. As I said, we'll try and have Siva, the CEO of Gokuldas, join us to explain to us what the situation there is with their operations specifically. And of course, Bangladesh is a market as well. Pankaj Murarka is with us now, CEO and CIO at Renaissance Investment Managers. Pankaj, good morning. Great to have you with us here. Thank you for your time. Appreciate it. So we've been through a lot of volatility over the last 48 hours, maybe a little bit more. Started last week. And of course, yesterday was a bit all over the place. What is your own sense as someone who's seen markets a long time, Pankaj? There will be more volatility. I think that is a given and all of that. But have global markets, to your mind, broken the sort of up and up phase at some level? So some of these growth concerns, etc., are back, especially for the largest, the US economy?
Morning, Prashant. Talking about global markets and the volatility that we've experienced over the day and a half yesterday and this morning, I think, Prashant, the fact is that there's a global reset. So far, the expectation was probably the US economy is holding very strongly and probably will have one or at max 2 rate cuts during the course of this year. Now, obviously, we've seen some weaker data points coming out of US and the narrative has clearly changed where the underlying assumption is now we're expecting at least 100 basis points rate cuts in US before the end of this year. And probably yesterday there were chatter about an out-of-turn Fed meeting, which just happens in very exceptional cases. Obviously, money making has been very easy globally across financial markets in the last year or so, and the trade was very crowded, meaning the yen carry trade in terms of borrowing in yen, and meaning the simplest way to play a carry trade is you borrow in the currency with zero or least borrowing cost, which yen has been, and invest in the markets which give you the highest yield, which was people were borrowing in yen and investing into Mexico where you can have 11% yield. And when money making becomes so easy, you have so much of this crowded trade playing out and everyone is dancing close to the gate where everyone wants to just get out at the first sign of turbulence. And when you try to do that, that is what happens. What happened yesterday, you get a stampede. So I think probably we are here for some volatility. It will take some time to settle down, though I'm still of the view that I think recession in US is off the table. I still think that the underlying economy continues to be fairly resilient. But I think this is a pullback and probably a reset in a global macro. India relatively remains fairly stable in that sense, given our strong macroeconomic fundamentals, and we remain largely immune to the volatility globally. But there'll be rub-off effect in equities that we've seen yesterday. So I still think that globally, at least US is concerned, the bull market in US remains intact, and this is nothing but a correction in a bull market, but it couldn't sustain for some time, I would think.
Okay, this is a correction in a bull market, but it won't sustain for too long. Got it? So how do you approach the Indian markets now, Pankaj? Because if global markets continue to be in turmoil, then a lot of global facing sectors, whether it's autos, whether it's tech, whether it's steel, could maybe see some impact, right? I'm just trying to understand what's the best way to approach this market sectorally now.
Not really. My view is that talking about India, we've had a ferocious rally in the last 15 months in Indian equity markets. India has always been and continues to remain the most expensive equity market in the world. I believe once we are through this correction over the next 3-4 weeks, I believe there'll be a change in leadership in Indian equity markets. If you see through the last 15 months, the leadership has been through PSUs, engineering, capital goods or industrials, defense and railways. In most of these cases, I think, especially in case of defense, railways and industrials, while the underlying growth is strong, now stock prices are discounting or pricing in earnings 3 years out. So valuations are extremely rich in that sense. On the contrary, some of the sectors which have underperformed, which is essentially IT and technology, financials to a great extent, and consumers, I think there probably it looks like the worst is behind. As far as IT is concerned, I remain very sanguine, and I'm seeing initial signs of revival in tech spend by the top 2,000 companies or the Fortune 2000 companies, as we talk about. So I think we'll start seeing a recovery in IT going into the second half of this year, and probably much more stronger recovery in the next year. So we remain constructive on IT, and to that extent, I think once we have a rate cuts in US, probably starting September, I think India will also have it. We should expect a rate cuts in India, if not in this calendar year, probably early into the next year, which will certainly ease some of the liquidity concerns that most of the financials have been facing on the liability side of the balance sheet. So probably I think the underperformance of financials is also done. We've been underweight financials for now almost 2 years, but I think we are close to the end of that underperformance in that sense.
Hi, Pankaj. Good morning and good to see you, Ben. Pankaj, I wanted to ask you about, this entire liquidity. We have been talking about mutual funds itself are sitting in more than 1 lakh crore of liquidity, which can support the market as well. My question to you is, but part of that would be a requirement that they normally do, right? Maybe 40,000, 30, 40,000 of it. So actually the liquidity in the market is a little bit less. What's your comment? And how much can it cushion this global weakness that we're seeing?
Well, I think in the short term, liquidity can help, but eventually markets will find their own levels in that sense, Nigel. And I think given the ferocious move that we've had in Indian equity markets over the last 18 months, and we haven't had any correction in this leg of this bull market in the last 18 months, which is very unlike a typical bull market where you get a correction once in every 12 months or so. And whatever dips we got was just for a day or so during what we got during the election day or during the budget day. So probably I think we're in the middle of a proper correction in a bull market this time around. Corrections in the bull market generally tend to last anywhere between 3 to 8 weeks, and at the index level you can have a pullback of 10-12%, which is a normal bull market correction tends to be. So I still think while there's cash with mutual funds, but they will probably invest more wisely and there'll be buyers on dips. Having said that, I still think this correction will play out, will run its course over the next 3 to 6 weeks.
No, got it. Correction could go on for another 6 odd weeks or so. Another news flash there. Government calls an all-party meeting at 10 o'clock to discuss the ongoing situation in Bangladesh that is coming in from Delhi with the political turmoil in the neighboring country. Pankaj, I know in terms of your ideas, you really liked SBI. And you think SBI is the one name, large cap name, which perhaps continues to look very good. I think the other one, correct me if I'm wrong, was a name that you liked very much was Birla Soft. Talk to us about prospects for both. and any other new ideas you may have.
Yeah, well, we continue to own both of them, Prashant. So I still think SBI as a franchise is still underappreciated by equity markets. I think the franchise is far more solid and far more valuable than what markets are pricing in. Clearly, we've seen in an environment over the last 2 years where there is, constraints of deposits and constraints on liquidity for most of the banks. SBI still has a very robust liability franchise or deposit franchise, which is very important for a long-term growth and sustainability of any bank or a lending institution, because lending is about a leverage business. Your ability to mobilize deposits is equally important. And I think SBI has one of the finest. We've seen the largest private sector bank, HDFC Bank, struggling with their deposit side of their balance sheet. So clearly shows that SBI is one of the most robust liability side of the balance sheet in that sense. And obviously, now with the changes they made during COVID and pre-COVID, when they went through their NPA cycle, it has a very robust lending side of the balance sheet as well. And as a bank which does 18% plus ROEs, I still think valuations are, meaning there's significant room for valuation improvement on SBI, and probably the market is underpricing the potential of the franchise in that sense. Likewise, we continue to remain positive on IT services. I continue to remain positive on IT services. My sense from talking to companies in India, and as well as listening to commentaries of global companies, there is a significant amount of pent-up IT spend which has been held back in the last 18 months or 2 years because of the rising rates in US. Now that the rate cycle in US is turning, I think all of those spends will be unleashed, or companies will start doing discretionary spend. And I think the entire, so in that context, we remain positive on the entire IT services. Amongst large caps, we have ownership across Infosys, TCS, and Tech Mahindra. We own a few mid caps and small caps as well. Birlasoft is one name which we like in the small caps. We think the companies, Birlasoft is concerned, they've gone a complete organizational reorg with the new CEO taking over about a year and a half back, and probably have a much more focused approach on business. Probably a company which is, so one of the bigger play in IT services for smaller companies, we have a handful of companies in India which are about $500 million or thereabouts of revenue. Can these companies transition to crossing the $1 billion revenue mark over the next 3 to 5 years? And we clearly see Birlasoft is one of those companies which can certainly do that in that sense. And if any company which can make that transition, crossing the $1 billion revenue threshold, probably I think there is significant value creation that's there on the table for shareholders.
Okay. One final question to you. You know, we have a lot of these new age tech companies that have now started to do very well. Zomato is a clear case in point. And this whole consumption space is picking up as well. Do you think that this is just, a cyclical story, or is it some sort of structural upcycle that we're seeing in some of these names?
I'm a perma bull on all tech companies. I think the adoption or consumption of technology by all of us as consumers is only increasing, and it will continue to increase. I think we are at a very early stage of technology adoption in India. Just think about it. If you think about the 7 of the top 10 companies in US are technology companies, and these companies are just about 25 years old. They did not exist 25 years back. I think some of the leading companies of India, amongst the top 20 companies in India, will emerge from technology sector over the next 15, 20 years. So, Sonia, I am a perma bull on tech as a sector.
Pankaj, just in jest, perma, anything is, I mean, you've seen markets 30 years plus, and you're calling yourself, I'm surprised, perma bull on IT, but...
Yeah, on technology, certainly yes, Prashant, because certainly the trends I see, or what I've seen having played out in US over the last 30, 40 years in the US and the world, certainly think it's going to rule the world. Some of the leading companies of India, 20 years out, just think about it. HDFC Bank was a startup in 97 when I started my career. Today it's the largest private sector bank of India, and probably among the market cap companies in India. All I'm saying is that some of the leading companies of India over the next 20 years will emerge from technology as a sector.
Okay, well, it's always good to hear that, especially in volatile times. It's always good to meet perma bulls, right? Thanks a lot, Pankaj, for joining in. Have a great day. Let's focus on some primary market action now. Well, First Cry's 4,200 crore IPO opens today for subscription. The issue comprises of an offer for sale of up to 54.3 million equity shares or 2,500 crores. To discuss this in detail on the IPO offering and the growth outlook, we have Supam Maheshwari, the MD and CEO of Brainbees Solution, that is a parent company of First Cry, that joins in here in the studio. Supam, thanks a lot for joining in. And, at the onset, I must say that being a mother, I think First Cry was an app that I have used endlessly. There was a point in time when I was only using, First Cry for my baby. But congratulations on, your sort of move towards Dalal Street and the impending listing. But just wanted to start by asking you about the industry itself, right? What proportion of the industry is unorganized currently? How much do you expect the shift will be to the organized sector?
Sure. First of all, thanks for having me here, and good to see that you were our customer as well. And you trusted us. So to answer your question, Sonia, I think, look, the overall industry is very, very big, which is around close to $34 billion as of today. It's going to become $66 billion by close to FY29. Wow. And within that, only 16% of the market today is organized. The rest 84% of the market is unorganized. The overall industry is growing at a 13-14% CAGR, where the organized industry, which is 16%, is growing at a 20% CAGR. So this is like a very, very sort of a massive time. As far as I'm talking about India childcare, for Brainbees overall, I think we are, our overall TAM, total addressable market, will be around $120 billion. So that's even bigger because we operate in 4 segments. If you put together all of the total addressable market, it's around $120 billion by FY29.
So, as a consumer, right, I've realized that, of course, there are apps and platforms like First Cry, which is concentrated on childcare. And then there are a whole other set of apps as well, where you get everything, including childcare. So how do you differentiate? Sure. How do you combat this kind of competition?
So, look, no, it's a great question. So fundamentally, you have to look at, we are a specialist and a vertical retail player, which we have built over the last 13 to 14 years, a certain set of competency to only focus on young mothers and fathers as our DNA and all the solutions that we have built. So let's say, for example, I'll enumerate a few of them. The first of all is that we are a true multi-channel business model, which essentially means although our large part of our GMV, 75% of it comes from our online in India multi-channel retail, and 24-25% comes from our 1,063 shops that we have across 533 cities in the country. So in this particular category, mothers prefer to buy both online and offline. And that gives us a very unique power that we have a one trusted retail platform which has both significant online and significant offline presence across 1,063. That's number one. Number two, we run the largest parenting channel on YouTube, and we have a parenting community within our app. And this app allows a mother, when she conceives a baby, she goes through pregnancy, post-pregnancy, all the time till the time the kids become a certain age. She's very anxious. She's very inquisitive during that phase of that physiological change that goes on with her. She wants validation of oral queries and answers, and we have provided all of that through help of gynecologists, pediatricians, other fellow moms who have been through the journey, who are answering those questions like a Quora platform on. This is all happening within our app, and provide things like ovulation tracker to growth tracker, vaccination tracker, baby names, parenting GPT, all kind of stuff is embedded within the community. And this community resides.
We had all this back
it was not
5, 6 years, 7 years ago.
That's correct. So all of it is now live, kicking, running into the app, and this is within part of the shopping app. So some of these things are not going to be provided by anybody because we are true to that moment in the parenting journey. So this is like the second, and we have built a whole lot of curation, personalization. Like on our app, you will see a mother of a 4-month-old or a 4-year-old or an 8-year-old will see a very different homepage.
Okay.
That is very unique, very different than what you will see in a different typical app or any other marketplace.
All right, Shubham, talking about parents of 4 and 5, well, I have a 3-year-old and a 5-year-old, so I think you know that I would be a customer. I've seen the bills around the house. But let's focus a little bit on business because, a lot of our viewers would want to understand. I'm looking at your GMV. If I look at the mix, most of it is offline, right? Is online right now.
Yes.
But you're looking at, even upping the offline segment because you're adding stores. Tell us, what is the strategy out there? My understanding would be when you set up stores, it requires a lot of more working capital and things would be very, very different. So what is the strategy with regard to this mix of GMV, online versus offline?
Sure. So look, when we started our business back then in 2010, we always had believed that we will also solve all the solutions that we are building, we will solve for offline as well. Because India, back then in 2010, we believed 10 years, 15 years later, it will be still an offline market. And we are here after 14 years, it's still an offline market. E-commerce penetration is still in single digits.
Correct.
Having said this, we have built 1,063 stores. And in that, if you look at it, we are putting 350 more stores and the use of proceeds in the next 2 years.
Yes.
Our online will continue to grow of a very simple reason, because of the variety and because of the convenience that it offers and the curation and personalization that it offers.
Okay.
And more importantly, the millennial mothers that are out there are far more digitally savvy than what we had 3 years back, 5 years back, 10 years back. And that will continue to compound, because India is one of the most digital savviest country in the world. And therefore, millennial mothers will come to us first online, and they will also transact offline in the vicinity of their home.
Yeah.
That's what will continue to happen, and therefore, being the largest organized player in the market within a large TAM, and although we are still very small as a company, only 6,480 crores, but we will still continue to have a headroom without really not too much of both offline and online will continue to grow.
Got it, Supam. I think you did a detailed interview with Rima earlier, and I'd encourage our viewers who are thinking of applying into the IPO to sort of go watch that entire interview. But because for the paucity of time, I want to get a few things out of the way. Your EBITDA margins are at about 4% only. What is the roadmap? I mean, are we looking at steady expansion?
Sure, absolutely. Look, how it will actually happen, if you look at our past track record, we have 4 business segments. We are talking about 4.2% FY24 adjusted EBITDA. That's at the consolidated level. In this, there are 2 new businesses which are less than 3-year-old. And these are typically all...
so 4 goes to what? I'm sorry, I'm pressing you.
Yeah,
but
just take a minute. If you look at our India multi-channel alone, we were at 5.9% for FY22, 6.2 in FY23, and in FY24 we already become 8.8. So our core business, which is the largest piece of our business, has been in the making for 13 to 14 years, is already delivered 8.8% adjusted EBITDA. So this will continue to expand as what we have demonstrated in the past, because of all the things and all the strengths and moats that we have built.
Do you have visibility to get to double digits?
Look, others have done it. We should be able to do it. There's no doubt and question in our mind.
And when do you take profitable? When do you become profitable at a net level?
It's as we, as all our 4 business segments continue to deliver better results over a period of time, because they are relatively new. Some of them are relatively new. All of this will translate into a sort of a pattern of PBT performance.
Absolutely. Thanks very much, Supam. Apologies for pressing you paucity of time. Thank you very much, and good luck with the IPO. And once again, to all our viewers who are thinking of wanting to know more about the company, I encourage you to go online to the website, the CNBC website, and watch that detailed interview with Supam and the First Crime Management. Well, let's focus on the real estate sector now, and this is a big story which we are reporting on. Will the Finance Ministry review the new LTC, the long-term capital gains tax regime for the real estate sector? My colleague Shirin is joining in with exclusive details on the thinking with the government right now. Shirin, over to you.
Well, thanks very much, guys. Just for context, as we know that post the budget announcement, this is the one decision that has got the maximum amount of blowback and criticism from the general public. The likes of Mohandas Pai, etc., have, of course, been suggesting that the government consider some relief, specifically as far as the removal of indexation benefits for real estate are concerned. As my colleague Timothy had also reported about a week or so ago, there were 3 options that were being considered by the government. What we are given to understand at this point in time is that the government prefers grandfathering till 2024, which is one of the options on the table, because then there is no retrospective in terms of the government's action on LPCG and the removal of indexation. So that is a preferred option, but no final decision has been taken yet. The other option is just like you have with the tax regime. There is the old tax regime which continues, and there is a new tax regime which also continues, and it is up to people to decide which one they want to opt for. In fact, as the Revenue Secretary told us, that they have seen cases where pretty much at the last moment people switch depending on where they feel that they are getting more benefits. That was an option on the table, and that is also being considered. But again, no final decision has been taken. And I just want to take viewers back to the conversation that I had with the Finance Minister as well as the Finance Secretary on specifically this issue on whether the government would consider any review, rollback or relief. And the Finance Minister had basically said she would only respond in Parliament, and the Finance Secretary had said that it was a political call. So remember, the Finance Minister is expected to reply to the Finance Bill tomorrow. The possibility was that she would speak today, but I'm given to understand that she's likely to speak tomorrow now. And if any relief at all is likely, it will only be with respect to real estate. So final decision in the process of being taken. But again, I want to caveat this by saying that a decision has not been taken yet, and we will know more once the Finance Minister responds in Parliament in reply to the Finance Bill, which is expected now tomorrow.
Okay, Shireen, thanks a lot for that. Very, very important story there. And if any relief comes through, then it will be a big positive for, you're already seeing a lot of these real estate stocks rally at the moment in hope of some relief coming through. But this is just source-based at the moment. Thanks a lot, Shireen, for that. In the latest turn of events from the subcontinent, though, Bangladesh has been pushed to the brink after Prime Minister Sheikh Hasina resigned and fled the country amidst severe student protests and a brutal crackdown. The President of Bangladesh has dissolved the parliament, and the army has announced an interim takeover of the government. Ajay Thakur, research analyst FMCG at Anand Rathi Institutional Equities, joins us now to discuss how the protests could affect Indian companies. Of course, there is a larger angle to this, but if we just drill it down to individual stocks and companies, Ajay, in your ambit or in your universe of stocks that you research, which are the ones that would be affected?
So Marico is one which has roughly about 11-12% kind of a revenue contribution coming from Bangladesh. So Bangladesh contributes roughly about 45 to 50% of the revenues to Marico's revenue. And that is one of the biggest in our space. After that, we have Imami, which has roughly about 4-5% revenue coming from the Bangladesh unit. We also have Bajaj Consumer, roughly about 6 to 7% revenue contribution from the Bangladesh market. There are others like Dabur, the Britannia, Godrej Consumer, but they have a very small contribution, maybe around 1 or 2% kind of coming from the Bangladesh market. In the paint segment also, we have Kansai Nerolac, which has roughly about 2-2.5% revenue coming from the Bangladesh market.
Okay, all right. I wanted your view on Marico, since you said it has a decent enough exposure to revenues. What's the view on the stock right now? It's still lower with a cut-off closure on 3% odd.
So the company in the call also, they indicated that this kind of black swan event do happen. However, companies are looking at a longer term perspective. They are looking at diversifying, de-risking, and reducing their concentration on specific markets. So it's a more of a longer term kind of a play. But yeah, in the immediate kind of the near term, we believe there could be some implication, maybe a 1 or 2% kind of a knock on the sales can be expected from the Bangladesh market for the year as a whole for Marico.
Okay, that's on Marico. Can any other companies where you see any kind of impact, anything that we miss? I think Britannia, Nestle, Dabur, all of them get less than 2% revenues from Bangladesh, right? So doesn't seem to be a very big impact there. But anything else you'd want to leave us with?
No, I think these are the companies. Having said that, I believe it's a very small, and generally we do have seen, in the past also this kind of incidences. For the FMCG companies, the business do get, certain bit of implications, but the sales kind of recover. So it wouldn't have a material impact. Apart from Marico, I doubt there could be, material impact on the sales or revenues of many of these companies.
Okay, we will thank you on that note. We'll take a short commercial break. When we come back from the break, Mahinder Chhabra and Anurag Gehlot of Motherson Sumi Wiring will join in for their Q1 earnings. Stay tuned. So let's focus on Motherson Wiring now. It was a good set of numbers actually, a strong revenue growth, but the margins have contracted because of two reasons. One is higher raw material costs and the second is higher startup costs that they had to incur because of two new plants that are coming on stream, the greenfield plants. Their EV revenues have surged 50% year on year, and overall very good set of numbers. We have two gentlemen joining in, Mahinder Chhabra, who's the CFO, and we have Anurag Gehlot, who's the COO of the company. Gentlemen, morning to both of you. Mahinder, I want to start with you because the growth on the top line has been pretty good, 15%. Can you just take us through what are the demand trends now like, both in the domestic as well as in the export market overall? And particularly for domestic, what kind of reasonable growth can you see for the full year?
Yeah, sure. So thanks for getting us basic. So first of all, I think yes, there has been good revenue growth as you have highlighted. And it is mainly resulted by two factors. One is the industry growth. So if you look at the industry, the PV industry has grown by 6% in this quarter compared to previous year, the same quarter. And the second most important thing is the content. So if you look at people today, the customer, the final consumer is preferring high-end features in the cars. So which means more and more content. So if there are more features in the car, that means more content in terms of buying harness, and which is a good sign for us, which gives us pretty good revenue growth in terms of revenue growth.
Okay, so you said industry growth has been 6%, but the content per vehicle is rising. So by the end of FY25, what kind of top line growth are you looking at, Mahinder? And also this content per vehicle, right? How much can it rise to by the end of the year?
Yeah, so as far as year is concerned, I think we are positive about the industry, about the outlook. And if you look at most of the OEMs, they have already announced their expansion plans. Be it Maruti, Tata, or Mahindra, they have announced their expansion plans. So we are optimistic about the industry growth. And as far as content growth is concerned, we see this trend to continue. Consumer would keep on preferring the high-end features as far as PVs are concerned. So we see these trends to continue in terms of both the industry growth as well as the trend growth, the content.
Okay. Anurag, come in on this because, you know, the margins were impacted a little bit. There were, of course, startup costs because of your new greenfield plants, and also raw material costs have gone up. But now that copper prices are settling a bit, going forward, what kind of average margins can you do in the next couple of quarters?
Okay. First of all, thanks for inviting us on CNBC. Just would like to say, you know, EBITDA is, or margins are not something we keep a focus on. Our main focus remains on the ROCE. And I think if you've seen the last year results, they were 48%. Prior to that, it was 44%. This year also, we are also on the track, backed by the customer plans. Now, coming on to the new plants, obviously these two new plants are ramping up phase. One plant is in Q2 and Q3, and one is going to happen in Q4 and Q1 of FY26. So these cost, because you have to train the manpower, you have to hire them in advance, you have to skill them to start making or giving the output what you need in when the ramping up is happening. So these are the cost, and which is very much visible in the P&L account also. And as we move forward, I think as Mahinder has also said that everybody is having increasing their capacities and investing into that. So we are seeing a good volume growth in the coming time. And I think, as I suggested, that our main focus remains on ROCE, and we are already in track on that.
No, I get that the focus on expanding the ROCE, but you are seeing some startup costs, right? Higher startup costs which are impacting your earnings. So I just want to know, going forward, can you give us a ballpark number? How much incremental startup costs are you looking at, and how much could that impact your EBITDA in the very near term?
See, if you have seen the Q1 results also, you will find the manpower cost is the one cost where you will find around 1.5% something was a high on the in terms of hiring these manpower. So these are the percentages, but it all depends on how much large business or how much large unit is going to ramp up, because both of these units are having a multi customers and a multi model are going to be launched at a different point in time. So giving a number as a straight away on something is a very difficult, because it's a spread of people hiring and getting them trained.
Okay, the EV industry growth has picked up a lot, and even for your own business, right? EV revenues have gone up quite a bit. Mr. Chabra, I wanted your thoughts here. As a percentage of revenues, it's still a very small piece, about 5% for you now. But over the next, say, 2, 3, 4 quarters, how much can EVs pick up, and would that add to your content per vehicle further?
Yes. So first of all, yes, EV content is more in terms of wiring harness. The content in EV is more compared to ICE vehicles. As far as future is concerned, it largely depends on the market, largely depends on the customers. Because since we are supplied to the OEM, so if there is a more demand for the EVs, for sure our revenues should also increase in the same proportion or even better.
Okay, got that. Finally, then one word on you said the industry growth has come in at 6%, right? Would it stick to single-digit growth this year, Mahindra? Or is there a possibility of getting to double-digit growth for the industry in FY25?
So maybe I can request Anurag to take up that question.
Anurag, you want to take that?
Yes, surely. If you see that all the major OEMs in the country has already given increasing their capacities. You talk about Maruti going from 2.3 million to around 4 million, and all these other customers like Mahindra and Mahindra, or you talk about Tata. Everybody is given their details in last quarter and prior to that. So if you see the last year also, it has grown into single-digit percentage higher side. Q1 also says about the same. So we think that the trend remains the same, or even looks positive to us. As far as MSWIL is concerned, obviously we are growing by double digit, because obviously there's a content involved into that, and that one is the volume growth is there. So I think market looks to be very positive to us, and we see a good time coming forward.
Okay, good times coming forward, and the market is very positive. I would have asked about the balance sheet, but there is big improvement in the balance sheet. You're debt-free as well, so there's no point talking about that. All the best, with the way forward. Just wanted one word from your end, Anurag, on the capex, right? Given that you have some legroom now, you have a cleaner balance sheet, would you be at any point in time taking on some debt, any incremental capex that you're looking to put on board over and above these two plants, these two greenfield plants that are coming on board?
See, for this financial year, we have a capex of approximately 200 crores. And I think this is including of two things, the new upcoming plants as well as the maintenance of the plants which are existing. We have total 28 plants, including these two new plants. And you will hear that a few more plants are also in the pipeline, which you will hear from us in the coming time.
Okay, all right. We leave it there, gentlemen. Thank you both for joining us with that perspective. appreciate it here on CNBC TV 18. So that's Motherson Wiring with some outlook coming through for their business going forward. Well, Mitesh is back with us with what he'd want you to do as far as individual trades are concerned, and of course the view on the index as well. We were up 300 points plus. We're about 285 points in the green. Lots happening. Market breadth is overwhelmingly positive. 2,000 stocks higher and about 400 stocks are down. So 5:1 advances to decline ratio. Mitesh, your thoughts on what you're seeing on the screen and your recommendations?
Morning, Prashant. So I think, today with the gap up opening and some kind of reversal, I think we might give a pullback to about 24,470, 480 on the Nifty, around those levels, give and take a few points. So I think we might have another 100 odd points on the upside. But I think if we don't show strength beyond 24,500, then I think in the next couple of days, we should again see some strong pressure coming in at higher levels and sell off. But that's the overall view on the index. But in the short term, I have a buy on Asian Paints. It's something which I've recommended repeatedly in the last few days. Now still showing strength today. Buy here with the stop at 3,100 or maybe just below it, and look for a target of around 3,200, 3,220 on the upside, and a sell on Steel Authority, which I would recommend selling with a stop at about 143 half, 143.75 for targets of around 133.
Okay, thanks a lot, Mitesh, for that. Well, let's track V-Mart Retail and find out why you should be watching that stock. Mangalam is here with the latest. Mangalam, over to you.
Good numbers coming in finally for V-Mart Retail. It's been many quarters of weakness. Weak sentiment is what everyone's talking about. At the same time, there were a lot of one-offs, etc. But despite that, of a low base, there has been strong recovery. The company's revenues in the quarter have grown 16%, and that's reflected in the EBITDA performance as well. A jump of almost 89% on the EBITDA, near 500 basis points improvement in the margins. And as a result of which, what was a loss of 22 crores at the same time last quarter has turned into a profit of close to around 12 crores as well. Internals are very strong. Same-store sales growth up 11%. Same-store volumes up 11%. Footfalls higher by 36%. And this, remember, despite there being extreme heat wave and there being disruptions around elections, etc. as well, sales per square feet have also increased by about 13%. And what's working for them, Unlimited, which was earlier a drag for them, is now showing improvement, signs of improvement. And also the digital market business, LimeRoad, which is now curtailing its losses, down 60% year on year and down 15% quarter on quarter. The company has guided for this to turn profitable at some point towards the end of this year itself. Now the key to track for them would be whether this recovery sustains post-monsoon as well and pick up in sales ahead of festive season. If all those were to happen, then we obviously see a lot better performance for V-Mart coming in over the next couple of quarters.
Okay, all right. Thank you very much, Mangalam, for that. So that is a look at what's happening there with V-Mart. We'll take a quick commercial break here. We put the focus on the commodity space. Manisha Gupta is going to be with us on the other side. Stay tuned. That's coming up.
Invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC TV 18, embarking on a quarter century of excellence.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself as India's longest running show on startups and entrepreneurship. Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV 18 and cnbctv18.com. CNBC TV 18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day.
Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC TV 18 weeknights at 7 p.m.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV 18. Now streaming live 24/7 on YouTube.
Even
Well, shifting focus to the commodity markets, Manisha Gupta is joining in. Manisha, what's the one commodity that you're tracking today?
Well, Sonia, I'm looking at metals as a sector. Most of the asset classes have seen a bit of a rebound, even gains today. But I can't say the same about metals as a place because we still suffer from poor demand for this sector. The inventories have been constantly rising in Shanghai, in Europe and US as well. And then it has been a barrage of weak economic data from US, Europe and majorly from China. For China, essentially, markets have been waiting for some big bang stimulus measures or some announcements, and we haven't heard any of those. There has been a bit here and there and in small quantum as well, and that really hasn't helped the markets. Apart from that, there also are recession concerns coming in for US. We have seen very weak data there, and the sell-off in other asset classes also seems to have broken the momentum when it comes to metals there. Dollar index is trading at a 5-month lows. We've seen that break below 103, so that could give some support at some point in the day today. And then apart from that, it also is about the US rate cut expectations. Those are a couple of factors that the metals, of course, will look at, as will other asset classes. But when you talk about the copper prices, we've seen constant decline onto this one. We did see an all-time high of $11,100 in the month of May. But from those kind of levels, the copper prices have declined almost at around 20%. If you look at copper inventories, they have gained up by nearly 140% in the last 3 months itself, at around 3-year highs onto that one. And if you look at the demand, well, it's trading at a discount in the Asian markets there. So constant pressure continuing in case of copper prices. Aluminum is no better. We are trading at a 5-month lows onto this one as well. If you look at the China aluminum June output, it gained up by 6% on a year-on-year basis. And we're looking at output in China at November 2014 highs. So that tells you that the inventories are building up, but the demand is not really coming here. Same is the case with lead and zinc, also trading at 4-month lows onto that one. Nickel prices are trading at a 5-month lows as well. And you have silver now trading at 3-month lows. So across metals as a sector, we are trading at a multi-month lows. And from the highs of 2024, we have seen the prices come off quite strongly. If you go by the textbook, then many of these metals actually are trading in a bear territory. You have 20% off in case of aluminum from its 2024 highs, 20% off in case of copper as well. Zinc has declined by 25% from the current year highs, and silver is down by 16% as well. It was just last month that we saw silver prices trade at all-time highs in the Indian markets. From those kind of levels, we are down 15% as well. So pressure, especially within this space, just about continues.
Okay, thanks a lot for that. Well, let's do one thing. Let's take a quick break. On the other side, our special segment is the economy. Lata will get chatting with Mitul Kotecha of Barclays and Jahangir Aziz of JP Morgan to put focus on the huge global market meltdown. Stay tuned.
On payrolls, labor market data in the U.S. was a bit disappointing. We're really not seeing other economic indicators at all pointing to a recession. And also keep in mind that the labor market is a lagging, not a leading indicator. So we really want to be looking more, say, at PMIs to get a sense of how well the U.S. economy at least is doing.
plethora of events shape up over the last few days, and it's obviously difficult to make sense of everything and put the pieces together. There will be, there are different factors which have been affecting different regions, whether you take Japan or US or maybe even emerging markets for that matter. I think as far as the US is concerned, what we read and what we probably still share as a view, and probably is a continuation of what we, in a way, expecting that, we will probably try and see some correction as far as the inflation dynamics out there are concerned, and some bit of slowing of growth as well. But in the meanwhile, I think what is happening is quite unexpected lines in a way. I would say that because there was this expectation that in the second half of the year, we will probably try and finally see some possibility of rate cuts emerging.
India, I think it would be less a growth scare. People have been talking about valuations for Indian equities for a very long time. Nonetheless, the market kept going up, and if anything, recently compared to many other global markets, it still performed relatively well. But I think now that question is going to become much more pertinent to investors when they see a much less supportive global environment for risk. Markets with high valuations are going to be one of the first things that they look at.
Big miss on the US jobs data has triggered recession fears. It's actually the first time labor market data, monthly jobs data in the US has been such a big miss in this particular cycle. And remember, till last week, expectations were that it's going to be, a very moderate, soft landing, which will allow the Fed to cut rates. And it's all very well orchestrated. But this could mean that, it's not all under control. And the Fed perhaps is even behind the curve with what they want to do as far as interest rates are concerned. As a result of which, US money markets are now pricing in a 50 basis point rate cut in September and a total of 125 basis points rate cut through the course of 2024. So the benchmark Nikkei is down over 20% in the last 3 days now. And you look at the USD JPY, that has fallen 20 yen to $1 in the last 1 month. So basically,
Welcome back. Let's revisit the huge market meltdown of the last few days and check out what is the danger to the US and the global economy, not just markets. Now, the markets tanked because the US created only 114,000 jobs in July versus market expectation of 175,000, and because of the so-called unwinding of the yen carry trade. But what hit the market badly was a supposed rule called SAM rule, SAHM, which argues that if the 3-month average of US unemployment is 50 basis points more than the previous 12-month low, then the economy is in for a recession. To understand more about both US recession and the yen carry trade, I have with me Jahangir Aziz of JP Morgan from New York and Mithul Kotecha of Barclays joining from Singapore. Gentlemen, thank you very much for your time. And Mithul, with your permission, I'm asking Jahangir first. He's staying up for us. Jahangir, now how much should we worry about a concept like the SAM rule? Because the 3-month moving average is 4.15 and the low of the last 12 months is 3.6. So clearly 50 basis point over the last, 12-month low. So is there a likelihood of recession according to JP Morgan?
So we're not. So I think the SAM's rule is useful, but it's a backward-looking rule. It doesn't really tell you what is going to happen in the future. It tells you that if in the case this happens, then chances are there will be a recession. As we have talked about, innumerable times with you, Lata, this time around, the dynamics of the business cycle are very, very different. And that is the reason, if you go back, let's say, to December of 2022, we had an equal sharp drop in non-farm payroll, and everybody screamed and shouted, well, 23 is going to be a recession. 23 turned out to be one of the best years for the US economy. So we are not calling for a recession. Having said that, I think what this shows to us is that it is making it much more stark, the asymmetry in Fed reaction. So the way in which we had been talking about the Fed is that, look, as long as inflation is coming down and the Fed is feeling confident that inflation is going to meet its 2%, 2.5% target, then the Fed should start cutting rates because the Fed has kept rates at a very restrictive level. The issue is that if that's the only thing that's happening, then the rate cutting cycle would be shallow, calibrated, and extended till the end of 2026, which is basically what's in the SEPs, the dot plots. I think the asymmetry is that if this was also accompanied by a weakness in the labor market, then that would bring forward the Fed rate cutting cycle. I think what the non-farm payroll on Friday showed that the gapping down of the non-farm payroll, I think that wasn't the big driver because, a large portion of that was probably a reflection of Hurricane Beryl's impact in the Midwest and in Texas, right? So chances are that it's going to recover probably next month. It was what was inside the payroll report. So for the first time, we saw that wage growth was much slower than the past, and more importantly, that the layoffs were turning to happen.
Yes.
And so it's a combination of the details, not so much as the gapping down, but the details that brought about the change that now we have downside risk on inflation. Remember, wage growth is much slower, and we have downside risk on labor market. So both the boxes that the Fed is worried about, both their mandates have downside risk, and that's the reason we have brought forward our rate easing cycle. We have brought it forward quite aggressively.
Okay.
So previously we had a 25% start in September, another 25% this year, and then every quarter we want to rate cuts. Now we have 50 in September, 50 in November, and then every meeting, not every quarter, every meeting we have 25, so that by the end of July of 2025, we reach a terminal rate of 3% instead of N26. So it's a huge difference, a huge change that has happened to the Fed call.
Okay, and I agree. And the markets seem to have brought forward that expectation. If you go by the way the dollar and the yields have moved. Mithul, on that note to you, like Jahangir told us about the SAM rule, can you explain to us the yen carry trade and its unwinding? How intense is the unwinding, and can we see more of it?
Well, look, I mean, firstly, I would just say about our view on the US. I mean, look, we've actually got a bit more of a hawkish view. We do expect free cuts this year from the Fed and free cuts next year, but we're looking at a terminal rate that's not as low as the market's pricing in, or as Jahangir just mentioned, the 3%. So we don't think the Fed will need to cut as aggressively. And I think that's been a factor. We talk about the yen carry trade, and look, the Bank of Japan hiked rates. We had expected that, but it happened at a time when we had a confluence of factors affecting markets. And clearly the carry trade unwinding, which has been very, very severe indeed. And we know that Japanese investors had a huge amount of outflows into emerging market carry and higher carry trades globally. And the ability or the amount of repatriation of that has been fairly significant. But it's also led to a broader global carry unwind. And I think the yen has been the key funder, but we've had a number of funding currencies globally, such as the likes of Swiss franc or CNH in Asia, Taiwan dollar. And we've seen a big shift in a lot of these funders. Now, I think how much is there to go? We probably don't see that much more to go in our view. We've seen a very, very aggressive move as it is. Even today in markets, we're starting to see a little bit of a bottoming forming. It could be early days, and you don't want to catch a falling knife. But clearly, this market has been hit by whether it's worries about the U.S. economy, whether it's worried the extent of Fed rate cuts, and that's been a driver of this dollar-yen move as well, with yield differentials between the U.S. and Japan narrowing, whether it's geopolitical concerns and in the Middle East, or whether it's equity valuations, in particular AI and tech. It's so many factors in a time when liquidity is thin, at the time when we would have normally expected to see summer quietness. It's a tight liquidity, difficult environment. So I wouldn't be surprised to see more volatility in the weeks ahead. But I do think we've seen probably the brunt of this move in terms of carry trade unwinding. We've already seen a lot of position shifting, and I think positions are moving closer to neutral. As an example, our dollar position sentiment index is already quite negative. So we've already seen a very, very sharp shift in dollar sentiment, and it's unlikely to see a further shift too much more negative from here.
Okay. That's very useful. In your reckoning, it's probably 75 basis of cuts in 2024, and Jahangir, of course, just told us they are expecting 125. And I think the CME Fed Watch is also indicating that 125, but things might change. Well, before I come to you, Jahangir, Mitul, therefore, at the moment, the dollar index is 102.78. It was, of course, 104.5 on Wednesday or Thursday before all the turmoil began. Are you saying that the dollar index is more or less there and we shouldn't expect too much falls from here on?
Look, you can't rule out more downside in the dollar. But, the reality is that this is not necessarily a dollar move, right? I mean, if you look at most major currencies except the yen, it's not been a dramatic move. This is a pure carry unwind. It's a selling of high-yielding, high-carry currencies. And no better place to look than, say, in Latin America when you look at the likes of Brazilian real, Mexican peso, and in India, the same with the rupee. It's the relatively high carry currency in this region, and at the same time, it's that unwind and it's the low yielders that have been positioned most negatively that have seen the biggest benefit. So I think the dollar's got caught up in this, and of course has been pressured because of the more aggressive rate cut pricing that the market has been pricing in more recently. And so there may be a bit more dollar pressure. But look, if we are right and that the market is already pricing a lot for US rate cuts, it's probably likely that, and also we add in the positioning and sentiment, it is probably likely that the dollar has not got too much further to fall from here. And we may again have seen a large extent or large magnitude of that move already having been taken by the market.
Okay, got that. Do you expect the yen to strengthen all the way back to 160? I mean, weaken all the way back to 160? Because the yen seems to be the root of more trouble than the other carry currencies.
Look, that's fair. Look, I mean, our forecast has been 160 as top in dollar yen, and clearly we're way away from that now. I think it's unlikely we see the sort of rebuild of carry trades that we've seen in past months, especially given that yield differential and especially given that the Bank of Japan has now tightened policy. But at the same time, I think we are approaching better levels for investors to start putting back on these trades using the yen as a funder. If we look at yield differentials, dollar yen is pretty much bang in line with where yield differentials would be expected. So, I think, again, it's the same story. A lot is priced in dollar yen, and probably the risk reward may favor an upward bias in the weeks and the months ahead for dollar yen.
Oh, upward bias. Okay, so we are not going to see more unwind. Just a final question. I know you're in a hurry, Mitul. What is your range for the dollar rupee, and are you expecting anything from the Reserve Bank in terms of cuts?
Yeah, look, firstly, let's say the second question. Reserve Bank, we don't expect the RBI to cut quickly. We have been penciling in a December cut from the RBI, but clearly the volatile food prices have had an impact on inflation, as we saw in the last reading. And so we would expect the risks are skewed perhaps to an even later cut from the RBI, even if the Fed cuts earlier and more aggressively. We know that India is not necessarily on the same path. Indian growth is still far stronger, and inflation is a bit more stickier on food prices. So, look, we think the risks are perhaps for a delay from the RBI, but we'll see at the next meeting and clearly see how or whether the RBI is looking at the Fed in any way and perhaps sounds a bit more dovish. We doubt it. We're looking at liquidity as a factor here. And for dollar rupee, look, the rupee has underperformed. And I think, part of that is the RBI continuing to soak up dollars, building FX reserves. And we would expect some of that underperformance to continue with perhaps that sort of move up to this sort of higher range that we've been in now. But again, I wouldn't expect to see the rupee fall significantly from here. I think we're just probably in a new higher range rather than any sharp moves. And I think volatility is still going to be very well contained by the central bank.
Oh, yes, it's almost not moving certain days. Thank you very much, Mithul, for your for getting time for us in spite of a very busy schedule. And Jahangir, thank you for your patience. Well, I just want to come back to the US for a bit. Is there a higher recession chance, according to you?
No, because intermediate cut is for an emergency, right? So emergencies are typically financial market scares driven by disruptions in the credit market or the breaking down of the interbank market. I mean, nothing has happened to credit spreads. Nothing has happened in the interbank market. Yes, I mean, the equity markets have sold off, but you can't blame recession risks on that. You have to go and look at the bigger culprit, which is the reversal that has happened to the yen carry trade, right? Because of the yen appreciation and the rise in yen rates. That's driving most of this leverage, buying of equities or emerging market carry trades, including in India. I mean, let's not forget what's happened in India. So that's much more to do with what has happened to yen as a funding currency rather than people suddenly realizing, well, a recession is around the corner. I don't think that's the reason as to why you've seen the bloodbath in the US market.
Okay. I want to know, will you bring down emerging market growth? I mean, if you're expecting some kind of slowness in the US, then are you expecting some kind of low growth headwinds for emerging markets and more particularly for India? Will you lower the growth?
So let's not, forget that there is another big variable called China, right? So both the engines of emerging market growth, one hand US, the other hand China, both are slowing down. And the slowdown in US probably in comparison to second half of 2023 is much sharper than, let's say, the slowdown in China, which is there, but it's not as dramatic as the slowdown in the US. So I think the combination of the two of them necessarily will start showing up. And you can see that in the manufacturing PMI numbers of the last 2 months across emerging market, particularly manufacturing exporters and Asia. We have seen manufacturing PMI slow down. You've seen the drop-off in Chinese PMI numbers. So I think that is obviously part of the course that you are going to see this happening. But at the same time, you should also not forget that domestic demand in emerging markets, particularly in Asia, had remained weak, had not recovered from the pandemic. It continues to benefit from a decline in core inflation. Core inflation today in India is probably on a 9-month low. And I think that we should not lose sight of the fact that domestic demand probably is getting boosted up. And so I think that the combination of the two of them will probably slow down growth, including in India. But I do not think that this is something that we should start panicking.
Okay. No, not panicking. It's just that there is an RBI policy upcoming that I was discussing with Mithul as well. Do you expect, I mean, if not a stance change, at least more dovishness from the RBI?
I think that the language will have to be brought down, right? I mean, if the 10-year has gone down from 450s to 3.380s, right? Yes. The RBI cannot say that global financial conditions haven't really quietened down a bit, right? Now, clearly, there's now pressure on the INR, right? It is fine that it is because of the reversal of the yen carry trade, but as far as the RBI is concerned, it is pressure on the INR, including there is this question about food inflation. So my guess is that it will tone down their rhetoric, tone down their hawkishness a bit, but I don't think they will signal a shift in stance. I think they still remain worried about credit growth, including in uncollateralized credit growth that has taken place. So my sense is that they'll tone down their hawkishness a bit. They're not going to say we're changing the stance. I think they will wait for the September cut. And if we are right and the Fed delivers a 50 basis points cut in September, I think in the very next meeting, the RBI has to cut.
Okay, very next would be as early as October. Thank you very much, Jahangir Aziz, for staying up for us and for giving us your idea or the JP Morgan view of recession. Not a recession, according to JP Morgan, but clear slowing down. And they are expecting 2 50 basis cuts, one in September and one in November. In the US, another 25. So that means an RBI rate cut can be expected in 2024 and perhaps even before December. But let's wait and see. Makes the RBI policy much more interesting. On that note, we wrap up on Bazaar. Chartbusters coming.
From 162 to 145 from the beginning of July. That's a massive move for a currency like that in such a short time span. The last time we had this magnitude of a rally, along with interest rate differentials between Japan and the US around 5%, it was back in 1998-99. And of course, we had that sort of LTCM crisis back then. Now, fears of yen carry trade unwinding is essentially reason number two. So, I mean, people borrowing in Japan, very low interest rates, investing around the world. And of course, the yen moving so sharply upsets plans. Stops are hit and there is a forced unwinding which takes place. So that is reason number two. Number three, and this went unnoticed under the radar for the first couple of hours when we began trading, but NVIDIA, the big reason why US stock markets have done so well is reportedly delaying its next AI chip Blackwell by at least 3 months. And it was not a coincidence that the Taiwanese market was amongst the worst performer in Asian markets today. And also take a look at the fact that Nasdaq continues to underperform the S&P. So that is, I think you could blame it on the NVIDIA story there. And number four, I don't think this was a really dominating driver, but geopolitics, right? The political news website Axios reports that, attack by Iran and Hezbollah against Israel could start as early as Monday. I would say that, what was happening with the currency markets and fears of a US recession were the dominating drivers. This, of course, if it were to come through and it's a big one, could hurt at the margin going forward.
Indices rebound sharply from yesterday's losses. The Nifty is above the 24,200 mark. The mid-caps rally with the index up nearly 2%.
Realty stocks surge as the Finance Ministry is likely to review the new LTCG regime for realty. Sources tell CNBC TV that the government prefers grandfathering till July 2024 as relief to counter the removal of indexation. The final decision is yet to be taken, and the FM is likely to reply to the finance bill tomorrow or today.
Well, a bunch of stocks on our radar. Marico is down nearly 4% despite a good set of numbers and good commentary because the political turmoil in Bangladesh has affected sentiment. Remember, 44% of the company's international sales, which is about 25% of their overall sales, comes in from the neighboring country, making its exposure to about 11 to 12% in Bangladesh.
Indian garment makers Gokuldas and Kitex, they surge as the companies become beneficiaries of the disruptions in Bangladesh, as global companies may look towards Bangladesh +1 supply chain.
V-Mart Retail zooms nearly 8% as the company's reported strong internals in the first quarter. The revenues climbed 16%. EBITDA margin improves on the back of 11% same-store sales growth.
Hello and welcome to Chartbusters. I'm Naishal D'Souza. Joining me as always is Mangala Malu. Well, the markets have opened up well in the green. The problem is we're not able to sustain at higher levels. We're still up close to around 160 points on the Nifty. The Nifty Bank, though, that's almost moved into the red, and that's the underperforming index in today's trade. Otherwise, the breadth of the market is good. So good to see some green after the clobbering that we saw in yesterday's trading session. Mangala.
Absolutely, Nigel. You know, when the market opened with a gap up, the first instinct would have actually been to book profits, etc. Now the dip has come by. The question is whether there would be a second rally from the lows or not. And the question to that would be answered by the way the Nifty Bank moves. Like you pointed out, you know, it's almost moved into the red as we speak, and that's led lower by HDFC Bank, which is now below the 50-day moving averages as well. So now below most of the important moving averages for that stock. And the second half, we'll have this one also in focus on account of the financial services expiry. What's also interesting is that the India VIX, which has seen a big cool off from yesterday, has actually moved higher from the lows. It's still down about 10%, no problems. But look at it, from the lows of today, it's up almost 22 odd percent. And this hour itself, from the start of 10, it's up around 5%. So that's something we'll keep an eye out on. In this wobbly market, what should you do? We'll get you a few ideas of profit coming in from our colleagues at Money Control Pro. And today we have Nitin Agarwal joining in with the stock.
So the company that I've chosen for today is SJS Enterprises, which is an auto ancillary company. First, let me touch upon its Q1 number. The company reported a 60.9% YY growth on its net revenue, driven by 104% growth in the passenger vehicle segment and 134% growth in the consumer durable segment. And company continued to maintain its EBITDA margin about 25%, which is a significant feat for any auto ancillary company. Now, moving on to the key driver for the company going forward, the company continues to focus on premium products, catering to the SUVs, premium bike, etc. Now, these are high value, high margin products, and has been able to improve the company's operating profitability due to this. Apart from that, the company has been focusing on export market. Its total share from the export is around 7.5%, which is steady. And with the improvement in the export market, the company sees 6 strong opportunities in those areas as well. Apart from that, in the quarter gone by, the company onboarded Dixon Technologies as its client, which is one of the largest and well-known EMS manufacturers, and management sees a significant opportunity coming from this particular collaboration. In terms of valuation, the company currently trades at around 22.8 times FY26 projected earnings, which we believe is reasonable given the company's growth potential.
All right, that's an idea coming in from our colleagues at Money Control Pro. But let's talk about the earnings radar. Century Plyboards, that's the stock on our radar, reported its first quarter numbers. Of course, there were challenges with labor shortage, heat wave, etc. Higher cost due to commissioning of a couple of their new plants. The stock is holding up mildly in the green because despite all of this, you know, the revenues of the company grew by about 13 odd percent. The EBITDA was down 17%, and because of higher depreciation and finance costs, the net profit was down 61% as well. The company hasn't uploaded its presentation on the exchanges. Yes, the conference call tomorrow at 12 p.m. as well. So to that extent, it makes this conversation with Keshav extremely important. So let's get done with the basics first, Keshav. You know, the overall revenue growth this time around was 13%, and it was a quarter marked by a lot of challenges, etc. as well. So if you could break up, you know, what the volume growth across all your segments were, and what was the realization growth across, you know, plywood, laminates, MDF, and particle board. If you could give us these basic details first.
Good morning. Thank you so much for having me on the show. I think, you know, if you look at it from the point of view of overall quarter, we have done a very good job in a very subdued demand environment. In the plywood segment, we would have close to 15% revenue growth YOY after quite some time. In MDF, despite a substantial dip in realizations, we have a 25% value growth plus more than 40% volume growth. In laminates, we have been flattish, and particle board, we have been flattish. But we are hopeful that in laminates, second half of the year, we'll post a strong growth once the Andhra unit starts scaling up. It is taking a little longer to scale up. The particle board new unit is likely to come on board by the end of this current financial year, and we'll see a strong growth in particle board from that point onwards. So I think overall, we have done a fairly decent job in, like you said, a very challenging quarter.
Could you give us the volume and realization of each of the segments clearly? What was it in the first quarter for plywood, MDF, laminates and particle board?
For plywood, year on year, the realization was slightly up, but it has been mainly driven by volumes. For laminates, both have been more or less flattish. Whereas for MDF, there is a delta because there has been a reduction in margins. As you know, we haven't posted the investor presentation yet, so I can't share too much of the detail at this point in time. But MDF has been driven by a substantial volume growth that has offset a drop in realizations because of competitive pressures. So a 25% value growth would have been on account of a 40% plus volume growth.
Hi Keshav, good morning. Nigel on this side, good to see you. Before we get back to your business, wanted to ask you, there's some unrest in Bangladesh. Any impact on your business or on the industry because of what's going on there?
Good morning. I don't think Bangladesh for us is a very small market. We export some laminates to it, but it is inconsequential in the overall scheme of things. So I don't think there's going to be any substantial impact on account of the disruption in Bangladesh on our business.
Okay, let's get it got that out of the way then. So let's focus on margins. Margins have skimmed down a little bit in the past quarter. And as we know, timber prices have surged in the last 12 months or so. What's the outlook on margins from here on? Because you're sounding optimistic on volume growth, though on realizations, it'll be, I think, a little bit difficult to push through price increases. What's the outlook on margins?
I think if we break this into different segments, in plywood, we have taken a price increase in June itself, and we're planning to take a further price increase in this quarter. In laminates, we have taken a price increase in the current quarter. In MDF, yes, the competitive pressure is there, but I think it has bottomed out. From here, margins should improve because realizations are likely to improve, and our Andhra unit is going to scale up. So as you know, the first quarter in any new unit is challenging. There are a lot of teething issues, but thankfully, those are behind us, and we are seeing Andhra ramping up quite rapidly. In laminates, we have been able to deliver on margins, but we have not been able to deliver on volumes. In H2 of the current year, we are confident that we'll deliver a very strong and robust growth in volumes alongside an increase in margins. So I think overall, we are well positioned. And as you see, our guidance for the year has been the margin guidance. We have pretty much been on track across all segments, whether it is plywood, laminate, MDF, or particle board. If you negate the impact of Andhra, in MDF, we are at 14% EBITDA margins, which is very close to the 15% guidance that we had given.
All right. Just to confirm this guidance, because you haven't uploaded the presentation, the conference call hasn't happened yet. If you could confirm this guidance for us, or is there likely to be a change? Earlier, you had said revenue growth for this year would be upwards of 15%. Plywood over 10% with margins of 12 to 14%, laminate over 20% with margins between 10 to 12%, and MDF over 40% with margins of 15%. Is there any likely change to this guidance, or you hold on to this?
No, we will hold on to this guidance, and we are fairly confident that we'll be achieving the same.
All right. And what about capacity utilization? I mean, you did speak about a lot of capacities coming on board in the last couple of quarters, a few coming on board in this year itself. Where do you see this year at the end in terms of capacity utilization? You had a glide path of almost 80-85% over the next couple of years. That's 26, 27. What we need to know about is 25.
I think, by the exit of this year, by Q4, we'll be at more than 50% capacity utilization in both the new MDF and the new laminate capacities.
All right. And 6,500 crores by FY27 at peak utilization on target, right?
Yes, very much.
Margins at that time?
We'll give you guidance as the year progresses.
All right, we take that point. Always a pleasure speaking with you. The street wanted to know a lot more about the business this time around, but you were limited by not having uploaded your presentation. But we get a sense that there has been some realization impact on MDF, and you hold on to your guidance.
Okay, all right, Keshav, thanks a lot for that. By the way, we need to get our eyes back onto the market. The Nifty Bank, the intraday chart should come up for you after opening up with a gain of around 500 points. It's now down close to around 70 points. So that intraday chart will tell you the picture why the Nifty has come off the high point of the day, because the Nifty Bank has breached that 50,000 mark yet again. I think the next support level is at around 49,500. So we'll have to keep a very, very close eye on that mark. Let's slip into a short break. Come back. We'll focus on the new listing from the pharma space. Don't go anywhere.
Usually in a session like this, when there is a sell-off across the board, you may wonder that a dip would get bought into, as has been the trend, but sadly that was not the case in today's session. And the benchmark indices, both the Sensex and the Nifty, saw their biggest sell-off since the 4th of June, and as a result of which 15 lakh crore worth of investor wealth was eroded after today's sell-off. And the sell-off was across the board, with 46 Nifty stocks ending in the red, with just a select FMCG stocks and some pharma names bucking the trend in today's trading session. And the sell-off, as I mentioned, was across the board. Metals, media, realty, auto, PSU banks, all of these indices saw drops of anywhere between up to 4% or even more, with metals and real estate being the biggest sectoral laggards in today's trading session. The key point also to watch out for today was the India VIX, and at one point of time the VIX was up almost 52%, and that was the biggest single day jump that it had seen since August of 2015, eventually ending 42% higher and above the mark of 20. That might be a cause of concern as well. There were of course global facing stocks that took a bit of a beating.
Had one that took place earlier today. Accoms is the new kid on the block. Well, they've listed with a gain of close to around 6%, and now the stock is up close to around 12%. Well, to understand how the business is shaping up, we have with us Mr. Sandeep Jain, who joins us to help us out with the way forward. Hi, Mr. Jain. First, good morning, and thanks a lot for speaking to us here on CNBC TV 18. Congratulations on a solid listing. Market conditions are a little bit feeble, but your stock is doing quite well. So let's focus on a couple of numbers then. For this year, what kind of a revenue growth are you looking at? And if you could split it up for us, how much will branded generics contribute as a percentage of your mix? And exports as well, I think they're in mid-teens. How much will that contribute as a percentage of your mix? Please go ahead.
See, we have been always achieving around 15% CAGR, and I hope that we are working on the same, and we will be able to maintain the same pace. As far as our branded marketing is concerned, we are around 10%, and this API business is somewhat very, low, around 1.5%. Around 2% we can say, and we are working on the same. And as we are having two European GMP plants which have been GMP approved very recently, European GMP, and we hope that we will be in a position to get good business from those two plants as well. And we are having more than 500 dossiers already approved in 60 countries, more than 60 countries, and we are working on the same to grab more business from these countries as well.
So exports go up by how much? I think they were 17% of the mix, right? Where do you see it headed?
Yes. You're talking about the marketing business that is divided into three segments. Around 78% of the business comes from CDMO only. Over here into CDMO, that is contract development and manufacturing organization. We manufacture for almost all of the big companies of the country, and holding around 10% of the total domestic requirements. And as far as CDMO space is concerned, we are having the total share of 30% of the total CDMO space of the country. And we are 25th largest in the country, in the world, and first largest in the country. And the remaining business is around 20%. Say 17% is marketing, and out of that marketing, 10% is from branded marketing, and around 4% is from exports.
All right, take that point. If you look at the valuations of the company at which you have offered, it's been much lower, but that also coincides with much lower margins as compared to peers. So if I look at, say, someone like a Suven or Divi's margins, they are close to 30, 40 odd percent. You are about 12%. Yes, there was a one-off in FY24, but on a sustainable basis, what is the kind of margin that you can deliver?
We are into research and development. Around 400 scientists are working day and night to develop more and new products. We are having more than 200 different kind of niche formulations which have been introduced to the country for the very first time or second time in the world, like that. And we are working for new molecules which always give better margins to us. As far as our current business is concerned, it is in a very sustainable profit margins, and we don't intend to increase so much of margins into that. But
how much?
Whenever there will be a new product or new market,
No, because as we see, you know, on the screen as well, the information tells you that Suven Pharma does close to around 20%, 42% margins. You have Gland, which is around 25%, Divi's around 31%. Innova Captab is another 15%. So amidst all of that, you are at just about 12%. So you're looking to improve them. To what extent can you improve it? Can it go to 20, 25%?
See, we don't intend to go for those 20% margins. We intend to maintain the same margins. And as far as Divis or Suven is concerned, they are into different kind of products. Divis is mostly into APIs, and we are into formulation, and that's true for the specific domestic Indian market, India-focused domestic CDMO player. We are working for say out of top 30, we are working for 26. May it be Indian companies, may it be multinational companies. Our focus is CDMO, and that is means you cannot compare us from Suven or Divis.
Okay, all right. Mr. Jain, could you help us out with as a percentage of a consolidated mix, how much is exports as of the last year?
Yeah, 4% is exports.
4% is exports. And where do you see this number headed?
Yeah, it is going to be very high, of course. But
so
in the
next 3 years, should it be in double digits?
Yeah, definitely.
In the next 3 years, it will be double digits. Got it. What about the utilization levels of your, in terms of capacity utilization level? We understand it was less than 50% as of the last year. So could you help us out with when do you see it move up? Point number one. And since you've incurred some capex, at optimal levels, what could your revenue potential be of the company?
See, we are working at around 40%, 42% of the total capacities, as we are holding around 18,000 SKUs, which is the largest in the world, and 4,000 different formulations, which is again the largest in the country. And we are serving for around 1,500 different clients. That's why, because of the complexity and because of the so many changeovers, etc., we are working for around 40% of the total capacities utilization, and we can always scale up it at 60%. And we have in the past as well, we have scaled up for 60%. So in almost all of the production lines. But whenever we go for more than 40-45%, we always make sure that we will have to install more plants and more capacity has to be built, so that the capacity should be spare enough to take care of the ongoing need of the country, as well as the global needs.
Right. Final question before we let you go, sir. You at the start of the conversation said that you have 2 EU GMP approved plants. I just wanted to know, of the total number of plants that you have, how many are EU GMP approved, how many of them are US FDA approved, and with these approvals, what is the increase in revenue likely to be?
See, we don't have any US plants right now with us, and 2 plants are European GMP, because 2 plants are sufficient enough to go into those markets. One is for oral doses and one is for injectables. Other plants have not been applied for European GMP because those are not required. As far as, say, volume is concerned or revenue is concerned, of course it is going to help us. But we cannot give you any futuristic numbers.
All right, we take that point. But this is a recent development, so this is something that we'll keep an eye out on. Increased revenues coming in from Europe, and if at all at some point you go, you look at US as well, you will obviously have to get some of your plants approved by the US FDA. Congratulations on a listing, a strong listing, up 13% for your stock right now. The street will be eyeing growth as you promised. 15% CAGR is what you've done, and that's something that you intend to maintain. With that, we'll take a short break, come back, focus on the markets itself, and talk a lot about specific stocks. Stay tuned.
Motors was one of them, 7.5% lower, the top Nifty loser, and the other one was Samvardhana Motherson as well. That stock ended 10% lower, of course, because of the relations to the Japanese markets as well. 600 stocks, almost 600, 580 to be precise, on the BSE, ended on a lower circuit in today's trading session. And of course, as I mentioned, there were select FMCG and pharma names that bucked the trend. Marico was one, Glenmark Life was the other. Devyani International, after its earnings today, ended in the positive, so that was a good sign. And lastly, on the commodities front, the crude oil prices have fallen to a lowest level in 6 months, and of course copper prices are at a 4-month low. There were specific sectors that bore the brunt of the sell-off today. Real estate was one of them. almost every index constituent ending lower. The top losers there being Suntech Realty, Brigade Enterprises, Godrej Properties, all of them seeing losses of between 5.5% to 6.5%. Railway PSUs are bearing the brunt as well. IRFC, IRCON, RVNL down at least 25% now from the peaks that they made last month. Defense PSUs, a similar story playing out there as well. Mazagon Dow, Cochin Shipyard, Garden Reach, all of them ending lower, almost 5% or more. And metals having a meltdown in today's session. The metals index also was down nearly 5%, 6.5% lower for SAIL, similar for NALCO and Jindal Stainless, 7.5% lower in today's session. So all in all, red across the screen, and there was no sign of any sort of support at lower levels.
My wife, for instance, and she's been such a big contributor in what I've become eventually. I think some of the soft skills actually, and these are aspects, and the ability to without getting sort of stressed, being able to manage many different things. I'll just give you one example. When I was a CA, typically, and many of the advisors, the Indian Economic Service actually are women. They would be in a meeting with me maybe at 3:30, 4 or something, and they'd get these calls actually, and they would be, because they're in a meeting with me, they would be, declining those calls. If the call comes twice or thrice, I knew this was actually either their kid or their mates calling basically for what needs to be made for dinner. Yeah. And so because that's exactly what, my wife, so when I was at ISB, it's the rare occasions when she was not instructing our kids or the maid to actually say what needs to be cooked. My kids would call me up. I would be at a loss actually.
Believe in your strength, right? What is your strength? Carry that, right? It is your deep technical knowledge, your perspective, because that's where the new ideas generate, right? So keep focusing on that. That is one thing that will give you a purpose. Second thing is networking, right? Network with people whom you come across, building the network where you can share your ideas, express them, thrash them out. That is one thing which is going to be very, very helpful as you go ahead. Third thing, I will have to say that keep learning, right? Our industry is about change. So it's a lot of innovation every day. Even actually, sometimes it is impossible to catch up with everything. So keep learning. Wherever is an opportunity, learn.
Come back. Well, that intraday dip has got bought into, and that's why the Nifty is back up close to around 200 points odd. The breadth of the market is still in favor of the number of stocks that are advancing, but earlier today, we had only 150 stocks that were declining. That number has perked up a little bit to around 600 stocks. But that's it from Mangalam and myself. Yeah, Mangalam.
Just as we spoke, the Nifty Bank has moved into the green. So we're happy. All fours, when we started, were in the green. There was a brief dip, and now the Nifty Banks moved back into the green. So we leave you at, at the hands of the team of Trading Guard with all indices in the green. Thank you for watching.
And the last but not least, resilience, right? Don't get disheartened by a failure, right? Failures will happen. Learn from it.
One particular moment, so I actually come from a very humble background. My father lost his father when he was just 7 years old, and just completed school. I was the first person in my clan to go to university. So when he first came to campus, and I took him to the library, the Vijay Kelkar library there. I remember him actually being very emotional and saying, at least in my next life, I get the opportunity to study in a university like this. So that moment is something which is etched in my memory. I'll be absolutely honest, I did not even know what a chief economic advisor is at that time. If somebody said I'll be X, Y, or Z, or even executive director, I don't think even I knew what the International Monetary Fund was.
I came here in 1991. 1991, that was my first year of college. I came here for Inter-IIT. So I remember this campus especially, because this is one thing that I think especially the women need to hear. So I was, good in table tennis. But I became the captain because my captain dropped out. And I came here and we were playing and I won the first game. And then all the men started booing me.
Are you serious?
Yeah. And so I realized the power of mind, right? Like, I was better than the player that I played against, but I lost. And I think that was my first lesson that I learned, which is that, you might be better, but sometimes, your circumstances make you believe you're not, and therefore you lose. So I think that's one thing that everybody needs to do, and I think coming back to this campus...
We have to correct that. We have to give it a big round of applause now to make up for what happened in the past.
Yeah, but my coach also gave me gajar ka halwa, so it was okay.
Today, she is the director for the mission that actually saw India's first private rocket being launched. So tell us a little bit more about that, Saranya. And you did that all under 30?
They gave me an opportunity to be the vehicle director for the mission. So it was a huge learning for me to build. We started off the company by at least when I went in, I didn't know anything about the rocket building. So to building a vehicle which can actually fly, it was amazing.
Not just actually fly, it's actually flown.
Yeah.
So congratulations to you and to the entire team at Agnikul. I know for many of the students here in the room, you're a role model, but you talked about Naveen being the initial role model for you when you got...
Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Surbhi Upadhyay. And this looks like the calm before the storm, after the storm. But it's just that it's not held up, right, at those high levels that we had in the morning.
Let's just hope it's not what you first said, that the calm before another storm, right? But I think that's the market's worry, the durability of this recovery. We've got these sharp pullbacks across Asia, but we need to see if the worst is really behind us, Reema.
But as of now, at least the markets have come off from the session highs. The high today on the Nifty was a level of 24,382. So from that level, we've given up close to about 150 points, though in the last 15 minutes, there has been some pickup in the markets. But globally, things have bounced back. So the Japanese market, Nikkei, is up 6.5%. Taiwan, Korea is up close to about 3-odd%. The problem for our market is banks. So the Nifty bank is flat. It's not participating on the way up. And many of the large cap banks, like an ICICI Bank and HDFC Bank, though they've recovered in the last 15 minutes, are still trading in the red. Today, top honors go to the IT space. Remember, yesterday, all the sector stocks indexed to global growth were under pressure, and that's where the maximum bounce back is. So IT is leading from the front. Nifty IT up 1.8%, HCL Tech Mahindra 2.5% gain, and even the others like Infi TCS up 1.5%.
Absolutely. So that's the way we're looking at things right now. At least the mid-cap market is holding up. Yeah. So let's see. It's still early days into the day. It's just 11 a.m. I thought, we'll start off with two very interesting calls that we're getting on yesterday's carnage from two different financial houses. Let's start with what Mahesh Nadurkar's view is. He's, of course, from Jefferies, and he says that higher risk of a U.S. downturn now factors in 132 basis points Fed rate cut by the end of this year. That's December 24. The consequent U.S. dollar weakening should augur well for Indian stocks on a relative basis. But on an absolute basis, the risk is on the downside, given one of the longest streaks of the bull run, unsustainably high domestic retail flows, and potential capital gains tax hikes in the future. He maintains a defensive stance, and their preferred large-cap laggards are private lenders, staples, L&T, and two-wheelers. So that's the Jefferies call. They do remain a little cautious on the market. Let's look at what Macquarie is now saying. This is coming in from Victor Schwetz of Macquarie, who says that the sell-off was precipitated by a confluence of events. That is the perception that the Fed is behind the curve, investor concerns that the tech bubble is bursting, and third, potentially disruptive unwind of the yen carry trade. Although stampedes, he says, are inherently unpredictable, their view right now is that this is quite close to irrational, thus creating a buying rather than a selling opportunity. So you have one cautious view, one slightly bullish view. Macquarie saying probably this has created a buying opportunity. So we need a tiebreaker. And therefore, let's bring in Mihir Vora, Chief Investment Officer at Trust Mutual Fund. Mihir, I hope you've managed to have a good night's rest. It was a roller coaster day yesterday. But to weigh in on everything that's happened, I mean, the US recession concerns on one side, this whole yen carry unwinding on the other side, and where we are we past the worst?
Good morning, Surabhi. See, are we past the worst is a very, very broad question, I would say. But I would say that yesterday's fall was not a reason to sell. And today, if the market goes up 1-2%, would not be a reason to buy. Because ultimately, what we need to keep in perspective is the fact that over the last few weeks, the absolute confluence of Goldilocks kind of tailwinds that we had are kind of reducing or slowing down. So a few weeks ago, we had the US economy on a roll with the Fed changing its stance to a little bit of neutral to maybe even a little, dovish. We had the Indian central banks do what they've been doing, in a sensible fashion. And we had continued retail flows and some pickup in FII flows over the last few weeks. So it was a combination of the fact that US and global growth is a tailwind. India, anyway, growth was expected to pick up after the monsoons, and retail flows are supporting the market. I think that situation has changed a little bit, as you mentioned, because of the sharp reversal of the yen carry trade. My view is that this trade has been building up ever since 2020, 2021. So it's been almost 3 years of this easy money, borrowing in yen and investing in all sorts of risk assets. That trade has been building up over 3 years. So I don't think it's going to unwind in like a day or two. It will have a bit of a trickle-down effect or ripple effects throughout various markets. For example, while we were looking at stocks yesterday, even the cryptocurrencies were down sharply. So you really don't know where exactly all the flows have gone, where all the borrowed leveraged money globally has gone. So it's not going to unwind in a day. So as I said, yesterday was, of course, a culmination of a lot of factors, and the kind of moves that we saw, 3 sigma, 4 sigma kind of moves that we saw, probably will not repeat too often. But that does not mean that every problem or every leverage trade in the world has been unwound yesterday. So as I said, just because the markets were down yesterday was not a reason to sell. Just because the markets are up today may not be a reason to buy. So in the medium term, I think we should stick to the overall investment thesis for Indian markets, which is that through thick and thin, at least for the next few years, India will continue to remain amongst the relatively fastest growing economies in the world. Demographics, etc., we all know are on our side. And plus, more importantly, we are probably already past the peak tightening stance by most of the central banks. So while, of course, Japan hiked, but they had different reasons for that because of the currency issues. But most other central banks are now in a cutting mode. So after the sharp Fed hikes that we saw ever since 2022-23, now, of course, we are talking about a cut cycle. So I think even if the US slows down, the Fed will start cutting rates actively now or in the next few quarters. And that should continue to give a buffer to the market. So if there is gut-wrenching volatility, I would not react negatively and use that as an opportunity to buy. But just because the markets are down on one day doesn't mean I go out and put all my money in one shot. So I think level-wise, as you did mention, Mahesh also mentioned that valuations, of course, were a bit frothy in some of the pockets. So I think we need to stagger out our investments level-wise as well as time-wise, with the clear view that the Indian economy is relatively amongst the better places to be.
Valuations were excessive. India's market cap to GDP had hit 150%. And the last time we were at that level was in 2007. And we know what followed, the crisis which precipitated. So we are not looking at 1-2 day index moves across the global markets, which are impossible to predict. But what about for the next 6 months? Is the outlook for equities looking a little less rosy because US growth may falter, whether or not we get into a hard landing or a recession? But growth is now being questioned in the US. Slowly, this yen carry trade is unwinding. That trickle-down effect will take place slowly. So what's the outlook for global equities for the next 6 months?
See, volatility is going to remain heightened for sure, which means it's on both sides, right? You'll see whipsaw moves both on the downside as well as upside. So it's very, very crucial to keep fundamentals and valuations in mind, stock-specific fundamentals and valuations in mind. And I think every carnage or every sharp move in the market does give opportunities, brilliant opportunities, because our canvas, luckily for India, is so high that you can always pick and choose stocks. So because I'm sure everybody has a list of stocks which they missed, and if there is a correction, a sharp correction in the market, you should keep that list ready and be prepared. But very clearly with a 1 to 3 year type of a time frame. I don't think the volatility that has begun is going to end very soon. So we have to continue to live with the volatility for the next few months, and make sure that we own good quality stocks that we always wanted to own, and stick with them for at least 1 to 3 years.
1 to 3 years, that should be a horizon if you get in now. Take that point, Mihir. But do you see, because of the events that have unfolded in the last 2-3 weeks, do you see market leadership changing? Because through thick and thin, over the last, I think now 18 months, if not longer, leadership has remained with PSUs, with CapEx, economy-facing stocks, whereas private banks, FMCG, they've been laggards. Do you see that changing at all?
Certainly. I think in some of the segments, which of course you mentioned, there is a lot of action happening. So there's no denying the fact that these are likely to continue to be growth sectors for a while. But in the last few months, we had too many thematic funds being launched, probably chasing a limited set of stocks, and valuations in some pockets because of that did go up significantly. So I think some of the segments which are, as you mentioned, domestic facing, like banks, financials in general, which are non-lenders, including insurance, wealth management, capital market linked stocks, those should provide a good buffer, and there are certain stocks and business models in that which can see secular growth. So I think some of those ignored sectors which have been underperforming for some time may come back into the limelight. As we mentioned, as we discussed, we are probably past the peak of the tightening cycle. So gradually you should start to see all the issues with deposit growth, etc., for the banks and NBFCs recede, and that should ultimately translate into not only volume growth, that is credit growth, but it should also translate into better margins over the longer term. So I think in the next 6 months, we should get a good tactical entry point into some of the lenders and non-lenders. So that's one. Second is discretionary has been quite volatile. And I think that in the last 3 years, while we have seen pockets of growth, like say cars recovered quite well, two-wheelers are beginning to recover. But if you look at the overall consumption and discretionary space, our volumes on an aggregate are only a little above or at levels which were there at the pre-COVID level. So I think the penetration story has really not played out in some of those discretionary names. Whether you talk about auto ancillaries, or you talk about eating out and all those kind of things. So I think there is still scope for the broad macro theme that we always want to play, which is increased penetration, increased prosperity, etc. So I think consumption also within that discretionary can offer good opportunities in a correction. And third, of course, I think we have been talking about pharmaceuticals, which are now coming out after a long period of issues with the FDA, etc. And you are looking at companies which are now doing not only basic API kind of work, but the CRO and CDMO space is also becoming quite exciting. So a lot of stock picking in say sectors like pharmaceuticals. So I think domestic link sectors, some of the pharmaceutical names look good. I continue to believe in the physical asset creation story. So all those names in the real estate infra, all the domestic names should continue to do better than the global facing names like IT, metals, energy, etc.
Okay, very helpful advice, Mihir. Thanks very much. Plenty of food for thought there for investors as they look at some tectonic moves over the last couple of hours in global markets. Thank you so much for joining in. We look forward to the next call. We'll take a break on that note, come back on the other side, and we not only touch base with Manisha, figure out how the commodity markets are doing, if they've stabilized today, but we will also get a global voice in. What next? After the big storm, is the worst over? How are global investors looking at the pullback across Asia today?
Let me end by asking you, who do you look up to today? Which are the companies that you respect and admire? And, is there anyone in specific that you would like to emulate? in your style of working?
The one individual that I have, I wouldn't say seen in very close quarters, but seen from some distance as part of my work in CII, but I truly admire is Mr. Uday Kotak. I think he has built a franchise in a bank that is truly outstanding. And to do it in one generation, and the quality of talent and the kind of ownership that that talent takes is remarkable.
Finance Minister Nirmala Sitharaman is just a few hours away from marking a new record. The CNBC TV 18 coverage of the Union Budget starts right now.
Hello and welcome to CNBC TV 18 Motilal Oswal Budget Headquarters.
Welcome back. So we're focusing on commodities. Equities are trying to look at some semblance of sanity and stability after yesterday's massive moves. Coming to commodities, we have Manisha joining. I think she's looking at oil in particular, because all of this, led to a big drawdown in oil as well in the last 24 hours. But Manisha, hi, morning. What's the situation today?
Well, slightly sane, as you said, in various other asset classes also, and the crude oil prices also seem to be getting some opportunity buying there. After that 3.5% decline in the markets yesterday, we are trading more than a percentage point on the higher side. Well, the support also comes because the US ISM numbers that came in yesterday were slightly on the supportive side. Well, this after a string of weak data that we have seen come in from US, or fears of recession in US as well. So this one economic data actually seems to be supporting markets. Having said that, the weaker data from China and Europe have pretty much continued. You also are looking at weak demand. If you look at the first half of 2024, the imports within Asia, especially within China and Europe, have been on the weaker side. So that will continue to weigh onto the markets, is the reason that you're looking at Brent prices trading at 77 right now. The high that we've seen in 2024 for Brent has been at $94. So from those kind of levels, still on the weaker side there. The other reason that you saw support come back in was reiteration of escalation of war within the Middle East. There have been statements from Iran and Israel as well. So that premium also seems to be coming back in prices. And apart from that, production has been halted in Libya's largest oil field, Sharara. And that also is a premium that you can see in case of prices. For the week-on-week basis, we are still down by about 2%, down by 11% in last 1 month as well. But after those declines, there is definitely some buying opportunity that you can see on the screen.
Okay. All right. Thank you very much for the latest there, Manisha. So some recovery in oil prices as well. Now, is this recovery durable? That is the question on investors' mind across asset classes, across geographies. Let's ask Phu Keen, who's a senior investment strategist at Standard Chartered Bank. Phu, thanks very much for joining in. I'm sure it must have been a very interesting, last 24 hours for you as well. I was going through the note that you folks put out yesterday, when the dust had kind of settled. So just take us through the thought process. Now, I believe a lot of officials are supposed to be meeting in Japan now at this hour to take stock of the carnage. I think the first question is the worst of the yen carry trade unwind over? Is there more to go? And will we see another round of volatility?
Yeah, no, thanks very much. Thanks for having me. I think the yen, we've got a view that for dollar yen of around 146 in the next 3 months. We think it went down. It got close to testing 140, which was the low back in December 2023. So we think that is a support level, getting testing to the 140 level. It got close to there. So we think that would be the support level. So we do expect it to be a bit calmer. At the 146, as I said, our view for the next 3 months. So a lot of it has been unwinding. We think positioning has been very much short of the yen. With the move from the Bank of Japan last week, there was a bit of a surprise. I think there's a lot of unwinding of the carry trade of the yen, where people have been borrowing yen and using that proceeds to invest in assets around the world. So that has been unwinding a lot in the past 48 hours, I'd say.
Fook, morning, Rima here. So what's the expectation for global equities for the next 3 to 6 months? Because your technical model had turned bearish on S&P 500 index for the first time in 2 years. And we saw the kind of sell-off over the last 2 or 3 days. What's the near-term outlook?
Yeah, thanks for that. I'm glad you picked that up. So you're right. The first time in 2 years it turned bearish, and it's been a positive up until that point. So I think in the near term, I think in terms of the volatility and whether we see the bottom or not, I think we're still quite cautious there. But look, over 6 months, our view really is that we still expect global equities to outperform. What's going to be crucial really is whether the US can get a soft landing, whether it can get into a recession. Now, a lot of this, in my view, started after the non-farm payrolls, the employment data, unemployment ticked up. So there was a bit of weakness there. So we've seen soft landing pretty much expected by a lot of economists across the street. But when that data just raised the possibility and a repricing of whether we can actually have a hard landing, I think that is what is causing a lot of the tailspin in the market. Look, our view is that rates are very high at a 23-year high. There is scope for the Fed to cut rates. And as they cut rates, they can then extend the economic cycle and support a soft landing. So that is our core or our base case, if you like. And if the Fed is able to achieve that by cutting rates and extend the economic cycle, as they're focusing on growth, we do expect global equities to outperform cash over the next 6 months. So that is our view for next 6-12 months. We're still constructive. But in the near term, as you say, we look at our technical model and positioning, actually, that hasn't actually washed out yet. So we're still a bit cautious, expect volatility in the short term.
So one piece of the puzzle is the US and whether we get that soft landing or not, or if how the Fed responds. And we'll have to wait and watch, because I think everyone's anticipating now 100 basis points, if not more, rate cuts by the end of this year. So that's one part of it. Fook, to get back to Asia, now we all understand that no one can ignore large markets like Japan, right? I believe you've already closed out, your team has closed out the short USD yen sort of positions. Do you think the maximum amount of this yen surge, is that over, or should we be prepared for any other surprises for Japan? Because I don't know, I mean, can the BOJ suddenly change course? They hiked rates, they were talking about tighter policy. But would they suddenly change course just because the financial markets are freezing up?
Yeah, look, I think that the surprise last week was what really the market didn't like. It was 50-50 going into the meeting, and then they came out with the hike, raising rates to 0.25%. And the market really doesn't like the uncertainty. We think the signs are there that inflation is picking up, and that's why the Bank of Japan acted. And we think that the trajectory really is for further normalization of interest rates. I mean, 0.25% is extremely low rates. They has exited negative rates back in March. So look, we're looking at normalization of policy here. And why are they normalizing? Because inflation is picking up. There's reason why they're doing that. So we do expect that normalization to continue. I think in terms of the communication and how the markets are digesting it, that could take time. Whether the yen carry trade happens or not, look, I mean, there's a lot of different factors in there. As I said, our 3-month view is 146. So pretty much where the market is, we think 140 is a bit of a support. But if you look at the differentials in terms of the yield that you get on Japan versus US, yeah, I can see the arguments there. But in terms of the trajectory, we expect where the Bank of Japan is going to be raising rates compared to the US, where they are reducing rates, I think that's a trajectory that we can expect, but the differential will narrow.
Yep, absolutely. We're living in very, very interesting time where these two large central banks, powerful central banks, are moving in opposite directions. So let's see if we get to equilibrium or not on rates and what that means for global asset classes. Great conversation, folks. Thanks very much. And we look forward to having more frequent chats as we understand how central bank policy moves over the next couple of weeks. Thank you for joining in today. We'll take a break on that note. Coming up on the other side, we will be in conversation with Rajan Sethuraman of Latent View Analytics. So we'll talk about the company's first quarter performance and the outlook.
The Indian markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Great way to celebrate our own 25th year with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high. We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC TV18, embarking on a quarter century of excellence.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startup.
Welcome back. Let's get a corporate conversation going now. Latent View Analytics is in focus. They reported their Q1 numbers a few days back. It's a good start to the year, a 21% year-on-year revenue growth, and profits too have gone up 18%. Margins, though, under pressure on account of wage hikes. We have with us Rajan Sethuraman, Chief Executive Officer of Latent View Analytics, on the show now. Morning. Thank you very much for joining in. It's good, 21% on a year-on-year basis. But I remember the previous conversation where you had indicated that, maybe we'll try pushing for a 6 to 7% quarter-on-quarter revenue growth. Compared to that, this quarter you've done about a 4.5% Q-on-Q revenue growth. So has this quarter growth fallen short of your expectations? And if yes, what led to this shortfall?
Yeah, good morning, Rima. Yeah, you are right. It is definitely short of our expectations. We were expecting it to be in the 6.5% range. The key reason is one, the larger initiatives are taking longer to close. We had a few deal closures, but they ended up closing in the early to mid-June timeframe rather than at the beginning of the quarter. So that had a bit of an impact. And then there are some opportunities that are getting delayed as well, or people choose to do a pilot first before they launch a bigger opportunity. So all these things are playing out. The outlook is still fairly positive for the year in terms of what our original guidance was. We are fairly close to that. But yeah, slower start than anticipated.
So next quarter, because some of these large initiatives have closed in June, do you think next quarter you can push for a 6 to 7% kind of revenue growth?
That's what we are looking at this time. And it looks more promising definitely than the first quarter.
Okay, so Q2 should be better than Q1, and again, you will try for the 6 to 7% kind of revenue growth. What about for the full year? You've given a guidance of 16 to 18%, but that doesn't include the Decision Point acquisition that you all concluded. So what will the overall growth look like, including the acquisition?
So Decision Point did about 12.8 million last year. We will get the benefit of the consolidation only for 3 quarters. But we are expecting them again to do about 14 million or so, 14.5 million, right, in terms of total. We will have to look at the exact numbers in terms of, we are actually looking into the details of their first quarter at this point in time, right, and where the second quarter will end. So I'll give a better view maybe closer to the end of this quarter. But overall, including the inorganic, I think we should be closer to the 25% plus kind of a number.
25% plus top line growth for this year, right? That's what you're referring to, which is fantastic, sir. I mean, given the rumblings that we are hearing of now with a lot of talk about the US economy slowing down, recession, question marks being raised. Is that a concern at all? Because at 25%, I mean, that doesn't seem to be factored in. So what is it that you're hearing and seeing?
Yeah, so the last 2 days, obviously, things, everybody has been caught by surprise. So we haven't fully factored in if that is going to have a big impact. In general, I mean, a lot of the opportunities that we have been pursuing and even what Decision Point has been, they all are fairly close to fruition, right, in terms of the actual closure happening and revenue starting to come in. We are seeing some tentativeness in general, right, but that has been the case for the last 12 to 18 months. Whether the last 2 days will have a big impact, it remains to be seen. But taking that out of the equation, right, we were really looking at a 16 to 18% for organic and a 25% plus, right, in terms of inorganic growth.
And good you clarified that your guidance is based on a lot of deals that are close to fruition. So, I mean, therefore, those numbers are not sort of long drawn-out conversations. So, got that point. Just a word on margins as well. You're at around 21.5% now at the start of Q1. You're saying 23% is possible by the third quarter. Just take us through the levers here. I mean, is there any sort of a pricing lift in this? Or, I mean, so how do you get back to 23, and will that be a sustainable run rate then going forward?
Yeah, not too much of a pricing lever. There will be the pricing adjustments that we will shoot for as part of renewals and so on. The real impact will come on account of leverage, operating leverage. Like we have said earlier, most of the investments that we wanted to make, whether it is on marketing or capability building or the front end, that's all done. There will be a little bit of adjustment that we might do from one area to another, but we're not expecting to add significantly in terms of the percentage of revenue, right, getting invested right on the front end and so on. So therefore, as the revenue growth comes in, the margin lift will happen automatically. Most of it will fall through to the margin. And we are expecting the 6-7% kind of number, right, quarter on quarter. So that's what will help us move the overall margin, right, for the year closer to the 23.5%.
Okay. 23-25% by the end of the year is the exit margin, right?
23.5. Yeah.
23 to 23.5. Okay. Your Gen AI pipeline is about $4 million, you've indicated. How much of that could get converted into revenues? Can Gen AI contribute to your revenues in the current year? Or for FY26, do you have any estimates? And a quick word, because you've specifically called out retail as a sector where there are headwinds. What is happening on that front with your clients?
Yeah, Gen AI, we already have about $1 million of revenue in the bag, which we are executing against. The $4 million worth of opportunities in the pipeline, they are also looking very promising. In general, there is a great deal of excitement. I would say that about 20% of the conversations that we are having today has Gen AI in the mix, either as a core Gen AI kind of a project or Gen AI being leveraged, right, to democratize decision making or making the information available, right, in the hands of the people. So I'm fairly optimistic that a lot of that pipeline will get converted, right, as part of revenue for this year itself. On the retail front, yeah, in general, it has been a fairly difficult place for quite some time now. This coupled with the fact that many of the larger retailers, right, the top 4 or 5 retailers, they're all going the GCC route and they are bringing a lot of stuff in-house. So in general, there has been a slowdown, right, on account of that. Our focus is now more on some of the tier 2 retailers and some of the media-based retailers, for example. Right? So we are looking at opportunities there because that's where, again, you can make use of data analytics, right, to create the kind of competitive advantage. But having said that, I would say that retail, we are more optimistic, more on the marketplaces side, which are digital in nature, as opposed to the core traditional retail itself. Now, again, based on what we are hearing in the US, that will have some kind of impact, right, for the remainder of the year as well. So it remains to be seen, right, how that pans out.
Okay. But in terms of the large retailers, you seem to be losing work to the GCCs. Thank you very much for explaining that. It's been a great conversation, but we need to get into a short break. On the other side, we'll invite the management of Unicommerce Solution. The company's IPO opens today.
Celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV 18 and cnbctv18.com. CNBC TV 18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC TV 18 weeknights at 7 p.m.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV 18. Now streaming live 24/7 on YouTube.
even if the non-farm payrolls labor market data in the US was a bit disappointing, we're really not seeing other economic indicators at all pointing to a recession. And also keep in mind that the labor market is a lagging, not a leading indicator. So we really want to be looking more, say, at PMIs to get a sense of how well the US economy at least is doing.
plethora of events shape up over the last few days, and it's obviously difficult to make sense of everything and put the pieces together. There will be, there are different factors which have been affecting different regions, whether you take Japan or US or maybe even emerging markets for that matter. I think as far as the US is concerned, what we read and what we probably still share as a view, and probably is a continuation of what we, in a way, expecting that, we will probably try and see some correction as far as the inflation dynamics out there are concerned, and some bit of slowing of growth as well. But in the meanwhile, I think what is happening is quite unexpected lines in a way.
Welcome back. Let's talk about Unicommerce eSolutions. They're all set to make their debut in the exchanges. The company's IPO has opened today, and the retail book has already been fully subscribed. Kunal Bair, promoter, non-executive director, and Kapil Makhija, the MD and CEO of the company, are now with us to talk about the company and the plans post the IPO. Gentlemen, thank you very much for joining in. Kunal, let's start with the company first. You're a SaaS company, and you're also indexed to e-commerce in India. Mm-hmm. So what exactly does the company do, and who are your big clients? Because your growth is dependent on them.
Sure. Thank you, Reema, and thank you, Surbhi, for having us. Unicommerce is essentially a SaaS company. We sell software products to companies that sell their products online, either on their own website or the marketplaces, various marketplaces. We take care of the operations from a software standpoint, post the customer clicking the buy button. Everything that happens behind the scenes, where as it pertains to managing of warehouses, managing of inventory, figuring out which inventory should be listed on which marketplace, shipping tracking, payment reconciliation, various operations, the myriad operations that an e-commerce brand needs to conduct behind the scenes, we simplify it using software. So some of the leading brands, both digital native and digital migrant brands, are our customers, the likes of Mamaearth, Boat, Imami, Fab India, and we have 3,500 customers.
Okay. You've always said in your previous interaction with us that you've grown faster than the industry, and eventually you would like your margins to rise to the EBITDA levels of other SaaS companies, which is typically 25 to 30%. So two questions. One, what is the industry growth rate? The next 3 years, 5 years. Sure. And secondly, how soon do you think you will be able to scale up your margins and hit that steady state?
Sure. Maybe if I take a step back, essentially Unicommerce is an index to the e-commerce volume growth, because we make money on a per unit shipped basis, right? So on every unit shipped, we make a small amount of money. So today in India, there are 4 to 5 billion e-commerce shipments a year. Compared to that, China is at 150 billion e-commerce shipments this year. So 30 to 40 times that of India. Over a period of time, as India's e-commerce volumes grow, one would like to believe that given Unicommerce is an index to e-commerce volume growth, Unicommerce should also grow. Yeah. In terms of margins, this business has very high operating leverage. It has high gross margins. We don't do custom software. We sell software products. So the margins are in the 78 to 80% gross margins. And as a result, what we are seeing is as the revenues are growing, more and more percentage of that incremental revenue is going to the bottom line. So last year, about 50% of our revenue growth went to the EBITDA.
Kapil, if we could just, I know you can't give too many forward-looking numbers right now, but just to understand the growth trajectory, between I think FY22 and 23, there was a significant bump up in growth, but then the subsequent year was more flattish. I think 90 went to about 100 CR. How do you map the trajectory going forward in terms of the opportunity, which seems to be very large? I mean, e-commerce is only booming in India, and also the competitive intensity. Who are the competitors in the market, and what should your investors expect from you, say, 2 years from now?
Sure. First of all, thanks for having me here. I think as Kunal mentioned, we are an index to the e-commerce. We have always delivered a growth which is faster than the market. The e-commerce market grew during the pandemic at 30-35%. We delivered nearly a 50% growth. Last year was probably the slowest year I have seen in the 9-year journey that I've been at Unicommerce for e-commerce growth overall. where market probably grew at late single digits, we delivered a 15% growth.
So that would be maybe just the post-COVID impact, sort of a high base slowdown effect, right? I would assume.
As a company, besides the fact that the number of transactions continue to grow, we are seeing more and more brands are going online. So we will continue to add more customers. Plus, we keep on launching new products. We launched 2 new products last year, and we will continue to add geography. So there are multiple levers for us to grow as a company. So we are hopeful of continuing to be delivering a growth which is.
So you mentioned in COVID, you were growing at about 35%.
No, the market
was growing at 35%.
We delivered 50% revenue growth.
You delivered 50% during COVID. Right now, what is the pace of growth of the segment market? And what is a sustainable run rate industry-wide that you expect?
See, ultimately, e-commerce is a long-term story, right? We believe long-term, it will continue to give about 25% CAGR sort of a growth, e-commerce shipments. That's there in our RHP as well. It's there in the industry report. So there may be some soft years, like last year was soft year. Even this year also, we are seeing there is slight recovery, but it's still too early for us to comment whether it's a long-term trend or not. But long-term, 5 years out, we believe that
25% CAGR is roughly sort of the trajectory for the segment as a whole, for the market as a whole. Got it.
What about the international business? 4% of your revenues today, you cater to Middle East and Southeast Asia. How much can you grow your international business?
So I think one of the key advantages of us having served a competitive market like India is that our product is kind of ready for these international markets. We continue to invest behind the international business. From a product perspective, the product is ready. All we have to do is take care of local integrations. We are obviously investing behind sales and marketing. So we'll continue to invest that. But we feel India, there's a lot of headroom for growth in India. A large portion of our business will continue to be driven by India. There's a lot to be done within India in terms of adding new customers, adding new products. And international will be one of the strategies.
Is there a mix you're looking at, India versus international?
So I think a large portion will come from India. International will continue to be one of the strategies, but a large portion of our growth and our contribution come from India.
Kunal, just a question. I think the issue is about 276 odd crores at the higher end, right? And I believe this is pure OFS, so the money is not coming in the company. Do you foresee any cash needs? And inherently, I mean, is this a business that throws up a lot of cash? What are the cash levels? And would you require any funding down the line, immediately, say in the next 15 to 18 months?
So last year, our revenues, while you mentioned grew at 15%, our PAT doubled, right? And we are adding cash to our balance sheet every month right now. We already have a good amount of cash on the balance sheet and the company has zero debt.
How much is the cash now?
70 crores as of end of FY24, but that's increased since then. So here's a company with zero debt, positive cash flows, generating free cash flow, already has cash. So we will first figure out how to deploy the cash we have effectively. Largely, we would look at inorganic opportunities with it because we have no intention of starting to lose money as a company, right? When we've been profitable last many years, last 3 years we've been profitable. So effectively that money can be put to good use in finding good products that are synergistic with our current business.
30-second answer. Why are you going public? Because you don't need the money. Your fund is selling, SoftBank is selling. Why are you going public?
Our holding company is selling, but our fund is not selling. Firstly, we feel, as Mr. Murthy would always say, that Infosys went public and suddenly large enterprises started taking them very seriously. Secondly, our company is only because of the talent we have. Being public allows us to retain and attract good talent. And finally, for inorganic opportunities.
Okay, so branding, more visibility and being out there on the large scale, the public market platform. Got it, gentlemen. Thanks very much. We look forward to more conversations down the line. And good luck with the IPO as well. Thank you.
Thanks for having us.
Okay, let's move on and talk about the market technicals. A quick check on the markets. In the green now, currently up about 175 points. Mitesh Thakkar is now with us for a quick tech check. Mitesh, it's bounced back, but it's off from the highs. What have you made of the morning so far, and what would be the trades that you would recommend?
So I think, the market with the kind of fall we have had for the last 3 days, a pullback and a bounce back was on the cards, and it happened with the gap up opening today. But the important thing is that we didn't even head towards 24,500, 600, which is the minimum retracement area. And I think, we have seen some supply emerge again from those levels. The structure is weakened. So my idea is that getting past 24,500 would be a tough ask, and therefore sell on rallies would be a good strategy. I think eventually we will head lower, and most likely targets on the Nifty should be a retest of 23,900, which is what we did yesterday. And in the worst case scenario, even 23,500, 550 zones could be tested. So slightly negative structure on the index. On the stock side, I have one buy and one sell call. The sell is on Vedanta with the stop at about 423 for targets of 400. And the buy is on Syngene, which is doing very well today. Syngene is a buy with a stop at 816 or 815 for targets of 842.
Okay, we will slip into a short break on that note. We'll get you more on the market. Stay tuned.
There's expectation that in the second half of the year, we will probably try and finally see some possibility of rate cuts emerging.
India, I think it would be less a growth scare. People have been talking about valuations for Indian equities for a very long time. Nonetheless, the market kept going up, and if anything, recently compared to many other global markets, it still performed relatively well. But I think now that question is going to become much more pertinent to investors when they see a much less supportive global environment for risk. Markets with high valuations are going to be one of the first things that they look at.
Big miss on the US jobs data has triggered recession fears. It's actually the first time labor market data, monthly jobs data in the US has been such a big miss in this particular cycle. And remember, till last week, expectations were that it's going to be, a very moderate soft landing, which will allow the Fed to cut rates. And it's all very well orchestrated. But this could mean that, it's not all under control. And the Fed perhaps is even behind the curve with what they want to do as far as interest rates are concerned. As a result of which, US money markets are now pricing in a 50 basis point rate cut in September and a total of 125 basis points rate cut through the course of 2024. So the benchmark Nikkei is down over 20% in the last 3 days now. And you look at the USD JPY, that has fallen 20 yen to a dollar in the last 1 month. So basically, the currency has gone from 162 to 145 from the beginning of July. That's a massive move for a currency like that in such a short time span. The last time we had this magnitude of a rally, along with interest rate differentials between Japan and the US around 5%, it was back in 1998-99. And of course, we had that sort of LTCM crisis back then. Now, fears of yen carry trade unwinding is essentially reason number two. So, people borrowing in Japan, very low interest rates, investing around the world. And of course, the yen moving so sharply upsets plans. Stops are hit and there is a forced unwinding which takes place. So that is reason number two. Number three, and this went unnoticed under the radar for the first couple of hours when we began trading, but NVIDIA, the big reason why US stock markets have done so well is reportedly delaying its next AI chip Blackwell by at least 3 months. And it was not a coincidence that the Taiwanese market was amongst the worst performer in Asian markets today. And also take a look at the fact that Nasdaq continues to underperform the S&P. So that is, I think you could blame it on the NVIDIA story there. And number four, I don't think this was a really dominating driver, but geopolitics, right? The political news website Axios reports that attack by Iran and Hezbollah against Israel could start as early as Monday. I would say that what was happening with the currency markets and fears of a US recession were the dominating drivers. This, of course, if it were to come through and it's a
Welcome back. Let's talk about the real estate sector now. Will the Finance Ministry review the new LTCG regime for realty? Shireen is joining in with exclusive details. Shireen.
Well, thanks very much. Yes, the blowback and the criticism with respect to the announcements that came in for the budget was specifically focused on the removal of the indexation benefits when it comes to the long-term capital gains regime, specifically for real estate. As my colleague Timsy has also been reporting, and what we are given to understand at this point in time, the options that are being considered by the Finance Ministry, the one that the Finance Ministry seems to prefer is the grandfathering option, whether it will be grandfathered till 2024, July 2024, or perhaps a year beyond that, is the question that remains unanswered. But what we are given to understand is that a final decision is yet to be taken. The other option, and that is what we've seen happen even as far as the tax regime is concerned. The old tax regime continues to coexist with the new tax regime, given the option to consumers, to taxpayers, to switch depending on what they feel they most prefer. So will that be the preferred route that the government decides to take forward? We don't know yet, but again, a decision has not been taken. But these are the two options on the table that are being reviewed at this point in time. Now, remember, again, to take our viewers back to the conversations that we've been having, including with the finance minister and the finance secretary, when I put this question to the finance minister a few days ago, asking if the government was considering a review or any kind of amendments, the finance minister had said that she would speak only in Parliament because the finance bill is now the property of Parliament. And when I'd asked the finance secretary had said that in his view, in his personal view, there was no need for a review, but he did make it clear that it was eventually going to be a political decision. So remember, the finance minister is expected to reply to the finance bill in Parliament. It was expected today. We're given to understand that's now likely tomorrow. But these are the options at this point in time. If any relief is provided, it's likely to be restricted to the real estate sector for the purposes of providing some relief that taxpayers felt was necessary on account of the indexation benefits being done away with. A final decision, though, is awaited.
Okay, all right, Shireen, thank you very much for that. So then it's all eyes on Parliament, because that's where the finance minister, as you're telling us, will probably clarify this point. Thank you very much for joining in. Take a very quick break. We'll come back with a market update in just a moment.
Could hurt at the margin going forward.
Usually in a session like this, when there is a sell-off across the board, you may wonder that a dip would get bought into, as has been the trend, but sadly that was not the case in today's session. And the benchmark indices, both the Sensex and the Nifty, saw their biggest sell-off since the 4th of June, and as a result of which 15 lakh crore worth of investor wealth was eroded after today's sell-off. And the sell-off was across the board, with 46 Nifty stocks ending in the red, with just a select FMCG stocks and some pharma names bucking the trend in today's trading session. And the sell-off, as I mentioned, was across.
Well, we are looking at a market which is managing to retain bulk of that gain, 160, 170 points still up on the Nifty, but need to watch for the banks because that's where the problem is. Even now, ICICI Bank, HDFC Bank, they're at the flat line. So if there's no further decline in the Nifty Bank or these other big banks, then perhaps the bulls can heave a sigh of relief. Mid-cap market's quite all right. We are still looking at a very, very healthy advanced decline ratio. With that, it's a wrap on this edition of Trading Hour from the entire team. Thank you very much for watching. Stay tuned. Halftime report up next.
Media, realty, auto, PSU banks, all of these indices saw drops of anywhere between up to 4% or even more, with metals and real estate being the biggest sectoral laggards in today's trading session. The key point also to watch was up almost 52%, and that was the biggest single day jump that it had seen since August of 2015, eventually ending 42% higher and above the mark of 20. That might be a cause of concern as well. There were, of course, global facing stocks that took a bit of a beating in today's session. Tata Motors was one of them, 7.5% lower, the top Nifty loser, and the other one was Samvardhana Motherson as well. That stock ended 10% lower, of course, because of the relations to the Japanese markets as well. 600 stocks, almost 600, 580 to be precise, on the BSE ended on a lower circuit in today's trading session. And of course, as I mentioned, there were select FMCG and pharma names that bucked the trend. Marico was one, Glenmark Life was the other. Devyani International, after its earnings today, ended in the positive, so that was a good sign. And lastly, on the commodities front, the crude oil prices have fallen to a lowest level in 6 months, and of course copper prices are at a 4-month low. There were specific sectors that bore the brunt of the sell-off today. Real estate was one of them. Almost every index constituent ending lower. The top losers there being Suntech Realty, Brigade Enterprises, Godrej Properties, all of them seeing losses of between 5.5% to 6.5%. Railway PSUs are bearing the brunt as well. IRFC, Ircon, RVNL down at least 25% now from the peaks that they made last month. Defense PSUs, a similar story playing out there as well. Mazagon Dock, Cochin Shipyard, Garden Reach, all of them ending lower, almost 5% or more. And metals having a meltdown in today's session. The metals index also was down nearly 5%, 6.5% lower for SAIL, similar for Nalco and Jindal Stainless, 7.5% lower in today's session. So all in all, red across the screen, and there was no sign of any sort of support at lower levels.
My wife, for instance, and she's been such a big contributor in what I've become eventually. I think some of the soft skills actually, and these are aspects, and the ability to without getting sort of stressed, being able to manage many different things. I'll just give you one example. When I was a CA, typically, and many of the advisors, the Indian Economic Service actually are women. They would be in a meeting with me maybe at 3:30, 4 or something, and they'd get these calls actually, and they would be, because they're in a meeting with me, they would be, declining those calls. If the call comes twice or thrice, I knew this was actually either their kid or their mates calling basically for what needs to be made for dinner. Yeah. And so because that's exactly what, my wife, so when I was at ISB, it's the rare occasion.
Stocks see a bounce up after the steep decline yesterday. Realty, IT and capital goods lead the recovery, while financials are the big laggards. Mid-caps outperform.
Bharti Airtel turns in an inline performance on the revenue front, but margins dip on the pressure in the enterprise business. The average revenue per user also sees just a small tick up.
Sources tell CNBC TV 18 the government is weighing offering grandfathering for long-term capital gains tax on real estate till July 2024. It may also allow both a flat tax and one with indexation as options. No decision is taken as yet, but there could be an indication in the finance minister's reply to Parliament.
The political upheaval in Bangladesh is a fresh spot of bother for some consumer companies like Marico, Imami, Bajaj Consumer, and to a lesser extent Britannia, Nestle, Dabur, which have exposure to the paint market. Paint maker Kansai Nerolac too may feel the pinch. After a rout yesterday, there has been a bit of a relief. The Nifty is up almost 180 points, led lower only by the Nifty Bank, which is just about flat. I'm Manglam Malu, with me Ekta Batra. We are speaking a day after a big rout, some recovery today. The mid-cap index has, the screen a lot more brighter than what it was yesterday. 1,800 stocks advancing for just about 600 declining. Hi, Ekta.
Hi, Manglam. Yes, and the US futures are probably supporting that sentiment at this point in time, and that's what's aiding it a little bit. So we have the Dow Jones futures, which is up around 400 odd points, the Nasdaq futures, which is up around 300 odd points. But while the equity markets have recovered, we just need to keep an eye out on the rupee, which has depreciated, Manglam. The rupee has hit a record low of 83.9 in today's trading session as well. So that should come up for you, giving you an indication that there is some amount of worry which continues on the rupee. It's probably making its way towards that 84 mark, as you can see currently at a record low. In fact, it has hit a record low for the 5th straight day as per the data that we've collected, and that means that it has been hitting record lows all the way since the 31st of July. So yes, while the equity markets have recovered, we need to keep an eye on the rupee as it probably makes its way towards that 84 mark.
It'll be interesting to see how much of the impact on the rupee is largely on account of the yen carry trade unwinding, and how much of that is on account of the weakness that we're seeing on Wall Street as well. But no such problems for the FMCG pack. HUL at very close to a 52-week high, just about 1.5% away from that. Yesterday as well was a good mover. We have Britannia as well, which has moved well, up almost 3%. Remember, the management was confident of double-digit volume growth, at least in the second half of this year, with some price hikes, though they were not pretty committal on margin improvement. They did say that they're okay with lower margins so long as volume growth comes by, and that's exactly perhaps the right way to go in an industry parched for top-line growth for the last many quarters. So we're seeing some pickup in all these FMCG companies, and consumption in general has been doing well. Marico, barring Marico, which has problems of its own with regards to Bangladesh, where about 10-11% of their revenues comes in or are exposed to that geography itself. So despite good numbers and even better commentary, the stock is under a wee bit of pressure. But while we were discussing the markets and the opening, there was a story at the bottom of your screen talking about the DGCI sending a show cause notice to 10 foreign airlines operating in India. Timsy joins in on the phone line with what that show cause notice is all about. Timsy.
Well, as you rightly mentioned, the Central GST Intelligence Authority, that is the Directorate General of GST Intelligence, or DGGI, they have sent show cause notices to 10 foreign airlines operating in India. According to sources, the show cause notices have been sent to Emirates, alleging tax evasion worth 7,550 crore rupees, Etihad Airways for 1,660 crore rupees, Saudi Arabia Airlines for 612 crore rupees, Air Arabia for 455 crore rupees, Oman Airlines for 71 crore rupees, Thai Airways for 60 crores, Qatar Airways for 53 crores, Singapore Airlines for 40 crores, British Airways for 33 crores, and Lufthansa Air Cargo for 10 crore rupees. Now, these show cause notices have been sent as a follow-up to the detailed action that was taken against these foreign airlines operating in India. Just to remind our viewers that CNBC TV18 had first reported about Directorate General of GST Intelligence conducting raids at branch offices of these airlines in India on 18th of October 2023. DGGI, while conducting this action, had alleged that tax evasion has been done on account of import of services from their head office by the Indian branch offices. And now, as a follow-up action to these raids and various investigations that were conducted against these 10 foreign airlines, DGGI has now sent show cause notices raising these claims or demands of tax evasion. So let's see what these airlines have to say Whether they get an indemnity or not is something we'll have to wait and watch for, because recently GST Council did clear a provision of Section 11A. Whether foreign airlines also follow as part of the indemnity that will be given through the Section 11A is something that we'll have to wait and watch for. But as of now, show cause notices have been sent.
Okay. All right. Well, thanks very much for that, Timsi. So that's an important update which is coming on the entire airlines space at this point in time. But let's talk about one particular company. We have Orient Cement, which is the first management on the show. The company reported what was a mixed set of numbers. The sales volume came in weak, while the margins came in healthy this time round. To discuss this and more, we have with us Deepak Khetrapal, who's the MD and CEO of Orient Cement, who's joining in and to discuss the numbers and the quarter gone by. Mr. Deepak Khetrapal, thank you very much for taking the time out. Well, I just wanted to start by talking about your realizations, which are flat on a Q-on-Q basis. How much of the mix was, premium sales this time round, and what led to this flattish performance in terms of the realizations?
Thank you, Ekta. First of all, let me clarify that when we say flat realizations, we are one of the very few companies in our industry who have actually been able to maintain our realizations over last year or over the previous quarter. So, and that I think is perhaps an outcome of the very cautious policy that we've been following rather than chasing volumes. We try to sort of in a way get a certain minimum amount of contribution margins on our sales. And if the orders are not offering at that our threshold margins, we refuse to do that business. If you look at the industry performance, like I said, we are one of the rare companies who maintained the realizations and also profitability. Despite 15% drop in sales volume, our profits are almost flat over last year. So that I think is a credit to our strategy that we've been following. Yes, the loss of volumes is a concern, and we would address it based on how the pricing goes. And we're also looking at, maybe monitoring it very, very closely. Now, one relief which I think our investors would have from hearing this, while we are giving up volumes based on margins in the B2B market, in the B2C market, as we call it trade sales, we are actually maintaining our market share. But on the B2B markets where large customers are there, they are hardly loyal to you. You give them a good price, they will come back. So that's the nuance in how we are picking up our customers and markets.
Incredibly nuanced view out there, Mr. Khetrapal. Always a pleasure speaking with you. If you could, help us with just three numbers. One, how much is value added as a proportion of your sales currently? Last time you said it was 22, 23%. And in light of this strategy that you're using, realizations over volumes, what's your updated guidance on volumes and EBITDA per ton for the remainder of this year? So value added as a proportion of your mix, volume guidance and EBITDA per ton guidance for the year.
So the good news is, despite 15% loss in volume, my premium sales have actually been very stable, and over the 21% that I had reported in the previous quarter, I'm happy to say in a poor quarter also the premium sales that has been just 23% of trade sales. So that strategy seems to be really, really well in place. In terms of the volume guidance, quite frankly, this perhaps is the absolutely incorrect time when the markets are actually seeing no volumes, at least in the market that we are exposed to. We've had extensive rains all across our markets in Maharashtra and in Telangana and Karnataka. As of now, I think I'll hold my views on what margin direction we want to give to the investors. But all we can tell you is that we will be chasing profitable volumes. We'll be chasing more premium volumes all through the place. But too early to give me for me to give you the annual guidance. This is just the wrong time.
Okay. When would it be a good time? When do you think you'd have visibility? By next quarter?
Yes. The moment monsoons get over, I'll tell you why the monsoon demand is weak, not just for us, for everybody in the market, right? The good part is that once the monsoons get over, there's a lot of pent-up demand which hits the markets. One, for construction to catch up with what was not possible during heavy monsoon. Secondly, there's a lot of repair work to infrastructure and housing that becomes necessary because of very heavy rains. So these two factors typically give us much better demand in Q3 than we normally would have. having good monsoon in India always is good for the second half of the year. So we are looking forward to that.
All right, but could you give us a sense of how pricing has panned out? Because there were expectations of a mild increase, at least post-elections ahead of monsoons. Typically, monsoons, we don't see much price increases. How have prices changed for the industry and for you post, in first quarter? How do they compare with the previous quarter?
Yeah, so that's a good question. Normally, we would see that Q1 should have had much better prices, but the prices, one, the demand was weak. Secondly, I think some of the larger players in the market are preferring to choose volume, so they're reducing the prices. So prices have been weak. In Q1, where we reported stable, every other company is actually reporting degrowth in pricing. And July, I can mention that July prices are further down below even the Q1 prices that we've had. So pricing is a matter of huge concern right now, along with the volume.
Would you be able to quantify the difference between July pricing and what the average in first quarter was?
It's about 10 rupees a bag.
All right, 10 rupees a bag lower.
2.5%.
Okay, go ahead, Ekta.
Okay. Mr. Khetrapal, just on that sense that you're going to probably get more visibility in the second half, what exactly is the capex lined up for FY25 then, based on what you are saying when it comes to pricing, based on what you are saying when it comes to visibility of demand? How much do you think you need to add on in terms of capacity addition? What are you spending on that?
See, capacity addition, Ekta, as you would know, is a longer-term view on the business. It's not driven by how 1 quarter or 2 quarters look. And when we start adding capacity, 15, 18 months are the bare minimum time before the capacity comes online from the time we start construction activity, right? So from that perspective, our capex is more governed by we having all the necessary clearances in hand. We need to add capacity at our Karnataka plant in a hurry. I mean, last 2 years, we've been selling nearly full capacity from that plant. And as far as we are concerned, first of all, we are chasing, and our application for environmental clearances are already on the portal of Ministry of Environment and Forest. In the next 4 to 6 weeks, we expect to get the environmental clearances. Post that, we'll start construction activity fairly quickly. Now that the clearances will be coming in during the second quarter, we are expecting that by the end of the year, at least at Chitapur plant in Karnataka, we would start the doubling of capacity project that we've been chasing.
Mr. Khetrapal, where you operate in the southern part of the country, there is a fair amount of storm and you're in the eye of that. A lot of acquisitions taking place, a lot of consolidation out there, and a lot of clamor for market share, so to say, as well. And in that, a lot of people are looking at your asset as one of those prized possessions too. I mean, I remember having spoken to Parth Jindal just 2 weeks ago, and he did say that they are looking at a lot of capacity increase, closer to 60 million tons by the end of 2030 is what they're seeking. There have been multiple reports that there is a jostle for Orient Cement between either Adani's or the Jindals. Would you have any comment on that, or are you not on the block?
Look, as far as I'm concerned, there's so many people eyeing us at a good asset. I think it's a compliment. We are recognized in the industry as one of the most efficient players, one of the players who has the highest amount of premium sales cement in the market, at the highest premium in the marketplace. So we are a good asset. That's a compliment. As far as the jostle for that is concerned, I'm blissfully unaware of all that. So it's perhaps happening at their end, not at my end.
You're a good asset and you're on the block. Would that be the correct assessment?
I am a good asset which people might be eyeing. I'm not saying we are on the block. Please don't put words in my mouth. I've never.
I'm glad you clarified. We were just, clarifying those interpretations.
Okay, so I'm sure you are not in the place to comment on that as well, Mr. Khetrapal. You probably wouldn't be as privy to it, or if you are privy to it, you're not going to let out on it. But if you could just give us a sense in the analysis of the South Indian market before you let us go. Before we let you go, in terms of pricing, considering the kind of consolidation that is taking place, what do you anticipate, at least in the next couple of months? Do you think that that pricing is going to get far more aggressive? If so, to what extent? And what would the new dynamics of the market be as well?
Well, as of now, the prices are under tremendous pressure. As I'm sure you heard that earlier. I've told you July has been even worse than the first quarter. So the prices will remain under pressure. The only way prices can improve is once the demand comes back to the strength that I spoke about. Till that strength in demand comes back, obviously the prognosis always the price will be under pressure because some people will chase volumes, right? So for the next couple of months that you spoke of, I think it's going to be a difficult time in South India. But as I mentioned, personally, I do expect volumes to pick up once the monsoon gets over. There's a lot of pent-up demand that we're expecting to come in. And that will be the time to perhaps look for some improvement in pricing in the market.
All right, we will close in on the volume guidance once we speak post-monsoons, post the second quarter perhaps. There will be better outlook that you will have in terms of what the EBITDA per ton as well as what the volumes could be. But for now, you are happy with the premium positioning that you have with the kind of realizations, choosing realizations over volumes. We'll keep an eye out on the pricing, but more importantly, we'll watch out for what takes place in the southern part of the country as well, where there is a fair amount of clamor for market share and capacity. Thank you so much for joining in. Yes, please go ahead.
Profitability, let me remind you, we are the only company in the whole industry which has reported improvement in EBITDA per ton over last year. The only company. So
that's true. And
look at our focus on profitability more than growth and volumes, because I think that we are playing slightly contrarian game to the rest of the industry. And
that explains why you're a good asset as well. That explains why everyone's eyeing you.
Thank you so much. Thank you. Appreciate that.
All right. Always a pleasure speaking with you. Take a short break, come back, get you more on the markets and a lot of stocks that are moving around this afternoon. Stay with us.
Not instructing our kids or the maid to actually say what needs to be cooked. My kids would call me up. I would be at a loss actually.
Believe in your strength, right? What is your strength? Carry that, right? It is your deep technical knowledge, your perspective, because that's where the new ideas generate, right? So keep focusing on that. That is one thing that will give you a purpose. Second thing is networking, right? Network with people whom you come across, building the network where you can share your ideas, express them, thrash them out. That is one thing which is going to be very, very helpful as you go ahead. Third thing, I will have to say that keep learning, right? Our industry is about change. It's just a lot of innovation every day. Even actually, sometimes it is impossible to catch up with everything. So keep learning. Wherever is an opportunity, learn it, right? And the last but not least, resilience, right? Don't get disheartened by a failure, right? Failures will happen. Learn from it.
One particular moment, so I actually come from a very humble background. My father lost his father when he was just 7 years old, and just completed school. I was the first person in my clan to go to university. So when he first came to campus, and I took him to the library, the Vijay Kelkar library there. I remember him actually being very emotional and saying, at least in my next life, I get the opportunity to study in a university like this. So that moment is something which is etched in my memory. I'll be absolutely honest, I did not even know what a chief economic advisor is at that time. If somebody said I'll be X, Y, or Z, or even executive director, I don't think even I knew what the International Monetary Fund was.
I came here in 1991. 1991, that was my first year of college. I came here for inter-IIT. So I remember this campus especially, because this is one thing that I think especially the women need to hear. So I was, good in table tennis, but I became the captain because my captain dropped out. And I came here and we were playing and I won the first game. And then all the men started booing me.
Are you serious?
Yeah. And so I realized the power of mind, right? Like, I was better than the player that I played against, but I lost. And I think that was my first lesson that I learned, which is that, you might be better, but sometimes, your circumstances make you believe you're not, and therefore you lose. So I think that's one thing that everybody needs to do, and I think coming back to this campus...
We have to correct that. We have to give it a big round of applause now to make up for what happened in the past.
Yeah, but my coach also gave me gajar ka halwa, so it was okay.
Today, she is the director for the mission that actually saw India's first private.
Welcome back. Well, just watch out for a couple of companies such as Gland Pharma. It comes out with its numbers today and showing a good amount of traction on the upside. So that stock is up around 2.5%. Numbers will be out late evening, but nonetheless, there's some amount of interest which is being shown on that particular counter. But nonetheless, the big news that we've been tracking on the political side is the political upheaval in Bangladesh. It's a fresh spot of bother for consumer companies. Mangalam, you've been tracking the impact of this turmoil. Tell us what have consumer companies told you and how big a concern is it?
So, the most important thing is that because it's such a close landlocked neighbor with India, there has been a fair amount of business with Bangladesh as well. But the most exposed consumer company here would be Marico, which is actually the one which is also falling today despite good numbers. So Marico is actually down about 4%. So if you look at their overall, revenue, international business is about 25% of the revenue. 44% comes in from Bangladesh. So net exposure to Bangladesh would be around 10 to 11%, and that's why that's down about 4% as well. But for the other consumer companies, the sales exposure is less than 5%. In fact, in most cases would be about 1 or 2 odd percent itself, and which is why all these stocks are not perturbed by the impact in Bangladesh. So Dabur is up around 4%, Imami, Nestle, GCPL, Britannia, all of them sub 5%, closer to 1 to 2% itself. For names like Bajaj Consumer, Kansai, Nerolac and others, it is again closer to 4 to 5% itself. But the rural recovery tailwind is so much that people have looked past the Bangladesh crisis itself. But for Marico, because the international business has been doing extremely well, that's the reason why, and it's been so, pegged around Bangladesh. That's the reason why that stock is under a wee bit of pressure. I'll be interested to see how VIP performs as well, because they have a capacity in Bangladesh, close to around 30-35% of their capacity sourced from there. That stock too is under mild pressure, reports its numbers today. So to that extent, commentary around that would be very crucial to track too. Then you have some suppliers from Bangladesh. So Trent, for instance, has a lot of its supply coming in from 3 countries, which is Hong Kong, Thailand and Bangladesh. Though again, out here, growth has been very strong. It can be a near-term supply disruption, which explains why the stock again is not very perturbed by what's taking place in Bangladesh. But what's really an opportunity is for garment makers, for a lot of these textile players, because remember, Made in Bangladesh as a textile brand was pretty active world over. So maybe even if supply chains get hit, then all the global brands, the global companies that source from Bangladesh will look at Bangladesh +1. So interesting times where we earlier spoke about China +1 and now we're talking about Bangladesh +1. And that explains why names like, Gokul Das Exports surging, Himmat Singh Said surging, we have Kitex Garments, all of them higher, including the likes of Welspun Living, which also, by the way, benefit from a weaker rupee because a lot of their revenue comes in from exports itself. So better realizations coming in. So garments and textiles, positive. Consumer companies, mild negative. For Marico, a little more than the others.
Okay, so definitely it could be possibly a gain for us considering what has taken place in Bangladesh, but we really need to assess in the next couple of days. But we'll take a short break. On the other side, Sachidanand Udekar of Trade Bulls will join in with some of his trading ideas today. Stay tuned.
Launch. So tell us a little bit more about that, Saranya, and what you did that all under 30.
They gave me an opportunity to be the vehicle director for the mission. So it was a huge learning for me to build. We started off the company by at least when I went in, I didn't know anything about the rocket building. So to building a vehicle which can actually fly, it was amazing.
Not just actually fly, it's actually flown. Yeah. So congratulations to you and to the entire team at Agnikul. I know for many of the students here in the room, you're a role model, but you talked about Naveen being the initial role model for you when you got started. But let me end by asking you, who do you look up to today? Which are the companies that you respect and admire? And, is there anyone in specific that you would like to emulate in your style of working?
The one individual that I
I wouldn't say seen in very close quarters, but seen from some distance as part of my work in CII, but I truly admire is Mr. Uday Kotak. I think he has built a franchise in a bank that is truly outstanding. And to do it in one generation, and the quality of talent and the kind of ownership that that talent takes is remarkable.
Finance Minister Nirmala Sitharaman is just a few hours away from marking a new record. The CNBC TV 18 coverage of the Union Budget starts right now.
Hello and welcome to CNBC TV 18 Motilal Oswal Budget Headquarters. Markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Welcome back. You're watching us here on Halftime Report. Perfect time to get you up to speed with what's taking place in the F&O side of things. The Nifty is holding up with gains of almost 150 odd points. But remember, it is off the highs. And the reason why it is off the highs is because of the Nifty Bank, which is putting some bit of pressure on the gains that we're seeing on the Nifty. The mid-caps, however, doing a lot better. So the advanced decline chart comes up for you. And that tells you that the broader market health is pretty strong. Even though those lines have come a little narrower, but, you know, there's still about 3 stocks advancing for every 1 stock which is declining. If you look at the active options, and if you look at the 1 stock which is actually going to be the stock of the second half of trade, it has to be HDFC Bank. Why do I say that? Because it's at 1612. The 50-day moving average is at 1617. So the stock is below the 20 and the 50-day moving average. If it falls below that, then maybe, you know, the next leg of support comes in at 100 and 200-day moving averages around that 1550 mark itself. Why is HDFC Bank important? Because it's the highest weight on the Nifty, highest weight on the Nifty Bank, and also the highest weight on the Nifty Financial Services Index, where the weekly expiry plays out today. Where is that index? 22,750. And the most active calls are the 22,800 call and the 22,700 put. And the 22,750 call and put are equally active. The premium on that straddle is close to around 100 rupees, telling you that the street is bracing for a 22,650 to 22,850 sort of range for the Nifty Financial Services expiry. So long as it stays in the range, no real problems out there as well. For the Nifty, or at higher levels, there is some supply that's coming in, which is what's visible in the kind of call writing that we've seen around 24,300. But at lower levels, there is demand around that 24,000 mark itself, which explains why 24,200 put writers are equally active for a premium of 125 rupees too. So those are a couple of factors for the markets that we'll watch out for. For the Nifty, the broader range would of course be the 50-day moving average of 23,862 at the lower level, with 24,535, the 20-day moving average at the upper level itself. So those are a couple of factors for the frontline indices and the markets. The one individual stock that I'm watching out for today is Manappuram Finance. A lot of open interest built up beyond that 95% level as well. So the stock may enter F&O band today.
Okay, all right, Banglam. Thanks very much for that. Sachidanand Uttekar of Trade Bulls joins in on the show to discuss the technicals of the market. Sachidanand, hi, welcome to the show. Well, if you could just start by giving us a sense, is today's gain showing you enough confidence to take any kind of longs?
Good afternoon, Ekta. Good afternoon, Mangalam. Definitely, when we look at both the indices, they are still trending within the previous day's trading range itself. When we look at Nifty, so far the support at 24,000 has been very strong and sustainable. But on the higher side, we need a very confident closing about 24,460 to redeploy aggressive long positions. When it comes to Nifty, a very similar kind of a scenario, Nifty Bank, it is a very similar kind of a scenario wherein the 50,000 support looks confident at least for the day. And on the higher side, it needs a strong swing above that 50,575 mark. So I think when it comes to indices, they are showing signs of consolidation. Certainly, there is not much weakness which is evident immediately. So we are avoiding a trade when it comes to indices. But certainly the way markets are, positioned, there are long short opportunities which are still, possible. One of them is the Asian Paint, which has been outperforming for the last 3 weeks. If you look at the overall structure, again, there's a very confident bullish flag formation on its daily scale. The kind of open interest built up which we have seen in the last 2 weeks, it is indicating that this particular rally may extend towards 3,300. So this is one space where we are comfortable holding our long positions, keeping a stop loss at around 3080. Even from a trading momentum perspective, one can initiate fresh longs. The pattern target is placed at around 3,300. But on the short side, Bharti Airtel is showing signs of distribution almost after 34 weeks of sustained up move. This is the first time where its weekly RSI has slipped below that 70 mark. We have seen a good amount of short positions in today's trading session as well. And the way its averages are placed, we may see this particular stock declining towards 1370, and that's why we have recommended building short positions when it comes to Bharti Airtel. From a trading perspective, the stop loss can be placed at around 1465 on a closing basis, and fresh shorts can be deployed for a target swing towards 1370.
All right, thanks a lot, Sachidanand, for joining in and giving us your views on individual stocks and the index. We'll take your leave on that. On the other side, we'll have the management of Monte Carlo. They reported their numbers. Sandeep Jain, the executive director, joins in to discuss their first quarter earnings and, more importantly, the outlook for this year. Stay with us.
Over the last 25 years, CNBC TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Way to celebrate our own 25th year with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high. We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC TV 18, embarking on a quarter century of excellence.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC TV 18 and cnbctv18.com. CNBC TV 18's most comprehensive and
Welcome back. Textile companies are buzzing around. The uncertainty around Bangladesh is looked at as an opportunity for Indian textile players. Monte Carlo Fashions, of course, is a largely domestic player and has reported their numbers as well. So we'll talk about all of that and also what's taking place in Bangladesh right now and the impact perhaps at an industry level in India. Sandeep Jain, the Executive Director, joins in now. Thank you, Sandeep, for joining in. A comment on, what proportion of global textiles come in from Bangladesh. Could global players now be looking at Bangladesh plus one? Is this a positive for Indian makers? If you could give us a sense of how trade is between the two nations.
Yeah, there is a positive and there is a negative also, because we also export a lot of cotton yarn and cotton fabrics to Bangladesh that might get impacted. But at the same time, we also import, some of the brands import garments from Bangladesh. But yes, because other countries, when they look at Bangladesh, they will definitely look for Bangladesh plus one country. And India is the only alternative which can, substitute Bangladesh in garments.
So what you're saying is that for garments, it is a positive, but for yarn exporters, it may perhaps be a negative, especially cotton yarn exporters, because we are exporting yarn to them, which they in turn are making garments of.
Yes, yes.
All right.
Okay. All right. But Mr. Jain, do we have enough capacity to probably accommodate this change? Because I'm assuming that this change might be more immediate and urgent as compared to, larger changes which happen for different issues. Say, for example, the pharmaceutical space and China plus one. But do you anticipate that India can fulfill that kind of capacity demand, say, on an immediate basis?
Near term, yes, but not for a longer period of time, because right now there is a little bit of slowdown in India as far as garmenting is concerned. So near term, they can definitely take orders. But to substitute Bangladesh, at a larger extent, it's not possible as far as Indian garment manufacturers are concerned.
But why do you say that? What is the key reason or the difference between the two markets that it's difficult to substitute Bangladesh's textile production in India?
See, firstly, I think the production base is much larger in Bangladesh as compared to India. And they're also, I think, the second largest exporter of garments to the world. So we need to build the capacities to fulfill all the demands.
All right, take that point. Thank you so much for giving us an industry perspective. Let's talk about your own numbers itself. The first quarter typically seasonally weak for you as well, because there's a lot of inventory correction that takes place. But basis what you've seen in the second quarter and your outlook for this year, what can you guide us in terms of revenue growth? And also if you could give us a sense of how, some of your new verticals are performing: footwear, kidswear, and the brand like Rocket, which was about 4% of your sales.
Yeah, the second quarter has begun well. July sales have been better as compared to last year. Even August has begun well. So we are very positive going forward in Q2 and Q3. And we see a flat to, a single-digit growth as discretionary spending is, still not happening. And as far as our new brands are concerned, like the Rocket, it's definitely picking up. and performing well as compared to last year. And also the kids wear is performing. And we also have home textiles, which also is growing double digit, even in this financial year also.
Okay. So what can you sense? I mean, what is the entire fiscal looking like in terms of FY25? What do you think your exit rate could be in terms of revenue as well as margins?
In just recently concluded con call, we have guided for a flat to a single-digit growth in this financial year, but there would be a substantial improvement in the margins. We see a margin improvement around 200 basis points as compared to last financial year in EBITDA.
All right. Your North India Kashmir plant, I remember, was supposed to come on stream. What's the outlook out there? Has it come on stream, and what's the capacity utilization plan out there?
No, that plant is cancelled because there has been oversupply, particularly in the blankets and quilt segment. So it makes more sense to buy from the market, which is more competitive now as compared to the past. So we have cancelled that project.
Okay. In terms of segments, since you are, just guiding for around a flat to single-digit growth in FY25, which is the segment which is probably going to pull you down the most? Because if you see your year-on-year performance, your cotton segment has grown, but woolen as well as home textiles has reduced. Kids has done well, but what would be the key growth driver for you for the entire fiscal, and what would probably be the one which would, you anticipate being sluggish?
I think definitely the woolen segment, which is going to bring us down in this financial year. Cotton segment is growing basically. As last year, there have been a lot of inventory correction which happened at the retail level also. So we are, cautious not to make much inventory in winter wear. So that is why we are projecting a flat sales this year. But we may revise our guidance in Q2 once we see the season going ahead, and we may revise it after the second quarter two con call.
Could you clarify on the Kashmir issue now? If you could give us a sense of if you are, doing any sort of major capex in the next couple of years, and also, number of inventory days. If you could give us a sense on working capital days as well, because you're consciously working on reducing the inventory that is there in your books.
The Kashmir project has already been cancelled because there have been some oversupply. And as far as inventory days are concerned, it's around 130, 140 days. And also, the working capital will remain same as last financial year, because we are in a business where we have to supply, almost 50% of our goods in August, September, and October. So we have to build the inventory before we make a supply.
All right, cool. Take that point. Thank you so much, Sandeep, for joining in. A quick, update on your results and a whole host of other industry-related issues as well. Always a pleasure speaking with you. Take a short break, come back, focus on the markets and a lot of individual stocks.
News show India Business Hour drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhan.
India Business Hour live on YouTube at CNBC TV 18 weeknights at 7 p.m.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV 18. Now streaming live 24/7 on YouTube.
Even if the non-farm payrolls labor market data in the U.S. was a bit disappointing, we're really not seeing other economic indicators at all pointing to a recession. And also keep in mind that the labor market is a lagging, not a leading indicator. So we really want to be looking more, say, at PMIs to get a sense of how well the US economy at least is doing.
plethora of events shape up over the last few days, and it's obviously difficult to make sense of everything and put the pieces together. There will be, there are different factors which have been affecting different regions, whether you take Japan or US or maybe even emerging markets for that matter. I think as far as the US is concerned, what we read and what we probably still share as a view, and probably is a continuation of what we, in a way, expecting that, we will probably try and see some correction as far as the inflation dynamics out there are concerned, and some bit of slowing of growth as well. But in the meanwhile, I think what is happening is quite unexpected lines in a way. I would say that because there was this expectation that in the second half of the year, we will probably try and finally see some possibility of rate cuts emerging.
India, I think it would be less a growth scare. People have been talking about valuations for Indian equities for a very long time. Nonetheless, the market kept going up, and if anything, recently compared to many other global markets, it still performed relatively well. But I think now that question is going to become much more pertinent to investors when they see a much less supportive global environment for risk. Markets with high valuations are going to be one of the first things that they look at.
Welcome back. Just want to point out a couple of stocks. Aurobindo should come up for you. That particular stock is in focus because their UGR Unit 2 has now been classified as official action indicated. This took place last evening. It is a site which manufactures injectables, and there are only 2 ANDAs which are approved from that particular site, and hence there is no reaction on the stock. It's around only 1% of their total revenues. So the impact is quite limited for Aurobindo. That's the reason you're seeing the stock just about holding up with a gain of around 0.5%. The other stock doing well is Vijaya Diagnostics, which is reacting very well to its numbers. So that stock is up around 5%. We'll take a break. Up next, commodities. Stay tuned.
Big miss on the US jobs data has triggered recession fears. It's actually the first time labor market data, monthly jobs data in the US has been such a big miss in this particular cycle. And remember, till last week, expectations were that it's going to be, a very moderate soft landing, which will allow the Fed to cut rates. And it's all very well orchestrated. But this could mean that, it's not all under control. And the Fed perhaps is even behind the curve with what they want to do as far as interest rates are concerned. As a result of which, US money markets are now pricing in a 50 basis point rate cut in September and a total of 125 basis points rate cut through the course of 2024. So the benchmark Nikkei is down over 20% in the last 3 days now. And you look at the USD JPY, that has fallen 20 yen to a dollar in the last 1 month. So basically, the currency has gone from 162 to 145 from the beginning of July. That's a massive move for a currency like that in such a short time span. The last time we had this magnitude of a rally, along with interest rate differentials between Japan and the US around 5%, it was back in 1998-99. And of course, we had that sort of LTCM crisis back then. Now, fears of yen carry trade unwinding is essentially reason number 2. So, people borrowing in Japan, very low interest rates, investing around the world. And of course, the yen moving so sharply upsets plans. Stops are hit and there is a forced unwinding which takes place. So that is reason number 2. Number 3, and this went unnoticed under the radar for the first couple of hours when we began trading, but NVIDIA, the big reason why US stock markets have done so well is reportedly delaying its next AI chip Blackwell by at least 3 months. And it was not a coincidence that the Taiwanese market was amongst the worst performer in Asian markets today. and also sort of take a look at the fact that Nasdaq continues to underperform the S&P. So that is, I mean, I think you could blame it on the Nvidia story there. And number 4, I don't think this was a really dominating driver, but geopolitics, right? The political news website Axios reports that attack by Iran and Hezbollah against Israel could start as early as Monday. I would say that what was happening with the currency markets and fears of a US recession were the dominating drivers. This, of course, I mean, if it were to come through, and it's a big one, could hurt at the margin going forward.
Welcome back, and joining us on the show now is Prabhu Damodharan. He's head India Texpreneurs Federation. Mr. Damodharan, thank you so much for joining us. And, after the Bangladesh unrest that we've seen, the knee-jerk reaction or the sentiment clearly seems to be in favor of India, because India is also a huge textile destination in that sense, in sense of apparel imports and exports as well. Apart from a knee-jerk and a sentiment, how do you see these numbers playing out?
Good afternoon, and it's unfortunate to note the internal turbulence of Bangladesh as a friendly neighbor, and we pray and hope for the quick recovery from this kind of a status. Yes, Bangladesh built a robust ecosystem in apparel manufacturing. Their monthly run rate of apparel exports is in the range of $3.8 to $4 billion. Their ambition of achieving $50 billion exports is a commendable one. And due to these incidents, definitely some kind of a setback, at least in terms of sentiments they will face from international buyers. Actually, in the last few years, Bangladesh grabbed more market share from China in the market, particularly in the markets of US, UK and European Union, by using a lot of advantages with their scale and competitiveness. Now, the current incidents will create 3 kind of scenarios. Number 1, the buyers will naturally develop a kind of fear over the delivery times, because in apparel manufacturing as well as in supply chain, delivery times are very crucial. This kind of turbulence will create a small kind of a fear among buyers, and they may try to divert some portion of orders to countries like India, particularly in cotton apparels. And India's monthly run rate is in the range of $1.3 to $1.5 billion of apparel exports. We can also accommodate another $300 to $400 million of additional capacity in a very short period of time. We have capacity available. So those kind of changes may happen in short term. But structurally, Bangladesh also should survive. We also should grow. How is it possible? And definitely both countries should use China Plus One opportunity. This particular incident reinstates the fact that buyers always will prefer multiple destinations instead of depending on a single destination, because risk can be any time. And number 2,
sure. Mr. Damodharan, I just wanted to get in and ask you, when you say that India can increase capacity in a very short period of time, what short period of time are we looking at? Are you looking at this season, because we are into festivities and the international export market is also quite buzzing? What is the definition of this short period?
Actually, ma'am, the larger players already have confirmed orders for the visibility of 3-4 months in India. But still, SME manufacturers have some capacity left, reasonable capacity left with SME manufacturer. We all know that India is predominantly an apparel SME manufacturing ecosystem. So we can immediately take orders. There is no time left, and we can easily accommodate on an instant basis. This is one factor. Second very important factor is we also have a strong export presence in Bangladesh in terms of yarn and our fabrics. Monthly, approximately around 3 crore kgs of yarn we are exporting, including fabrics. Our monthly run rate is around 1,000 crores per month to Bangladesh. Bangladesh don't have a strong manufacturing capability in yarn. So for the apparel export ambition, India is the right partner to supply yarn and fabrics. So quick recovery of Bangladesh is also very important for the healthy operation condition of spinning and fabric sector here. We are hearing from the ground from Bangladesh. They may come back in a week time, at least in the factory operation levels. So that will be good for spinning sector. Once such turnaround happens, yarn demand also will be very strong because already some lackness in production is there.
Fair point. We understand that. Thank you so much, Mr. Damodaran, for sharing those numbers with us. So, well, of course, it's a sentiment positive for India, but not as much because India exports as well in sense of fabric to Bangladesh. So it is in good interest that Bangladesh does come back. But for the next season, for the short duration, of course, India will increase its capacities and be in the positive there. But with that, that's all the time that we have on Halftime Report. Business Lunch will take all the action ahead after this break.
Usually in a session like this, when there is a sell-off across the board, you may wonder that a dip would get bought into, as has been the trend, but sadly that was not the case in today's session. And the benchmark indices, both the Sensex and the Nifty, saw their biggest sell-off since the 4th of June, and as a result of which 15 lakh crore worth of investor wealth was eroded after today's sell-off. And the sell-off was across the board, with 46 Nifty stocks ending in the red, with just a select FMCG stocks and some pharma names bucking the trend in today's trading session. And the sell-off, as I mentioned, was across the board. Metals, media, realty, auto, PSU banks, all of these indices saw drops of anywhere between up to 4% or even more, with metals and real estate being the biggest sectoral laggards in today's trading session. The key point also to watch out for today was the India VIX, and at one point of time the VIX was up almost 52%, and that was the biggest single day jump that it had seen since August of 2015, eventually ending 42% higher and above the mark of 20. That might be a cause of concern.
Stocks see a bounce up after the steep decline yesterday. Realty, IT and capital goods lead the recovery, while financials are the big laggards. Mid-caps outperform.
The rupee continues to hit new lows as FIIs continue to sell shares given the global uncertainty over growth, interest rates and carry trades. The Indian bond yields rise a bit following the US yields, but trading is thin ahead of the RBI policy on Thursday.
And Bharti Airtel turns in an inline performance on the revenue front, but margins dip on pressure in the enterprise business. The average revenue per user also sees just a small tick up.
Sources tell CNBC TV 18 the government is weighing offering grandfathering for long-term capital gains tax on real estate till July 2024. It may also allow both a flat tax and one with indexation as options. No decision is taken yet, but there could be an indication in the finance minister's reply to the parliament.
And the political upheaval in Bangladesh is a fresh spot of bother for consumer companies like Marico, Imami, Bajaj Consumer, and to a lesser extent Britannia, Nestle and Dabur, which have exposure to the market. Paint maker Kansai Nerolac too may feel the pinch. Hello and welcome to Business Lunch. I'm Sonia Shenoy and with me is Hormuz Fatakia. Well, things are looking good. By looking good, I mean after that huge sell-off yesterday, there's at least a relief rally in the market. There's a bit of much needed respite, and all the gloom and doom we saw yesterday has sort of taken a step back, at least for now. But let's see, we still have the second half of the trading session to go, but for now not bad at all, Hormuz.
Not bad at all indeed, and there is some bit of cooling off from the highs as well. So there is, you can sum it up in one word, you can say that the market is choppy. It's not a one-way pullback as you would expect after a fall, as we have seen over the last few months. The Nifty is off the highs of the day, which was around 24,380, almost 200 points now off the highs of the day, but still holding on to gains of around 0.5% as we speak. The indices, most of them are trading with gains, but the Nifty Bank has cooled off as well from the highs of the day. Now it's absolutely flat as we speak. Now 5150 is where the Nifty Bank is. The high of the day somewhere around 5700, so around 600 points of the day's high. At one point had even slipped into the negative had the Nifty Bank, but now is somehow managing to hold on to some bit of gains at least. We still have the financial services expiry today, so that will keep the index in focus towards the second half of the session. But what's staging a rebound though is the real estate index. That is up 2.5%, and that is after it has snapped a 4-day losing streak in today's session. It's also off the highs, but still trading with gains of well over 2%. Sonia, anything that you're spotting on the screen?
Okay, there is of course a lot happening in the broader markets, and it's good to see that the mid-cap index has come back in a big way compared to the frontliners. So the mid-cap index itself is up almost about 600 points right now, and plenty of stocks moving around, 1,700 stocks on the advancing side. But let's begin Business Lunch by focusing on the currency. The rupee touched a fresh all-time low of 84 rupees per dollar before strengthening somewhat to 83.80 to 83.90. Bond yields have also risen a bit. Lata is here to sum up the action in the currency and the bond market. Lata, over to you.
Well, the stock markets gave us a feeling of rebound, but the rupee market is telling us that the foreigners' selling has not abated at all. Actually, on the feared foreign selling and actual selling, the rupee in early trade itself went all the way to 84, and thereafter the Reserve Bank came in and supplied dollars, and it did dilly-dally between 83.80 and 90 for a bit. But it has started slipping since, and although experts tell us that the worst of the carry trade unwind is over, the market is not convinced at all. The flow of the depositories, the custodians, the guys who actually work for the foreign funds, selling and taking away dollars from the market is continuing. And so that sense that yesterday was 10,000 crores of FPI selling, something big is happening even today. One cannot assess the number, but they're not buying bonds, okay? The foreigners are selling equities. There is no selling in bonds. So the uncertainty is there in the market over, is the US in a recession or not? What will the Fed do in terms of timing of interest rate cuts and extent of interest rate cuts? Because the range is huge. Almost everyone has gone from one rate cut expectation in September to at least 3. People like JP Morgan have gone to 7 rate cuts, like 50 basis, 50 basis, and 125 is what they're expecting. So that's 125 basis points cut. The market is full of these kinds of expectations, and also Indian exporters and importers are unhedged because the Reserve Bank has kept the currency in a narrow range. Even when the range shifts, it shifts ever so slowly. So when you're unhedged, there is even greater fear in terms of what you may be exposed to if the global markets are extremely choppy. So markets are in a state of uncertainty, no taking away from that. In the yield market, it has been much more steady. Yields fell just about 6 or 7 basis points yesterday in response to that nearly 20-30 basis point fall in the US. And today they've recovered by all of 3 basis points. You know, it's come up from 6.84 yesterday, the 10-year bond, to 6.87. Fairly steady over there. And of course, over there, action is less because everyone's eyes are fixed on the Reserve Bank's policy that's due on Thursday.
Very interesting updates. We'll keep an eye out on the number that comes in later this evening for the FIIs. Lata, thanks a lot for that. By the way, the flash on your screen, Symphony has approved a buyback of its shares at around 2,500 rupees. The stock is around 1,500. The stock is showing up on the price as well, 17.5% higher now as we speak. You know, there's been a rush of these buybacks ever since these rules were amended in the budget by the finance minister. Almost 11 companies have announced buybacks since then. And Symphony now 18% higher after the announcement of that buyback. But shifting focus now to another top story. Now, in the latest turn of events from the subcontinent, Bangladesh's military has taken caretaker control of the country after Prime Minister Sheikh Hasina resigned and fled to India. She is currently at the Hindon Air Base near the national capital. Weeks of mass protests forced her out, ending her 15-year rule. Now, Foreign Minister S. Jaishankar chaired an all-party meeting this morning to discuss the political turmoil in Dhaka and brief top leaders about the tensions fuming in the neighboring country.
Okay, well, lots happening there. In fact, we have Parikshit joining us now to give us the latest on this front. Parikshit, over to you.
Well, yes, the latest update that we can share with our viewers is that External Affairs Minister Subramaniam Jaishankar briefed an all-party meeting. Opposition leaders were there and he informed them that Sheikh Hasina is in shock right now. They are allowing her to come to terms with what has happened and they're offering her full support at this juncture. India has also established contact with the Army Chief of Bangladesh to ensure safety of about 10,000 Indian students who are still there in the country. Almost 8,000 were brought back in the last 1 month, but 10,000 still remain. On the question of whether there could be foreign interference in the fall of the government in Bangladesh and the riots and the violence that we saw, Jaishankar apparently told the all-party meeting that one cannot rule out a foreign hand. At the same time, we must tell our viewers that there is a consensus among the opposition to support the government right now in this stand against for Bangladesh at the moment and support to Sheikh Hasina. Now, as far as her asylum is concerned, India is silent on her status. She is in a safe house at the Indian Air Base. We believe that she intends to go to London or Finland or another European country, but talks still continue. She has not been given approval to travel to any of these countries at this juncture. In fact, the UK Home Office, replying to our query about whether she has asked for political asylum and whether she would be allowed to travel to UK, they went on to say that they have advised everyone, and this is not just for Sheikh Hasina, to actually travel to any country where they can reach safely first, and they do not allow people to actually travel to UK and then seek political asylum. So clearly things are up in the air for Sheikh Hasina right now. Talks are still underway with different countries. NSA Ajit Doval has called on her as well, and protests continue in Bangladesh. Muhammad Yunus, the Nobel laureate, somebody who has been known as the banker to the poor, he has been announced as the advisor to the interim government. Let's see what happens in Bangladesh now.
Interesting developments. We'll keep an eye out on all of that. Parikshit, thanks a lot for joining in. Now, there are plenty of Indian companies as well that have an exposure to Bangladesh, and Mangalam is now joining in to give us an overview of how this political turmoil is affecting these companies. Mangalam.
Well, let's talk about stocks which are moving the most. We start with Marico, which is the top F&O loser in today's trading session, and that's largely because we have a fair amount of exposure to Bangladesh. When it comes to the FMCG stocks, Marico has the largest. Around 44% of their export exposure or international revenue comes in from Bangladesh. International revenue alone accounts for about 25% of their sales, so making their Bangladesh exposure to about 10 to 11%. Remember, the results of the company were good. The stock was well bid up, so maybe the incremental pressure of long unwinding has the stock lower by 5%. Analysts believe that this could impact their overall annual revenues by no more than 1 to 2% itself. The other one that we're looking at are a bunch of these garment makers. It's interesting times. Until last year, we were talking about the China plus one factor. Now, maybe because of its big, exposure to Bangladesh, a lot of these garment manufacturers will be looking at India as a hub as well, which explains why there is a big move on names like Kitex Garments or Gokaldas Exports, etc. Because all these international players will now look at exposing themselves beyond Bangladesh. So the Bangladesh plus one factor playing out as well. The other couple of stocks that we're looking at, we have VIP, which has its capacity in Bangladesh, about 30-35% coming in from there. They have their results today, so commentary around Bangladesh would be extremely crucial to track as well. That stock too under a wee bit of pressure. For all the other FMCG companies, their exposure to Bangladesh is limited, sub 5%, in most cases around 2 to 3% itself. And the prospects of better rural recovery actually are taking away from any sort of Bangladesh related concerns, which is why all the other FMCG stocks are doing well in today's trading session. And finally, we have Trent and Jubilant Food as well. Trent gets some of its orders from Bangladesh among all the other countries as well. So there could be a bit of a supply disruption. And Jubilant Foodworks has about 28 Domino's stores in Bangladesh, accounting for 1% of their consolidated sales. But the recovery in India is something that the street is eyeing, which is why that stock too higher today.
All right, thanks a lot, Mangalam, for that. Let's focus on the real estate sector now. Will the Finance Ministry review the new LTCG regime for realty? Shireen is joining in now with exclusive details on the same. Shireen, over to you. The blowback and the criticism with respect to the announcements that came in for the budget was specifically focused on the removal of the indexation benefits when it comes to the long-term capital gains regime, specifically for real estate. As my colleague Timsy has also been reporting, and what we are given to understand at this point in time, the options that are being considered by the Finance Ministry, the one that the Finance Ministry seems to prefer is the grandfathering option. Whether it will be grandfathered till 2024, July 2024, or perhaps a year beyond that is the question that remains unanswered. But what we are given to understand is that a final decision is yet to be taken. The other option, and that is what we've seen happen even as far as the tax regime is concerned. The old tax regime continues to coexist with the new tax regime, given the option to consumers, to taxpayers, to switch depending on what they feel they most prefer. So will that be the preferred route that the government decides to take forward? We don't know yet. But again, a decision has not been taken. But these are the two options on the table that are being reviewed at this point in time. Now, remember, again, to take our viewers back to the conversations that we've been having, including with the Finance Minister and the Finance Secretary, when I put this question to the Finance Minister a few days ago, asking if the government was considering a review or any kind of amendments, the Finance Minister had said that she would speak only in Parliament because the Finance Bill is now the property of Parliament. And when I'd asked the Finance Secretary had said that in his view, in his personal view, there was no need for a review, but he did make it clear that it was eventually going to be a political decision. So remember, the Finance Minister is expected to reply to the Finance Bill in Parliament. It was expected today. We're given to understand that's now likely tomorrow. But these are the options at this point in time. If any relief is provided, it's likely to be restricted to the real estate sector for the purposes of providing some relief that taxpayers felt was necessary on account of the indexation benefits being done away with. A final decision, though, is awaited.
Shireen, thanks a lot for that update. All eyes on the Finance Minister now. Time for a short break here on Business Lunch. Up next, we'll focus on the global markets and whether the recession fears could price in a higher rate cut by the Federal Reserve. Stay tuned, back on the other side. There were, of course, global-facing stocks that took a bit of a beating in today's session. Tata Motors was one of them, 7.5% lower, the top Nifty loser. And the other one was Samvardhana Motherson as well. That stock ended 10% lower, of course, because of the relations to the Japanese markets as well. 600 stocks, almost 600, 580 to be precise, on the BSE, ended on a lower circuit in today's trading session. And of course, as I mentioned, there were select FMCG and pharma names that bucked the trend. Marico was one, Glenmark Life was the other, Devyani International, after its earnings today, ended in the positive. So that was a good sign. And lastly, on the commodities front, the crude oil prices have fallen to a lowest level in 6 months. And of course, copper prices are at a 4-month low. There were specific sectors that bore the brunt of the sell-off today. Real estate was one of them. Almost every index constituent ending lower. The top losers there being Suntech Realty, Brigade Enterprises, Godrej Properties, all of them seeing losses of between 5.5% to 6.5%. Railway PSUs are bearing the brunt as well. IRFC, IRCON, RVNL down at least 25% now from the peaks that they made last month. Defense PSUs, a similar story playing out there as well. Mazagon Dock, Cochin Shipyard, Garden Reach, all of them ending lower, almost 5% or more. And metals having a meltdown in today's session. The metals index also was down nearly 5%, 6.5% lower for SAIL, similar for Nalco and Jindal Stainless, 7.5% lower in today's session. So all in all, red across the screen, and there was no sign of any sort of support at lower levels.
My wife, for instance, and she's been such a big contributor in what I've become eventually. I think some of the soft skills actually, and these are aspects, and the ability to without getting sort of stressed, being able to manage many different things. I'll just give you one example. When I was a CA, typically, and many of the advisors, the Indian Economic Service actually are women. They would be in a meeting with me maybe at 3:30, 4 or something, and they'd get these calls actually, and they would be, because they're in a meeting with me, they would be, declining those calls. If the call comes twice or thrice, I knew this was actually either their kid or their mates calling basically for what needs to be made for dinner. Yeah. And so because that's exactly what, my wife, so when I was at ISB, it's the rare occasions when she was not instructing our kids or the maid to actually say what needs to be cooked. My kids would call me up. I would be at a loss actually.
Believe in your strength, right? What is your strength? Carry that, right? It is your deep technical knowledge, your perspective, because that's where the new ideas generate, right? So keep focusing on that. That is one thing that will give you a purpose. Second thing is networking, right? Network with people whom you come across, building the network where you can share your ideas, express them, trash them out. That is one thing which is going to be very, very helpful as you go ahead. Third thing, I will have to say that keep learning, right? Our industry is about change. It's just a lot of innovation every day. Even actually, sometimes it is impossible to catch up with everything. So keep learning. Wherever is an opportunity, learn it, right?
Welcome back to Business Lunch. Well, it was a dramatic Monday for Wall Street as stocks took a sharp fall. This has also pushed investors to price in a 90% chance of a 50 basis points rate cut in September. There is even a chatter of an emergency cut playing out. CNBC's Steve Leisman has more on that.
Dramatic moves in the outlook for the Federal Reserve and rate cuts in the wake of the global sell-off in stocks that started in Japan and picked up steam in the U.S. Chicago Fed President Austin Goolsbee telling CNBC that markets are reacting more strongly than the Fed is likely to.
If you look at how the market reacts in its predictions of the Fed funds rate, there's a massively more volatility in the market reaction on a day-to-day basis than in what the actual moves are.
Futures markets still priced in a very aggressive Federal Reserve with an 84% probability now of a 50 basis point cut in September, 61% probability of a 25 in November, and then another 50 likely in December and a 25 in January. Add it all up, and a total of 150 basis points of rate cuts are priced in over the next 4 meetings. That would bring the funds rate down to around 4% from the current level of 5.38. Goolsbee wouldn't rule out an emergency cut for which there is some pricing now in markets, but he also didn't say it was imminent.
The Fed's job is very straightforward. Maximize employment, stabilize prices, and maintain financial stability. That's what we're going to do. We're forward-looking about it. And so if the conditions collectively start coming in that on the through line, there's deterioration on any of those parts, we're going to fix it.
So the forces at play on the economy and in markets include the unwind of the dollar-yen carry trade, a carry trade for which there is no real knowledge of how big it is and how long it might take to unwind, and including in that a tech stock overvaluation and a Federal Reserve that many think is now behind the curve of the economy and financial markets. How far behind the curve is the pressing question, and whether the Fed needs to react to the tech sell-off or the unwind of the carry trade is an unknown proposition. That is, it should and will likely focus more on where rates ought to be relative to economic fundamentals.
Okay, let's take a short commercial break for now. When we return, we'll get you all the updates from the Olympics underway in Paris currently. Stay tuned for that.
Not least, resilience, right? Don't get disheartened by a failure, right? Failures will happen, learn from it.
One particular moment, so I actually come from a very humble background. My father lost his father when he was just 7 years old, and just completed school. I was the first person in my clan to go to university. So when he first came to campus, and I took him to the library, the Vijay Kelkar library there. I remember him actually being very emotional and saying, at least in my next life, I get the opportunity to study in a university like this. So that moment is something which is etched in my memory. I'll be absolutely honest, I did not even know what a chief economic advisor is at that time. If somebody said I'll be X, Y, or Z, or even executive director, I don't think even I knew what the International Monetary Fund was.
I came here in 1991. 1991, that was my first year of college. I came here for Inter-IIT. So I remember this campus especially, because this is one thing that I think especially the women need to hear. So I was, good in table tennis, but I became the captain because my captain dropped out. And I came here and we were playing and I won the first game. And then all the men started booing me.
Are you serious?
Yeah. And so I realized the power of mind, right? Like, I was better than the player that I played against, but I lost. And I think that was my first lesson that I learned, which is that, you might be better, but sometimes, your circumstances make you believe you're not, and therefore you lose. So I think that's one thing that everybody needs to do, and I think coming back to this campus...
We have to correct that. We have to give her a big round of applause now to make up for what happened in the past.
Yeah, but my coach also gave me gajar ka halwa, so it was okay.
Today, she is the director for the mission that actually saw India's first private rocket being launched. So tell us a little bit more about that, Saranya, and what, you did that all under 30?
They gave me an opportunity to be the vehicle director for the mission. So it was a huge learning for me to build. We started off the company by at least when I went in, I didn't know anything about the rocket building. So to building a vehicle which can actually fly, it was amazing.
Not just actually fly, it's actually flown.
Yeah.
So congratulations to you and to the entire team at Agnikul. I know for many of the students here in the room, you're a role model, but you talked about Naveen being the initial role model for you when you got started. But let me end by asking you, who do you look up to today? Which are the companies that you respect and admire? And, is there anyone in specific that you like to emulate in your style of working?
The one individual that I have, I wouldn't say seen in very close quarters, but seen from some distance as part of my work in CI.
Back with us here on Business Lunch. Now, high hopes continue for Team India in Paris after Avinash Sable made it through to the finals of the 3,000-meter steeplechase, the first Indian to qualify for a track and field event final after Neeraj Chopra, of course. But while Lakshya Sen lost a hard-fought battle to win the bronze medal to Malaysia's Lee Zijia, day 11 of the Paris Olympics is set to kick off with India's golden boy Neeraj Chopra all set to take the stage today in the men's javelin qualification round, while the Indian hockey team is looking to improve its medal standings in the semi-final against Germany, and wrestler Vinesh Fogart will open India's Paris campaign in the women's 50 kg freestyle.
Okay, all the best to Team India, and we're going to, of course, have lots of sporting action later in the day. So that's that from the Paris Olympics. But disaster management and relief operations are still underway in the landslide-ravaged regions in Wayanad district of Kerala. Reliance Foundation has announced a multi-pronged approach to support the people of Wayanad in coordination with the government authorities and the disaster management teams. The Reliance teams are delivering immediate relief to people located in camps, including milk and fruits for essential nutrition. Over the next few weeks and months, Reliance Foundation has committed to holistic, immediate, mid-term and long-term support for the severely affected district, along with sustainable initiatives to address prevention, strengthen early warning and early action.
Reliance Foundation there on the ground in Wayanad. But with that, it's a wrap on this edition of Business Lunch from Sonia, me and the team that put this show together. Thank you so much for watching. Midcap Radar up next.
Is Mr. Uday Kotak. I think he has built a franchise in a bank that is truly outstanding. And to do it in one generation, and the quality of talent and the kind of ownership that that talent takes is remarkable.
Finance Minister Nirmala Sitharaman is just a few hours away from marking a new record. The CNBC TV 18 coverage of the Union Budget starts right now.
Hello and welcome to CNBC TV 18 Motilal Oswal Budget Headquarters. Markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Over the last 25 years, CNBC TV 18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive.
Good afternoon. Welcome to Midcap Radar. I'm Sonal Bhutra. With me, as always, is Vivek Iyer. Earnings are coming in thick and fast. We'll discuss that in greater detail. For now, markets staying in the green. The Bank Nifty, though, has just slipped into the red, so at the flat line. But a lot to discuss today.
Good part is, the mid caps and the small caps outperformed, so that's the good part. But quite a lot lined up on the show. We have the result of Shree Cements as well. That we'll address that as well. Let's start off with the top headlines. Stocks bounced after the steep decline yesterday. Realty, FMCG and metals lead the recovery, while financials are the big laggards. Mid-caps outperform.
Indian garment makers, Gokuldas Exports and others surge as the companies become beneficiaries of the disruptions in Bangladesh, as global companies may look towards the Bangladesh +1 supply chain as an opportunity.
Marico shares fall nearly 4% despite a good quarter. The stock is under pressure following the political turmoil in Bangladesh. 44% of the company's international sales comes in from the neighboring country.
Realty stocks surge as sources tell CNBC TV 18 the government is weighing offering grandfathering for long-term capital gains tax on real estate till July 2024. It may also allow both a flat tax and one with indexation as options. No decision is taken yet, but there could be an indication in the finance minister's reply to the parliament.
Sirma is under pressure after reporting a weak Q1 FY25 set of numbers. Gross margin along with profit after tax decline. Stock is down over 4% today.
Okay, all right, those are the top headlines for the Nifty. It has come off from the day's high, so 99 points higher on the Nifty right now. But as I said, the opening gains, they have been sold into. The Bank Nifty is in the red right now. Mid caps are doing well, 0.9% higher there. The small cap index is also doing well. We do have earnings which are coming in. Symphony, for instance, is locked in upper circuit. We'll discuss that in greater detail. But a lot to track and a lot of discussions lined up as well. But again, it's the same thing. One day down and one day up. That has been the story.
So, the only thing that's going up continuously is actually the VIX index, which is the volatile index is what is doing very well in the last couple of trading sessions. But Hormaz is standing by at the wall and he's standing there to take us through all of the mid-cap stocks that are moving around in the session.
Plenty of movers in the broader markets. That does not appear to be a lot of confidence at higher levels for the benchmark indices, which is why the gains are getting sold into. But stock-specific activity continues, and the RPSG group stocks, two of them in particular, First Source and PCBL, continue to scale newer highs, although both of them are off the highs of the day, but still trading with gains of anywhere between 4 to 9%. Welspun Living, the record date for the buyback was yesterday, 6.5% higher today, and Jyoti Labs is having a good day in today's session. Real estate is staging a comeback in today's session. It snapped a 4-day losing streak today, and Godrej Properties, Brigade and Prestige Estates having a good day at the office in today's session. Some of the other stocks, the link to the Bangladesh political crisis, Marico is trading lower, almost 5% down. Now, Gokuldas Exports is having a good day, as is SP Apparels, Vardhaman Textiles, all of them seeing gains of anywhere between 8 to 17% in today's session. Some stocks doing well on the back of volumes, and KPR Mills is one of them, Serra Sanitary Ware as well, and DCM Shriram seeing gains of 3.5% on the back of strong volumes. And lastly, some earnings impacts in today's session. BLS International, 12% higher now at the highest point of the day. Schneider Electric, Triveni Turbine and Symphony, after the buyback that it announced at over 100% premium to Monday's closing price, is now trading with gains of almost 20%. Back to you guys.
Okay, yes, big gains there. Earnings, the impact can be seen. Thank you so much, Hormaz, for joining us. Let's welcome Shrikant Chauhan from Kotak Securities for a technical check on the markets. Shrikant, good afternoon. Thank you so much for joining us. Well, what's the mood of the market now? We did see massive opening gains, but we have seen some cooling off from those levels as well. Will we see some consolidation at these levels? What are the charts suggesting?
Yeah, good evening, Vivek. Good evening, Sonal. I think market is like going to consolidate, because the way it has fallen from the highs of 25,000 to almost 24,000. It was a vertical fall, and in a very short span of time, we saw these levels. So most of the time, whenever we see such type of sell-off in the market, we see some more liquidation or some like profit taking at important resistance level. And yesterday, when the market opened lower, that time the highest level was somewhere close to 24,350, 360 levels. And from there only today, we are seeing some, again, the reaction in the market. So I am of the view that the market is going to consolidate between these levels. And most of the time, whenever there is like uncertainty in the market, we saw 100-day simple moving average acting as important support level for the market. So this time, this 100-day simple moving average is around 23,500, 600 levels. And I'm of the view that the market can correct up to those levels. So that's the overall view. But yes, it's a overall trend of the market is bullish, and the strategy should be to buy on dips. But this time the strategy should be to buy little deeper. I'm to say deeper on the correction side.
Srikanth, so you suggest that wait a little bit before going in. But anything you have for our viewers in terms of what they could look at currently? Any long or short trades?
Yeah, I think Vivek, most of the stock have rallied extremely close to their extreme levels in a very short span of time in last, let's say, few months. Supreme Industry was somewhere close to 3,500 levels in the month of March. From there, all the way it moved to 6,500. And now again is back to the levels of 5,100, 5,200 levels. So from here, I'm expecting stock to move towards the levels of 6,000 or 6,200 again. It's attractive buy at current levels. It is very close to its important support levels. So Supreme Industry is a buy at current levels with a target of 6,000. We can keep stop loss if there is any trading position, then close to 4,800 levels. And the other stock, which we like, is Castrol. The reason is because it has spent a lot of time above the levels of 240, and from there we saw the rally up to 270, 75. But now again, the stock is coming back to those same levels. I'm of the view that it's a buy. Currently, the risk reward ratio is quite favorable for the stock. It's a buy at current level with a stop loss close to, let's say, 240. I'm expecting stock to move back to the levels of 275 or 290.
All right. Thank you so much, Srikanth, for joining us, giving us your individual picks. We'll step into a break now. Atul Ganatra from Cotton Association of India will join in on the other side to discuss the impact of Bangladesh crisis on Indian textile and the cotton sector as well. Stay tuned.
Decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Way to celebrate our own 25th year with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high. We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC TV 18, embarking on a quarter century of excellence.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV 18 and cnbctv18.com. CNBC TV 18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart.
Welcome back. You're still tuned into Mid-Cap Radar. The big story now, the political crisis in Bangladesh is likely to benefit the Indian textile industry as international buyers may shift focus to alternative markets like India. Indian garment makers, Gokuldas Exports, Lux Industries, Nitin Spinners, all of them are trading higher. These are considered to be the beneficiaries of the Bangladesh Plus One supply chain. We spoke with Monte Carlo Fashions and head of Indian Textpreneurs Federation, and both believe this crisis will be sentiment positive for India. Listen in.
There is a positive and there is a negative also, because we also export a lot of cotton yarn and cotton fabrics to Bangladesh that might get impacted. But at the same time, we also import, some of the brands import garments from Bangladesh. But yes, because other countries, when they look at Bangladesh, they will definitely look for Bangladesh Plus One country. And India is the only alternative which can substitute Bangladesh in garments.
Bangladesh built a robust ecosystem in apparel manufacturing. Their monthly run rate of apparel exports is in the range of $3.8 to $4 billion. Their ambition of achieving $50 billion exports is a commendable one. And due to these incidents, definitely some kind of a setback, at least in terms of sentiments they will face from international buyers. The buyers will naturally develop a kind of fear over the delivery times, because in apparel manufacturing as well as in supply chain, delivery times are very crucial. This kind of turbulence will create a small kind of a fear among buyers, and they may try to divert some portion of orders to countries like India, particularly in cotton apparels. We also have a strong export presence in Bangladesh in terms of yarn and our fabrics. Monthly, approximately around 3 crore kgs of yarn we are exporting, including fabrics. Our monthly run rate is around 1,000 crores per month to Bangladesh. Bangladesh don't have a strong manufacturing capability in yarn. So for the apparel export ambition, India is the right partner to supply yarn and fabrics. So quick recovery of Bangladesh is also very important for the healthy operation condition of spinning and fabric sector here. We are hearing from the ground from Bangladesh, they may come back in a week time, at least in the factory operation levels. So that will be good for spinning sector.
Well, we just heard from Monte Carlo Fashions and the Indian Textpreneurs Federation about how this particular development in Bangladesh could impact the Indian cotton and yarn ecosystem. To discuss more on this, we have Atul Ganatra, the President of the Cotton Association of India, joining us now. Good afternoon, Mr. Ganatra. First of all, thank you so much for joining us. Give us your first take on how this particular development can impact the Indian ecosystem.
Yeah, good afternoon. Accordingly to me, there will be no much of impact on these issues. In fact, for cotton, as far as cotton is concerned, we are doing export to Bangladesh, but it is the end of season, so no much impact of cotton will be there. There will be a little impact on yarn exporters will be there, but it is a very big positive news for the garment industry, and I believe garment industry will do very good, and the lot of international brands which are buying at present from Bangladesh, they will turn to India due to this. Again and again, there is certain issues are coming. So I feel there will be a shifting of international big brands from Bangladesh to India. And that will be a very positive news for Indian garment industry. If you look at today, this news, our industry is taking it positively, because if you see most of the stocks of the garment industry and textile industry like Nitin, KPR, Vardhman, Welspun, Alok, SP, and many more are doing today 5 to 15% stocks are up. So I believe this will be a very positive for the Indian garment industry. Also, Bangladesh is dumping lot of cheap rate clothes to Indian market. And if that will be stopped, that will be also benefit to Indian cloth market. Yes, please.
Okay, all right, we'll get that. Thank you for your insights here. Mr. Ganatra, I wanted to understand, we were speaking to Monte Carlo as well today. They indicated that it will be negative for the yarn industry maybe because if a lot of it goes to Bangladesh, and now that some of the factories would be shut, that would mean excess supply in the country itself. I wanted to understand if there's any data of how much cotton and yarn do we export to Bangladesh. You're saying it's end of the season. What are the estimates that we have for the next season in that case?
Yeah. You see, this year, Indian export, cotton export will be around 28 lakh bales. Out of this, 20 lakh bales will be exported to Bangladesh. And our almost quota of Bangladesh is already done. And it is now slack season. Coming 2 months, it will be no much cotton exports will be there to the Bangladesh. Our new season will start from 15th October. And I hope till that Bangladesh situation will improve. But about yarn, you see, Bangladesh don't have any raw material, much of cotton. They are not having any cotton growing in the country. They are depend on India, USA, Australia, Brazil. As far as yarn, we do 25 to 30% of our yarn export to mainly to the Vietnam, Bangladesh and China. But if yarn export will little slow down, but our cloth and garments movement will improve far better than what we are doing now. So one side there will be a little drop, but other side we are expecting this will be a very much positive to our textile industry.
Mr. Ganatra, a two-part question, as a follow-up to that. Number one, how do you see prices of cotton as well as yarn, moving at least in the near term on the back of this sudden development that's happened? And number two, while you say it is a positive for Indian garment manufacturers, can you quantify it in some form for us in terms of, what is it that currently India gains, from the overall export market, and where can they take it higher up to?
Yes. You see, Bangladesh problem is, they don't have any raw material. They do import of maximum raw material like cotton, yarn, etc. Only benefit to the China, Bangladesh, is their labor is cheap and power is cheap. But now after this new power policy has come, lot of Indian mills also, they are also having captive power. So our power also is comparable with Bangladesh, and our quality and quantity what we can offer, that will be, and the consistency will be there from the India. So I think lot of buyers will shift from Bangladesh to India. As far as cotton is concerned, the rate difference between ICE and Indian cotton, we are now, as on today, ICE future is at 68 cent, which is around 46,000, and Indian cotton is at 57,000. But ICE cotton future is of December month, and this future is only of 26.5 mm, which is a short staple. And against that, our Indian cotton rate is 29 mm, which is much superior cotton. If we have to compare anything with the Indian cotton, we have to compare Cotlook index, which is around 80 cent. And if we add 11% import duty, still our Indian cotton is cheap and best. Yeah.
Okay. All right. Thank you so much, Mr. Ganatra, for joining us today and giving us all those details. So largely it's positive for the Indian garment industry. The cotton industry does not get impacted too much. The yarn industry may be a bit of a negative because the exports to Bangladesh could be impacted. TVS Motors numbers flashing for you. It's largely an inline set versus the pole. Margins at 11.5%, which compares with the pole of 11.5%. The profits also absolutely in line with estimates. The stock is holding in the green, up around 0.8%. Of course, we'll get Sonia with more details on this one as well. For now, the stock is at the day's high. We'll slip into a short break. When we come back, we'll get you more on the markets and put focus on Symphony. The stock is up 20% after reporting its Q1 earnings. Stay tuned for that.
The top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC TV 18 weeknights at 7 p.m.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV 18. Now streaming live 24/7 on YouTube.
Even if the non-farm payrolls labor market data in the US was a bit disappointing, we're really not seeing other economic indicators at all pointing to a recession. And also keep in mind that the labor market is a lagging, not a leading indicator. So we really want to be looking more, say, at PMIs to get a sense of how well the US economy at least is doing.
plethora of events shape up over the last few days, and it's obviously difficult to make sense of everything and put the pieces together. There will be, there are different factors which have been affecting different regions, whether you take Japan or US or maybe even emerging markets for that matter. I think as far as the US is concerned, what we read and what we probably still share as a view and probably is a continuation of what we, in a way, expecting that, we will probably try and see some correction as far as the inflation dynamics out there are concerned, and some bit of slowing of growth as well. But in the meanwhile, I think what is happening is quite unexpected lines in a way. I would say that because there was this expectation that in the second half of the year, we will probably try and finally see some possibility of rate cuts emerging.
India, I think it would be less a growth scare. People have been talking about valuations for Indian equities for a very long time. Nonetheless, the market kept going up, and if anything, recently compared to many other global markets, it still performed relatively well. But I think now that question is going to become much more pertinent to investors when they see a much less supportive global environment for risk. Markets with high valuations are going to be one of the first things that they look at.
Big miss on the US jobs data has triggered recession fears. It's actually the first time labor market data, monthly jobs data in the US has been such a big miss in this particular cycle. And remember, till last week, expectations were that it's going to be, a very moderate soft landing, which will allow the Fed to cut rates. And it's all very well orchestrated. But this could mean that, it's not all under control.
Welcome back to Mid-Cap Radar. The stock in focus is Symphony. The stock has hit the upper circuit after reporting a strong set of numbers, and the company has also announced a buyback. Vamakshi is here with more details.
Well, absolutely. It's a very strong set of numbers coming in from Symphony. Revenue has surged by almost 76%. The gross margins have improved by almost 100 basis points to 51%. But the operational performance of the company is stellar. The margins have risen from 8.6% to 21% roughly. And as a result, the EBITDA has surged from 26 crores to 111 crores. This in turn is also driving a very huge jump in the net profit as well, which has gone up from 24 crores to 88 crores. But apart from a very strong set of numbers, like you rightly pointed out, Vivek, the company has gone ahead and announced a buyback. They said that the board has gone ahead and approved a buyback for up to 71.4 crores, and they will be buying back 2,85,600 equity shares at a price of 2,500 per share, which, as you can see, is coming at a significant premium to the current market price. But it is important to note that that the buyback price does seem attractive, but it is important to look at it in context of the acceptance ratio. The acceptance ratio stands at 0.41%, which implies that only 4 shares out of 1,000 shares will be bought back, and even in the event that the promoter does not participate in the buyback, the acceptance ratio is still very low at only 15 shares for every 1,000 shares held. So overall, while the buyback price may seem attractive, the upside for retail investors may be limited. So definitely Symphony in focus on the back of strong set of numbers and the buyback that they have announced.
Thank you so much for that, Vamakshi. So number one, it's a very strong operational performance from Symphony, no doubt about that. But also, thank you for tempering the expectations in terms of the buyback, the actual quantum, and what is it that a retail shareholder will be able to actually tender and will get accepted. But one more stock on the radar is NCC. Just around 15 to 20 minutes ago, the company reported its Q1 set. Operationally, it appears that NCC delivered a strong set of numbers. But the one thing to keep on mind is the order inflow. The Q1 order inflow is just around 400 crores, while the company had given an order inflow guidance for FY25 in the range of 20 to 22,000 crore. So it appears as though a lot of heavy lifting would have to be done Q2 onwards by the company. Q1, remember, across the entire infrastructure space has been muted in terms of order inflow activity on the back of the elections. But that's all the time we have on this edition of Midcap Radar. Mutual Fund Corner when we return.
The Fed perhaps is even behind the curve with what they want to do as far as interest rates are concerned. As a result of which, US money markets are now pricing in a 50 basis point rate cut in September and a total of 125 basis points rate cut through the course of 2024. So the benchmark Nikkei is down over 20% in the last 3 days now. And you look at the USD JPY, that has fallen 20 yen to a dollar in the last 1 month. So basically, the currency has gone from 162 to 145 from the beginning of July. That's a massive move for a currency like that in such a short time span. The last time we had this magnitude of a rally, along with interest rate differentials between Japan and the US around 5%, it was back in 1998-99. And of course, we had that sort of LTCM crisis back then. Now, fears of yen carry trade unwinding is essentially reason number 2. So, people borrowing in Japan, very low interest rates, investing around the world, and of course, the yen moving so sharply upsets plans. Stops are hit and there is a forced unwinding which takes place. So that is reason number 2. Number 3, and this went unnoticed under the radar for the first couple of hours when we began trading, but NVIDIA, the big reason why US stock markets have done so well is reportedly delaying its next AI chip Blackwell by at least 3 months. And it was not a coincidence that the Taiwanese market was amongst the worst performer in Asian markets today. And also take a look at the fact that Nasdaq continues to underperform the S&P. So that is, I think you could blame it on the NVIDIA story there. And number 4, I don't think this was a really dominating driver, but geopolitics, right? The political news website Axios reports that attack by Iran and Hezbollah against Israel could start as early as Monday. I would say that what was happening with the currency markets and fears of a US recession were the dominating drivers. This, of course, if it were to come through and it's a big one, could hurt at the margin going forward.
Usually in a session like this, when there is a sell-off across the board, you may wonder that a dip would get bought into, as has been the trend. But sadly, that was not the case in today's session. And the benchmark indices, both the Sensex and the Nifty, saw their biggest sell-off since the 4th of June. And as a result of which, 15 lakh crore worth of investor wealth was eroded after today's sell-off. And the sell-off was across the board.
Hello and welcome to MF Corner. I'm Sonal Bhutra in the Mumbai studio. In our Tuesday special today, we try and simplify two different subjects for our viewers. First up, with Shweta Rajni of Anand Rathi Wealth, we discuss all about investing in gold, the approach post the import duty cut, the view amid geopolitical tensions, and also the most debated, equities versus gold. Where should you invest? On the other side of the break, we'll discuss and make our viewers understand about the tax benefits to retail mutual funds in Gift City for NRIs and foreigners with Jay Kothari of DSP Asset Managers. So, power pack show. Let's start again with Shweta now. Thank you so much, Shweta, for joining us today. And there have been so many changes in the budget session, right? So let's discuss that first. How does the recent budget amendment impact gold ETFs and gold funds? And how does a gold ETF differ from gold fund after this change?
Sure. So, what I'll do is I'll start with explaining the difference between a gold ETF and a gold fund. When you're buying a gold ETF, you're buying it at that current gold rate. It, in effect, means that, you're buying one transaction is 1 unit of 24 karat gold being purchased. Whereas in a gold fund, you're ultimately, it's again investing into a gold ETF. So it's kind of a fund of buying an ETF. Gold ETF from a cost perspective is more efficient than a gold fund. ETF means you can exit any time. In a gold fund, generally you have an exit load. Coming to the tax, which has basically changed. Earlier, from 1st April 23 onwards, if you invested in a gold ETF or a gold fund, it meant irrespective of the holding period, you would be taxed at your slab rate. Post the budget changes, if you have invested into a gold ETF and your holding period is more than 12 months, it will be categorized as long-term and will be taxed to you at 12.5%. Whereas in a gold fund, if you hold it for 2 years, then it will be considered as long-term and taxed to you at 12.5%. Anything below that is short-term and taxed at the slab rate. So actually, post the budget changes, gold ETF becomes more tax efficient as compared to a gold fund. However, if you're looking at flexibility in terms of, wanting to do SIP investments or a few other things, then you have to choose. But from a tax perspective, ETF is better than a fund.
Okay, so let's talk about all of these asset classes together. What do you prefer? Sovereign gold bonds, gold ETFs, or gold funds? Can you explain what works for each category? And if someone has to pick one, which one would that be?
So, my vote, irrespective of which category you are as an investor, would be towards a sovereign gold bond fund. And the reason I say that, one is in a sovereign gold bond fund, from a tax standpoint, if you hold it on till that 8-year maturity period, and then on the maturity, the capital gains are tax-free for you. Second benefit of a sovereign gold bond fund is that apart from the gold price movement, you also benefit from a 2.5% of interest payment coming to you every year, which is taxed to you at your slab rate. So one, it gives you not just gold returns tax-free, it also gives you an additional return. However, the downside is it's not liquid, so you'll have to hold it on, in most cases, till the 8-year period. So if you have that time horizon, I would vote for going in for an SGB.
Okay, all right. So sovereign gold bonds still, after whatever changes have come, continue to remain the top pick when it comes to investing in gold via different ways. What about physical gold, Shweta? The import duty cut, but that has reduced the final price for those who invested some time back. So it has happened with sovereign gold bonds as well. But how do you look at this particular way of buying gold or investing in gold?
See, investing in physical gold does not make sense because, you'll have storage costs attached to it. Plus, there are other disadvantages, I would say, in the form of liquidability, you having to go and sell it in the market. So physical gold, I would say no. Also, import duty cut is just one of the factors that affect the gold price. A major impact towards the gold price comes in from what is the international price of the gold as well as your exchange rate. That tends to have a higher implication on the gold than the custom duty cut. So therefore, if you're looking from that perspective, I would say go in for a SGB than even a physical gold.
Okay, all right. So physical gold is not something that you would prefer so much against the other options. But say between a silver ETF and a gold ETF, which one do you think is more popular? Which one would possibly give better returns to an investor?
So, silver ETF also in the last few years has been emerging and there's been enough takers for it. But if I look at in terms of cost efficiency, a gold ETF tends to be more cost efficient than a silver ETF. Second, in terms of liquidity, the liquidity for gold ETF, if you see, is also better than that of a silver ETF. So while being used as hedge against inflation and having an alternate asset class, both would work. But just looking at these two factors, I would still go in for a gold ETF than a silver ETF.
All right, so gold ETF it is. And Shraddha, how much should gold be as a part of your overall portfolio?
So, I'll just take a minute to explain how gold really performs. So gold, to a large extent, is a sentimental asset class as well. And it tends to perform well when there is concerns around, let's say, geopolitical issues or there is concerns around inflation. So if you specifically, take periods like, let's say, the COVID period where equity market corrected significantly. And, if I just see there was almost a 38% correction, which happened from the peak to the trough. Gold at that time gave you positive 7-8% return. Or, times like Russia, Ukraine, which happened, where again, equity markets were correcting, gold ended up giving you a 3-4% positive return. But this is only specific periods. If you look at longer term cycles of gold, they tend to give you returns which would be lower than equity, but 1-2% higher than that of gold. So if I'm looking at a 10-year period, for example, debt would have given you 7%, gold would have given you around 9.5%, equity would have given you around 12%. Coming to the risk, debt, of course, if this is government paper, it's risk-free. The standard deviation of gold works out as around, somewhere 9% for a 10-year period, and that of equity works around as 12%. So therefore, if you have a complete equity debt portfolio, that is also just fine to have. But if you want to infuse gold, then to my mind, it should not be more than a 5% allocation of your entire portfolio. So, let's say if you are a long-term investor, you're looking at 15-year time horizon or 10-year time horizon, I would say 70 to 75% of your money can be towards equity. 5% odd can be towards let's say gold, and 20-odd% can be towards debt instruments that you have.
All right, so that's the ideal portfolio that you can look at in case you want to split it between debt, equity and gold. Shraddha, always a pleasure speaking with you. Thank you so much for joining us today. It's a big development that took place, so always good to get in some expert advice on what's happening with gold ETFs, funds and sovereign gold bonds. With that, we'll take a quick break. On the other side, we'll be joined by Jay Kothari of DSP Asset Managers. We'll discuss about the tax benefits to retail mutual funds in GIFT City for NRIs and foreigners and try and understand what really went by in the budget this time. Stay tuned for that conversation.
Stocks ending in the red with just a select FMCG stocks and some pharma names bucking the trend in today's trading session. And the sell-off, as I mentioned, was across the board. Metals, media, realty, auto, PSU banks, all of these indices saw drops of anywhere between up to 4% or even more, with metals and real estate being the biggest sectoral laggards in today's trading session. The key point also to watch out for today was the India VIX, and at one point of time the VIX was up almost 52%. and that was the biggest single day jump that it had seen since August of 2015, eventually ending 42% higher and above the mark of 20. That might be a cause of concern as well. There were, of course, global facing stocks that took a bit of a beating in today's session. Tata Motors was one of them, 7.5% lower, the top Nifty loser, and the other one was Samvardhana Motherson as well. That stock ended 10% lower, of course, because of the relations to the Japanese markets as well. 600 stocks, almost 600, 580 to be precise, on the BSE ended on a lower circuit in today's trading session. And of course, as I mentioned, there were select FMCG and pharma names that bucked the trend. Marico was one, Glenmark Life was the other. Devyani International, after its earnings today, ended in the positive, so that was a good sign. And lastly, on the commodities front, the crude oil prices have fallen to a lowest level in 6 months, and of course copper prices are at a 4-month low. There were specific sectors that bore the brunt of the sell-off today. Real estate was one of them. Almost every index constituent ending lower. The top losers there being Suntech Realty, Brigade Enterprises, Godrej Properties, all of them seeing losses of between 5.5% to 6.5%. Railway PSUs are bearing the brunt as well. IRFC, Ircon, RVNL down at least 25% now from the peaks that they made last month. Defense PSUs, a similar story playing out there as well. Mazagon Dow, Cochin Shipyard, Garden Reach, all of them ending lower, almost 5% or more. And metals having a meltdown in today's session. The metals index also was down nearly 5%, 6.5% lower for SAIL, similar for Nalco and Jindal Stainless, 7.5% lower in today's session. So all in all, red across the screen, and there was no sign of any sort of support at lower levels.
My wife, for instance, and she's been such a big contributor in what I've become eventually. I think some of the soft skills actually, and these are aspects, and the ability to without getting sort of stressed, being able to manage many different things. I'll just give you one example. When I was a CA, typically, and many of the advisors, the Indian Economic Service actually are women. They would be in a meeting with me maybe at 3:30, 4 or something, and they'd get these calls actually, and they would be, because they're in a meeting with me, they would be, declining those calls. If the call comes twice or thrice, I knew this was actually either their kid or their mates calling basically for what needs to be made for dinner. Yeah. And so because that's exactly what, my wife, so when I was at ISB, it's the rare occasions when she was not instructing our kids or the maid to actually say what needs to be cooked. My kids would call me up. I would be at a loss actually.
Believe in your strength, right? What is your strength?
Welcome back. You're still tuned into MF Corner. Let's talk about the second important topic that we are going to discuss. This is the tax changes with respect to GIFT City that came by in the budget, which would impact retail mutual funds and NRIs and foreigners as well. To discuss this in greater detail and to understand the changes, we are now joined by Jay Kothari of DSP Asset Managers. Jay, good afternoon. Thank you so much for joining us today. Let's stick to the basics first up. What are some of the changes announced by the budget when it comes to GIFT City, and who does this impact?
Sure. Thanks for the opportunity, Sonal. Great to be here. So as far as the gift announcements in the budget were certainly, first of all, in the right direction. Number two, this also shows the government's commitment in terms of creating the world-class financial hub to attract global capital. And the changes, what we kind of witnessed were, number one, and in no particular order, but number one, abolition of the angel tax. So, this kind of gives an overall boost to the overall startup ecosystem in India. Secondly, even in terms of the indirectly kind of boosting the funding of the startups via GIFT. Number two is in terms of the lower compliance for the venture capital funds or the VCs, as we call it. So this is, just in terms of removing the so-called hurdles which they had in terms of the sources of funds. So that's not required anymore. So that kind of eases some pressure from their perspective. Number three, and a very interesting one from a VCC structure, which is a globally recognized vehicle in terms of variable capital company, which a lot of kind of family offices and other institutions kind of set up in Singapore, which we've kind of heard a lot. So that becomes a natural progression where one can kind of set up that structure in the GIFT ecosystem. But however, there are a few nuances in terms of the number of tax holidays. So in GIFT, it's kind of limited. In Singapore, it's kind of for perpetuity or forever kind of a scenario. So that's something which is going to be an interesting opportunity. Other part is on the financial leasing, again, not related to the MFs or investments in particular, but when you're leasing aircraft, ships, etc. So that's going to be a direct competition to Singapore, Lux, or Luxembourg, or Mauritius. So that's an opportunity from an India structural standpoint. And lastly, from a tax exemption standpoint, it's going to be both on the retail schemes and the exchange traded funds. And both retail schemes are now in parity with the AIF. So any foreigner or NRIs investing into India, they don't have to pay tax, if they invest through the retail funds or through feeders directly coming into India. So that's going to be a definitely welcome move. And I certainly see a lot of money coming into India going forward.
Okay, so let's take the last point forward. I wanted to understand, would it impact only NRIs and foreigners, or does it help Indian investors as well here? How would the last change that has come about impact?
No, we wish it was even for domestics, but that's clearly not the case. I mean, from LTCG and STCG, it's very clear that the mutual fund investors in India, when we file taxes, we will continue to pay these taxes. This is more an advantage to the NRIs and foreigners who even come through the feeder structure. Even there's a segregation, so it's not that every investment structure in GIFT will be getting a benefit. The funds which are set up will continue to pay the LTCG and STCG as applicable, but the feeder structures, which you drop a sleeve in the GIFT city, which invests directly into the mutual funds in India, whether it's DSP or whichever mutual funds it invests into, that's a pass-through. So there you do not pay taxes, so that's going to be a benefit. But for investors in India, it's status quo. The only benefit is that if you want to kind of just take it with a positive bent, is that once a lot of money kind of flows or continues to flow into India, that's going to be good from a flow perspective from an Indian investor standpoint.
Okay, all right. So that makes sense. And thank you for explaining that in such great detail. But do tell us, how does it impact AMCs? Do all the AMCs have the license to operate funds in GIFT City? If not, which are the ones that do have it currently?
No, so no, not everyone has it, and it's not natural that everyone has to have it. So it's a choice like any other aspect. So DSP for one, we are one of the largest kind of GIFT operations, with having almost $600 million we manage out of there already. We have to take a fund management entity license within the GIFT IFSC for operating under GIFT. So to answer your question, no, not all AMCs have it, but gradually I won't be surprised if most of them have it, because there is an inherent opportunity for money coming into India, and it's ease of operation. So initially, if you go back 10 years, 15 years, a lot of investment management entities were set up in Singapore and otherwise, because Indian mutual funds or managers were not allowed to invest money sitting here in India. But now you can have a fund management entity in GIFT, so it's not very far away. It's just kind of 3-4 hours from here, so that makes it conducive. But yes, going forward, I do expect a lot of asset managers to set up shop within the GIFT entity.
That was going to be my next question. If we'll see more retail funds, ETFs being launched now in GIFT City because of this change. Are there any right now? What is just the expectation after this change that has come about?
Yeah, no, so it's a very valid question. So I think the only difference why you didn't see any retail funds getting launched, and it was mainly the AIFs, including us. We've launched mostly the AIF strategies, but incrementally after the clarification in the budget, where retail will also be classified under the same kind of tax regime as AIF, this will encourage a lot of people to now start going with more retail strategies. We have done that as well. So over the next few months, you'll see a lot of retail funds being launched within the GIFT structure.
Okay, all right. Jay, last question before we let you go. We've been seeing a lot of changes already. RBI raising that limit that had come by here. Now, an Indian investor can open an offshore account there if they have payments abroad. Is there any other change that investors should be aware of from a GIFT City perspective that could benefit the Indian investors as well? Of course, the NRIs and foreigners, something that you explained right now.
No, absolutely. I think it's from a direct impact standpoint, the way we need to look at it is that India is still not an obvious in terms of the global allocation from funds or investors, whether it's hedge funds, family offices, sovereign wealth funds, pension funds. So I think when they look at India, now the question is from why India to how India. So how do you access India? So this becomes an obvious kind of answer in terms of gift is another opportunity. So Mauritius and Singapore were other opportunities, but now with the proactive regulators, I think there is another option, and through this a lot of money will come in. And I think from our perspective, what we need to understand is that global funds are still underweight on India. So if we see over the next 5 to 7 years, even if $25-30 billion per year can come in through the FPIs, it is going to be a function of how easy we are making it for global investors to invest into India. And with all these proactive steps, I don't see any reason why foreign investments should continue to flow, even after a lull, which we've seen over the past couple of months, where retail or domestic institutions have kind of outpaced foreign flows. So I think I remain very hopeful in terms of foreign flows entering in India.
Okay, all right. Take that point, Jay. Thank you so much for joining us today with your take and to explain the changes that we've seen in the recent budget when it comes to Gift City. Hope to be speaking to you very soon again.
All right. Thank you.
Okay, all right. That's all we have on the show today. But stay tuned for Closing Bell to take you through the last hour of trade.
Even if the non-farm payrolls labor market data in the US was a bit disappointing, we're really not seeing other economic indicators at all pointing to a recession. And also keep in mind that the labor market is a lagging, not a leading indicator. So we really want to be looking more, say, at PMIs to get a sense of how well the US economy at least is doing.
plethora of events shape up over the last few days, and it's obviously difficult to make sense of everything and put the pieces together. There will be, there are different factors which have been affecting different regions, whether you take Japan or US or maybe even emerging markets for that matter. I think as far as the US is concerned, what we read and what we probably still share as a view, and probably is a continuation of what we, in a way, expecting that, we will probably try and see some correction as far as the inflation dynamics out there are concerned, and some bit of slowing of growth as well. But in the meanwhile, I think what is happening is quite unexpected lines in a way. I would say that because there was this expectation that in the second half of the year, we will probably try and finally see some possibility of rate cuts emerging.
India, I think it would be less a growth scare. People have been talking about valuations for Indian equities for a very long time. Nonetheless, the market kept going up, and if anything, recently compared to many other global markets, it still performed relatively well. But I think now that question is going to become much more pertinent to investors when they see a much less supportive global environment for risk. Markets with high valuations are going to be one of the first things that they look at.
Big miss on the US jobs data has triggered recession fears. It's actually the first time labor market data, monthly jobs data in the US has been such a big miss in this particular cycle. And remember, till last week, expectations were that it's going to be, a very moderate soft landing, which will allow the Fed to cut rates. And it's all very well orchestrated. But this could mean that, it's not all under control. And the Fed perhaps is even behind the curve with what they want to do as far as interest rates are concerned. As a result of which, US money markets are now pricing in a 50 basis point rate cut in September and a total of 125 basis points rate cut through the course of 2024. So the benchmark Nikkei is down over 20% in the last 3 days now. And you look at the USD JPY, that has fallen 20 yen to a dollar in the last 1 month. So basically, the currency has gone from 162 to 145 from the beginning of July. That's a massive move for a currency like that.
Today, it's a big rebound that we are seeing.
There is a fair amount of trade that we have with Bangladesh. The impact on some companies will be a little more than the others.
The economy deteriorates, Fed will, and I quote, fix it.
This is how markets behave at these kind of big inflection point.
First trades 160, 170 points higher, I think, is where we are starting on the Nifty.
The fact is that there is a global reset.
If any relief at all is likely, it will only be with respect to real estate.
We are not calling for recession.
The bank is flat. It's not participating on the way up.
People have been borrowing yen and using that proceeds to invest in assets around the world. So that has been winding.
Markets staying in the green. The Bank Nifty, though, has just slipped into the red.
Sharpest strategies, top market trends, unmatched perspectives, the trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell. Broadcasting live from the CNBC TV 18 Motilal Oswal Studios in Mumbai.
Well, we are all smiling, but the market is not smiling. The market is not hurting, but we're off the high point of the day quite a bit, actually. Banks is essentially the problem child here. We'll talk about all of that. This is Closing Bell, last hour coming up. We're coming to you from the CNBC TV 18 Motilal Oswal Studios. I'm Prashant Surbi, Reema with me here in the studios, and Nigel is joining in from the newsroom floor. Guys, hi, good afternoon.
Hi, afternoon. Is disappointing the word for today's trading session?
That's exactly the word that I had in mind.
When he said not smiling, not happy, I was thinking of it's a bit disappointing.
No, because, a lot of the Asian markets managed to retain some of that pullback. Some of the European markets are still flashing at least a little bit of green, but we have decided to go with red. Let's see. Last hour is still there, so let's see.
No, I think, so I think basically it's all global, right? Nikkei managed a 10% bump. The graphics will come up. You had Nikkei, which was up 10%, so almost reversing yesterday's losses. But the follow-through into Europe is not really visible to that degree. I mean, actually, very, very hesitant kind of moves across the European board. As I was coming in, I looked at the US futures. Nasdaq futures have cut their gains in half. I mean, they were up about 1.4%. I think about 0.75% higher. So I think, and of course, you look at the dollar JPY as well. That has also pulled back a little bit. The dollar was stronger, the yen was weaker. But the yen has moved up, the dollar has come off a little bit. So I think, at the margin, everyone is, of course, watching what's happening at on the global screen, really. Now, in terms of the levels, basically, the Nifty is about 300 points off the day's high. Bank Nifty, for a brief moment, broke yesterday's low. And I think it is starting to pull back a little bit once again. So, the low is absolutely same. So today's low is 49,660. Yesterday's was 49,719. So we broke yesterday's low for a brief bit, but we're trying to pull back here. And it also, the lows, by the way, coincide with a 50% retracement of the rally from the lows of the 4th of June. It's a level we put out in the morning as well, which is 49,718. We are now slightly above that level. So we'll watch this. Mid caps and small caps are off the highs of the day. Market breadth has turned negative. It was comfortably in the green with more advances, but not anymore. So it tapered off, basically, and no real follow-through coming through. But I think it's to be expected. I mean, I think no one's case that we're going to see a V-shaped recovery. It's going to be tricky trading conditions. But the fact is that the panicky kind of markets we had yesterday, that is not something we are seeing, at least. And I think that's the silver lining here. Reema.
Well, let's go through then some of the big movers in the frontline pack. So on the way down, life insurance companies are under stress. So HDFC Life, top loser, down more than 3%. SBI Life down 2%. These two are the top two large cap losers. Then you've got Bharti Airtel, muted set of Q1 numbers, no beat. The conference call will be beginning soon, 2:30 p.m. So we're going to keep our eyes firmly on that. In terms of the large cap private sector banks, which are dragging the Nifty Bank lower, it's HDFC Bank with a 1.25% gone, and ICICI Bank too is under pressure, down close to about 0.6%. On the way up, there is recovery in metals and IT. Though the recovery has faded, the Nifty IT index was up close to about 1.5% at early in the morning, and now it's only up close to about 0.5%. But names like Tech Mahindra, LTI, Mindtree are still holding on to about a 2% gain. Britannia is the top Nifty loser, and then you've got a few metal names like JSW Steel, which are looking up. That stock is just above its 100-day moving average.
You know, at the move on IT, I think it's got nothing to do with sort of a global rally or anything of that sort. I think it's probably more defensive in nature, more of a move to safety. These are great, cash-rich companies with proven track record, and not perhaps they haven't seen a very sustained rally. So maybe that explains the move back to quality, back to safety, which is why we are seeing that play out on the FMCG names as well. Just a word on the mid-cap market, and disappointing is, a word you can use even here, because the mid-cap index was cruising along in the morning, looked quite okay till about 10:30, 11. And then things started sort of falling through. The index is at the flat line right now, having lost all of its day's gain, and the advance decline ratio has also now turned in favor of declining stocks. They're basically outnumbering the advances, with some, some names from the PSU basket really coming up on top. So Bank of India, Railtel, Aircon, UCO Bank, these are the names where there's price action on the way down, along with heightened volumes, and then some profit taking on names like Zomato, for instance, which is down about 2.5%. But yeah, I guess, Nigel, interesting next 55 odd minutes coming up.
Well, that's right. The disappointing part for me today is the breadth of the market. When we started off trade, there were only 150 stocks that were declining, and now you have close to 1,350 stocks. So those crisscross lines, they're telling you the picture, and that's why your portfolio may not be feeling too good. The Nifty Bank is the weak spot, and in fact, the breadth of the market as well has turned unfavorable from a bullish perspective. But as we said earlier today as well, it's the Nifty Financial Services Index weekly expiry, so maybe in fact a bit of a move is pending even on that front. Mitesh Thakkar is back with us. Hi Mitesh, good afternoon and good to see you win. Well, it's become a sell and rise market. How are you viewing it? Are you short on the index? And if yes, what are the targets you're looking at?
Good afternoon, Nigel. I think that's exactly the way I'm looking at it. Sell and rise kind of a scenario. I think this is a market, which is now clearly showing signs that we would possibly see further declines, because what happened today was a gap up opening, followed by a failure of the index to sustain at higher levels. Both the Nifty and the Bank Nifty have tapered off. And while we haven't broken below yesterday's low, the structure is weakened. So I think, unless until 24,500 on the Nifty is captured, 24,500, 550, good chance that we'll head lower. And the worst case scenario, which I have penciled in, is a retest of 23,900, which was yesterday's low, and then even 23,600, 500 zone, which would be a good, strong support area. So I think those levels could be tested. So maintain that idea of, sell and rise, or trade via put options in stocks or indexes. I think that would be a good idea. Finance some of your put options by selling out of the money call options. That also could be a good idea. So that's the way we'll take it forward. On the stock side, I have a sell on Ambuja Cement with a stop at 641. Look for targets of 600 here. Maybe more, but I think that's the minimum which I'm penciling in. And the other stock which I have is on the list is ICICI Bank, which I would recommend selling with a stop at 1182 for targets of 1130.
Okay, all right, Mitesh, thanks a lot for that. Well, let's welcome Gurmeet Chadda as well on the show. Hi, Gurmeet, good afternoon and good to see you win. Well, there are a lot of stocks that we want to discuss with you, so let's go through a couple of results that came in the last 90 minutes or so. Let's start off with Shree Cement first. The numbers actually are looking quite weak. On the top line, well, there was a volume growth of closer around 8%, which is a little bit better than what we were working with. We were expecting volumes of around 9.5 million tons. It came in at around 9.6 million tons. So that's a little bit better. The problem is on realizations, and that's the reason why these numbers are a miss. So despite having mildly higher volumes, the absolute top line number is a little lower than what we were working with, predominantly because of realizations. The EBITDA the absolute EBITDA as well is much lower. Came in at around 920 crores. We were working the number in excess of around 1,100 crores. And that's what led the margins down to around 19%. That compares with around 23.5% that we're working with. What was the problem first? The realizations are weak. They are down by closer around 6%. And the other expenditure, well, that's up by closer to 14%. So we'll require some clarity as to why the other expenditure surged up by such an extent. On the power and fuel cost, they have got some relief, because on a year-on-year basis, despite producing more, that cost is down by close to 7%. The problem for Shree Cement is the other two larger players, that's the Adani Group as well as Ultratech. They have been aggressive in acquiring companies as well as increasing their market share, while Shree Cement is doing everything organically. Valuations are not cheap, and that's the problem for Shree Cement. Gurmeet, what's your view on Shree as of now? Clearly some troubled times with the other two giants becoming aggressive. Their numbers are not really coming about, and margins are under pressure. Your take?
So as Nigel rightly said, it's the realizations, and if you see the expenses, there's some pickup in the employee expenses. Other expenses probably we need a more detailed breakup. How they are up 14%, and the margins dropped from almost 22-23%. She is known for better realizations and margin, and as you rightly said, valuations do not offer any miss. At these valuations, if you miss earnings or it's a slightly weak. We saw that with Ambuja also. Realizations were weak. So I think this is more an industry trend. But you got to be a little, I think we are headed into consolidation, but consolidation will probably take 3-4 years. Ambuja relatively, although everything is now 17, 18 times, EV by EBITDA, Ambuja clearly has a goal of 140 million tons. The cost, they have maintained that the operating cost, they want to bring it down to 530 per ton, which means that in the medium term, they are in a way giving you a margin guidance. With consolidation, I think that could be something which can be looked at. Also down the order, if you look at some players in down south, there could be more acquisition candidates, all deals, whether it was Sanghi, almost at $95 a ton. India Cement was also at about $100 a ton. And south, there is a strategic focus. So I think you probably have somebody like a Sagar Cement and few names which are still at about, let's say, $50 a ton. So I think in the short term, probably you're better off looking at more tactically acquisition candidates which are well run, available at Sagar at $230 now is almost what, $45 a ton. And you're knowing acquisitions are happening at 2x the price. In the short and the long run, get into either the big one, either Ultratech and Ambuja, depending upon your view. I would probably prefer in terms of relative valuations, Ambuja in large cap and Saga Cement in the small mid cap space.
Okay, all right. Well, let's focus on the next set of number. Then we got your point on cement. You like Sagar Cement among other names. Let's talk about Vedanta then, Gurmeet. I wanted your view on the metal pack and how you all are playing that. The results, well, they were more or less in line with what the street was working with. Top line up by close to 6%. The EBITDA number was up by close to 55%. And margins, well, they expanded on a year-on-year basis on a very low base. They've got some benefit of lower power and fuel costs because despite the top line growing by 6%, the power and fuel cost was down by close to 5%. The PAT number as well did come in lower by 5%, but that's because in the base year, there was an exceptional gain. So that explains why we are seeing growth on the EBITDA front, but we're not seeing growth on the profitability front. Moving to their segmental performance, well, the aluminium business did very, very well. Just a few quarters ago, they were doing around 2,000 crores per quarter on the aluminium front. Well, that's gone up to more than 4,000 crores on a per quarter basis. So aluminium is the one that's driving the way. The problem is that aluminium prices have corrected post the first quarter. And that's why this profitability may not hold or will not hold actually. The oil and gas business, it continues to struggle. So you're still waiting by for profitability to catch up out there. Besides the numbers, the commentary is important. And, on the debt front, well, it's gone up marginally. The debt number on a year on a sequential basis actually has perked up a little bit, but that's par for the course. The management says that the demerger is on track. All the approvals are in. The key creditors like SBI and LIC, they have given their no objection certificate. So that's positive because the street is looking by for some value unlocking. And also they're saying they raise 8,500 crores by the QIP route. That's going to help them deleverage their books. They've also released the pledge on Hindustan Zinc's book out there. And they've said that the interest savings will be around 1,100 crores from this particular QIP. So put everything together, one of the best plays on the metal space. The numbers are good. The problem is the global environment has turned a little bit jittery, and that's why the stock is not reacting in that manner. Gurmeet, what's your take on this one?
So, I agree, Nigel, it's one of the cheapest metal stock available, but it is cheap for a reason. We know that with the kind of pedigrees that. I think the two big triggers, as you pointed out, one is the demerger plan, and second is debt reduction. I think what one thing which stood out is you see the finance cost is almost down 10% YOY. The net debt has also come down. So I think that's something market would be looking at, more closely to make it, let's say, value closer to some of the leading names there. But anything right now with global linkages, with China involved, global factors involved, it's better to not get into it. Although metal stocks are, as I mentioned, is reasonable, especially Vedanta. But I think rather focus on the domestic plays right now, which are, let's say, FMCG, healthcare also not the generic ones, but the branded ones, rural economy facing stocks. And maybe rate sensitive. I believe, in banks, probably there is a better opportunity. Interest rate cuts will happen over the next 2-3 months. And the one big issue, which is NIM coming down, will get addressed.
Okay. That's a word coming in on some of the companies that have reported numbers. By the way, speaking of earnings misses today, there's Syrma SGS. Syrma is now down about 7%. This, of course, has been one of the darling stocks of the market, EMS play. But it seems that it's been a bit of a rough quarter on the margin front, especially for Syrma. Their gross margins have come down by 700 basis points. Even at the EBITDA level, the margin, I think, is compressed by over 200 basis points. And obviously, in a market like this, probably no room for error. Just very quickly on Syrma, Gurmeet, is this a dip that one should be buying? What's your view on the company and the stock?
Yeah, so I think you have to divide this EMS space into B2C and B2B and B2B2C. I think Syrma and Keynes probably come in the latter, and you have like the Dixon and the Ambers of the world, come in more B2C. I think if you look at the scale Dixon has built, obviously valuations are completely very, very stretched at 11,000 levels. But let's say 30%, 35% of the mobiles they are making, another 30% of probably washing machines they are making. Break it product-wise, and you'll see that in a lot of spaces they now have 25, 30, 35% market share. And this electronic market is huge. With the kind of geopolitical tensions we are seeing, look at textiles, for example, see the move in Gokuldas today. So I think companies which are building a lot of scale may stand to benefit as we see more disruptions in this space. So we have Dixon in B2C space and Keynes in B2B space. Syrma, if it falls a little more, maybe worth looking at, but probably want to wait out a quarter or two and see that if this is just temporary issue or there's something more structural at play.
Okay, Gurmeet spoke about textile companies, Kitex Garments, Gokuldas Exports, Vardhaman Textiles. These are all stocks which are buzzing in trade, as the hope is that international buyers will now shift to India given the turmoil in Bangladesh. But it's not just textile. There are many other Indian companies with an exposure to Bangladesh. And Manglam is now joining in to give us an overview of how the political turmoil in Bangladesh affects these Indian companies. Manglam.
Well, let's talk about companies on the basis of stock price movement right now. And the biggest loser is Marico, understandably, because nearly 44% of its international revenue comes in from Bangladesh. Remember, this number a couple of years ago was 51%. They're looking to reduce their exposure to Bangladesh to about 40% of international business. But international alone accounts for nearly 25% of their sales, making it nearly double-digit contribution coming in from Bangladesh. Remember, up until the numbers yesterday, the stock was fairly well bid, good numbers, good commentary. So some sort of long unwinding also further pressurizing the stock, which is currently down 6%. The other one that is on our radar is also Trent. Of all the suppliers that it has, Bangladesh accounts for one of the three major countries. So you have, Hong Kong, Thailand, as well as Bangladesh. Jubilant Foodworks less perturbed by this issue, largely because 28 of Domino's stores are in Bangladesh, which roughly accounts for just about 1% of the consolidated revenues. And the street is eyeing improvement in domestic business to more than make up for any sort of loss that may come by in Bangladesh. And that's also the case for a lot of these other FMCG companies, the likes of Dabur, Imami, and others, where the Bangladesh exposure is less than 5% of sales, in most cases about 1 to 2% of sales itself. The other company that I'm also looking at is, all these garment companies. It's exciting times where, last year we were talking about China plus one. Now, global global buyers may go ahead and look at India as an option, which is Bangladesh plus one. And that explains why a lot of these garment makers are doing well in today's trading session. But be mindful of the fact that, we also export yarn to Bangladesh. So some of these cotton yarn exporters may get a hit, a mild hit as disruptions come about. So not every textile company benefits from this. Garment makers definitely are expected to benefit.
Okay, thank you very much for that. Gurmeet, any of these stocks you'd like to highlight?
Yeah, we've been holding Gokuldas, lucky to hold it from almost 300 levels. I think if you see the garment export number, especially the apparel export, it's 3% since 2017-18. Bangladesh is almost 12%, China is almost 1/3, upwards of 35%. And then you have Taiwan and Vietnam also, which are much, much ahead. I think you could see some disruption. It's almost been now a month with the kind of disruption which we have had. Also, Gokuldas has done some meaningful acquisitions in Middle East and Africa, which gives them an entry into EU, right? Because EU doesn't charge duty to, Middle East as well as, in certain parts of Africa. So Gokuldas is mostly US right now, which is H&M, Superdry, Puma, Old Navy, etc. There's a lot of inquiries coming from EU labels as well. Even the UK thing got a little delayed because of the diplomatic issues we had. So I think there is a huge opportunity here. And I think there's a government focus on textiles. It's a job generator. 90% of workforce is usually women, which politically also, rhymes. So we are positioned there, and we are looking at few more names in this space.
Which are the other names you're looking at?
So we are looking at Vardhaman. KPR is not really garment export, but KPR is a very most integrated model. Starting from yarn to the final fabric. So textile, I think, would be a great focus area by the government in terms of additional PLI, as well as the changes happening in the global supply chain.
Okay, so that's a word on the textile makers of today. While we're discussing textile, Gurmeet, just a word about Marico. Also, I guess got caught up in the whole Bangladesh storm, right? But otherwise, I believe the numbers are pretty okay in the quarter gone by. And how do you look at it? 6% drop right now, but we have to look at all other factors, including the nature of the market, having a bit of a defensive play in the portfolio, rural, all of that put together. What should you be doing with a stock like Marico?
Reasonable. So we don't own it, so haven't tracked it that closely. But it's news driven right now. We've seen the reaction even in textile export stocks. It's obviously news driven. Nothing is going to change overnight in supply chains, right? The way stocks have gone up 14-15%. So I think our preferred plays are Imami. Imami has shown great turnaround. Both in terms of capital allocation, rural focus, premiumization of portfolio. We like ITC, and I've been liking ITC now for a while. Unless you have this hotel demerger, and then later on, their FMCG business is now 20,000 crores with operating margin in line with what Dabur has. So I think the FMCG business takes time. It should be valued at anywhere between 2 to 3 lakh crores. So there is value unlocking, and there is steadiness in cash flows, and there's reasonable valuation. We like Tata Consumer, and we like Mrs. Bector, which is actually linked to both QSR as well as the food segment. Any correction also, Mrs. Bector obviously is quite expensive right now. Any correction in these names, we probably tend to lap up more. And in an environment like this, where this entire thing hasn't played out yet, the yen carry trade has been there for 30 years. It can't play out in one day. Literally, I know clients who actually borrowed in yen and actually repaid much lesser because the yen kept depreciating. So it just became too easy. You're borrowing 100 and you're repaying only 97, 98. I think it will take a little time to unwind this. So that's why I think the key metric to watch here is the yen movement to the dollar, at least in the short.
That's a great point, Gurmeet, and one worth taking note of. By the way, folks, just keep an eye out on the screen, because the pace of the decline is suddenly accelerating again. The Nifty is looking at a 90-point drop. So, yeah, it's a pretty quick slide. Prashant?
It's led by banks once again, Surabhi. So the bank Nifty is, it looked like it was stabilizing after breaking yesterday's low briefly, but, it's gotten right back there. So we're at 49,736, and yesterday's low is 49,719, which is also that retracement that we were talking about. So banks really responsible in large measure for the 90-point cut, more than anything else, more than any other sector, for the 90-point cut.
Even the CPSE index is under pressure. So the Nifty CPSE index is down close to about 1%. PSUs like ONGC, Coal India, BPCL in the large cap space at the day's low. That's the PSE index. So that's hurting too.
Gurmeet, I know you like Sona BLW. We've spoken about this in the past. Stocks lost about $100 from the highs, recent highs. You think becomes attractive? What's the sense? And autos, the index has lost about 8.5% in 3 days. The index itself, double of what the Nifty is lost. So I'm not sure what's going on. Are people making space for some of the newer listings?
I think it will be a bit of rotation and profit booking also. A lot of stocks like, let's say, Sandhar, Uno Minda, they almost became 2x in a matter of, few months. What has happened, Prashant, in this space also is that Sona obviously has a good EV portfolio, incremental orders coming there, both for hybrid gears and hybrid assemblies. Other spaces, what has happened is there's hardly been any capex in IC engine parts, because the entire world is focused on, EV and other forms of, cleaner vehicles or new age vehicles. And look at, for example, TVS numbers today. They did 11 lakh units, of which 10 lakh is between motorcycle and scooters. iQube was about 50,000 units for the quarter, right? So even if you take industry as a whole, which is 1.2 crore, 1.3 crore units, it's less than 10%. And the bulk of the capex has happened on EV side. So what has happened is that a lot of the existing portfolios, guys who make locks, switches, people in fabrications, tooling, forgings, there's hardly been any capex, and now they are running at 80-90% capacity as auto demand comes back. So we are very constructive on, let's say, Uno, Sandar, Sona BLW, Samvardhana, Summi, some of the names like Lumax. I think there will be a lot of operating leverage playing out, because Ukraine got disrupted because of the war. That's the second largest country on IC engine parts. So I would be very focused on auto value chain. I think there is sometimes non-glamorous sectors like textile, IC engine parts can make money for you.
Okay. All right, Gurmeet, we'll leave it there. Thank you very much for joining us. It's a pleasure, as always, and thanks for being here. 23,990, so small recovery, 15-point recovery from the last time we looked at the Nifty, but that's about it. We take a break, we're back. We'll have Rajesh Bhatia of ITI Asset Management Company joining in on the other side. Stay tuned. The last time we had this magnitude of a rally, along with interest rate differentials between Japan and the US around 5%, it was back in 1998-99, and of course we had that sort of LTCM crisis back then. Now, fears of yen carry trade unwinding is essentially reason number two. So I mean, people borrowing in Japan, very low interest rates, investing around the world, and of course the yen moving so sharply upsets plans. Stops are hit and there is a forced unwinding which takes place. So that is reason number two. Number three, and this went unnoticed under the radar for the first couple of hours when we began trading, but Nvidia, the big reason why US stock markets have done so well, is reportedly delaying its next AI chip Blackwell by at least 3 months. And it was not a coincidence that the Taiwanese market was amongst the worst performer in Asian markets today. And also take a look at the fact that Nasdaq continues to underperform the S&P. So that is, I think you could blame it on the Nvidia story there. And number four, I don't think this was a really dominating driver, but geopolitics, right? The political news website Axios reports that attack by Iran and Hezbollah against Israel could start as early as Monday. I would say that what was happening with the currency markets and fears of a US recession were the dominating drivers. This, of course, if it were to come through, and it's a big one, could hurt at the margin going forward. Okay, welcome back. I think we're about, there's a bit of a recovery afoot. So 20 points lower now, and the Nifty is coming back sharply. Actually, it's now as we speak. If you have the Nifty up, you'll see we are coming back into the green, almost there. We were down, I think, 80-90 points, and we're down just about 20-odd points now. So 24,035. And I think similar should be the case on the Nifty Bank, which has also come up sharply. I mean, actually not that sharply also, but yeah, from the lows, I think we've seen about a 0.3% recovery coming through. Well, let's welcome in Rajesh Bhatia, Chief Investment Officer at ITI AMC. Rajesh, good afternoon. Good to speak with you again. And Rajesh is someone who tracks macro markets also very closely. And I think his view is formed from a slightly macro-ish perspective. And then, of course, he goes down and finds sectors and what is working and what is not. So, Rajesh, what have you made of the sort of turmoil over the last 48 hours or so? And, of course, what people want to know is it now behind, or are we in a phase of slight, de-risking around the globe and here in India as well?
So, Prashant, I'd like to believe that this is a correction in India's bull market. If you look at it, just until some time ago, 15 or days or 1 month ago, US was at a new high, Japan was at a new high, crypto, gold, a lot of the asset classes were at a new high. And there has been a sudden shakeout in the narrative of all of these markets. Suddenly that risk-on trade, which had become a little more complacent, has become a bit of a risk-off trade. Not surprising then, you're seeing a lot of selling pressure. Yesterday, the FIs sold the third largest amount that they've ever sold. Clearly, there could be some kind of follow-on selling from there as well. So we are kind of witnessing that kind of a pressure. But look at how we have done. In spite of all of this global risk-off environment, what have we fallen? 4 or 5% from the top. So in spite of all of this, my sense is India is emerging as an extremely strong market. Now, how long could this last? It's anybody's guess. And there is no methodology to figuring out when does the yen carry trade kind of completely unwind. But it has happened very violently and very quickly, which means that there should be kind of some light at the end of the tunnel. But we can't figure that out. There's no methodology to kind of figuring that out. But I know, or I am quite comfortable thinking that from a India perspective, this is a correction in India's bull market.
So since we are in a correction in India's bull market, what are you doing at ITI AMC? Are you looking to up the cash levels and maybe deploy it at lower levels, or maybe tilt the portfolio, pivot it more towards defensives? How are you going to approach the next 6 months?
So, across most schemes, we don't take aggressive cash calls except hybrid schemes where we have some cash or some ammunition, so as to say, in case we wanted to up the equity exposure. Having said that, I think we are going, and at least I as a fund manager, I'm increasingly more gravitating to one, domestic sectors. Second, I am looking at more incrementally on sectors which have greater predictability, better business models. In some sense, as I reflect on what I'm doing, I'm becoming more of an absolute return investor rather than a relative return investor in my own portfolio. So from a portfolio perspective, to answer your question, we are moving more towards the domestic sectors, avoiding global commodities, becoming a lot more conscious of export-oriented opportunities. If you look at across the region as well, what markets are correcting the sharpest? Export-oriented markets. So to that extent, I think in our portfolio, we are just carefully weighing where those exposures lie and how we should kind of maneuver them.
All right. Hi, Rajesh. Good afternoon and always good to see you. When I recall when we chatted the last time around, you said that banks is something you like. And I think you were leaning towards private sector banks, but select PSUs as well, you had mentioned, will do well. At current reckoning, how are you positioned out there? I'll tell you what, valuations of banking names are still pretty much par for the course. There's not very, very stretched on that side. The problem is the high FI holding, and if FIs are going to sell, then that could be the reason that we're seeing pressure on the banking names. So tell us your preference there and how do you see the outlook?
No, Nigel, you're absolutely right. I think the selling in the private banks, particularly rather all the banks, is more because of the FI ownership, which is one of the largest in banks there. Fundamentally speaking, look, these banks are actually underperformed quite a lot, including some of the private banks. Underperformed quite a lot. I don't, in terms of valuation also, relative to the rest of the market, they make a lot more sense. Yes, to the extent you are seeing the best of NIM margins, the best of credit costs. And as interest rates decline, which is now becoming a little more of a consensus that interest rates will decline, their asset repricing could also hurt the NII growth. Although my sense is that that's already captured in a lot of analyst estimates for these private banks. So from a valuation perspective, they make a lot of sense relative to the market. They may be at a peak of their interest margin as well as credit cost, but from a growth perspective and an ROE perspective, I would say the private banks still are going to be good, consistent compounders from here on.
Okay, got that. Rajesh, stay on. We want to talk to you about real estate as well, because there's been such a hue and cry over it since the budget, right? So we wanted to get your sense, because right now, as the rule of thumb stands, I mean, all the market pundits and real estate, experts say that the rule of thumb is that your property must appreciate more than 10%. That should be the kind of, IRR if the new regime minus indexation is to be beneficial. Now, rarely do properties give a 10% kind of a flip over a short period of time. So therefore, the hue and cry about the removal of indexation. So let's just take that story forward. We in fact have Shireen joining in, because what we're picking up is that the finance ministry could be reviewing the new LTCG regime for real estate. Shireen, tell us, what is it that you've picked up on the matter?
The blowback and the criticism with respect to the announcements that came in for the budget was specifically focused on the removal of the indexation benefits when it comes to the long-term capital gains regime, specifically for real estate. As my colleague Timsy has also been reporting, and what we are given to understand at this point in time, the options that are being considered by the finance ministry, the one that the finance ministry seems to prefer is the grandfathering option. Whether it will be grandfathered till 2024, July 2024, or perhaps a year beyond that is the question that remains unanswered. But what we are given to understand is that a final decision is yet to be taken. The other option, and that is what we've seen happen even as far as the tax regime is concerned. The old tax regime continues to coexist with the new tax regime, given the option to consumers, to taxpayers, to switch depending on what they feel they most prefer. So will that be the preferred route that the government decides to take forward? We don't know yet. But again, a decision has not been taken. But these are the two options on the table that are being reviewed at this point in time. Now, remember, again, to take our viewers back to the conversations that we've been having, including with the finance minister and the finance secretary. When I put this question to the finance minister a few days ago, asking if the government was considering a review or any kind of amendments, the finance minister had said that she would speak only in Parliament, because the finance bill is now the property of Parliament. And when I'd asked the finance secretary had said that in his view, in his personal view, there was no need for a review, but he did make it clear that it was eventually going to be a political decision. So remember, the finance minister is expected to reply to the finance bill in Parliament. It was expected today. We're given to understand that's now likely tomorrow. But these are the options at this point in time. If any relief is provided, it's likely to be restricted to the real estate sector for the purposes of providing some relief that taxpayers felt was necessary on account of the indexation benefits being done away with. A final decision, though, is awaited.
All right, Shireen, thank you very much for that. Rajesh, there you go. The issue is still a very hot one. But taxation aside, I mean, how do you look at things in the real estate space? From the equity standpoint, stocks did really well. What have you made of all the noise around removal of indexation, and what's your view on the sector?
Well, from a stock market perspective, I think a lot of real estate companies have done extremely well over the last couple of years. Their pre-sales numbers have tripled. That just kind of gives you the sense of demand visibility that they have. When we speak to a lot of real estate companies, they tell us inventories are dropping. Prices are actually moving up. And their confidence in build-up of new development has gone up tremendously. So all of that augurs very well. And real estate typically is a very long cycle play. So we have begun this cycle probably 2 or 3 years ago, and probably there's greater visibility that demand is sticky and that it'll last another 3 or 4 or 5 odd years. So one way to play the real estate is through these companies. And of course, it's getting more concentrated with the organized sector. But the other way is, of course, to kind of go into affordable housing companies or, wires and cable companies, etc., which are also an equally good way to participate in the real estate cycle, which has been extremely strong as far as India is concerned.
Okay, all right, Rajesh, we'll leave it there. Thank you very much for joining us. It's a pleasure having you here on CNBC TV 18 and a good chat as always. 60 points down again. So, I mean, the market did not really go all the way back into the green and we are still there, a little lower on the Nifty. About 0.6% cut on the Nifty bank, but trading as we have been dangerously close at below, but, around yesterday's lows. And then important retracement support as well. We take a break. We're back. Nimish gets us what's happening in dealing rooms on D Street Chatter. And of course, we'll get you some trading ideas as well. Stay tuned.
Usually in a session like this, when there is a sell-off across the board, you may wonder that a dip would get bought into, as has been the trend, but sadly that was not the case in today's session. And the benchmark indices, both the Sensex and the Nifty, saw their biggest sell-off since the 4th of June, and as a result of which 15 lakh crore worth of investor wealth was eroded after today's sell-off. And the sell-off was across the board, with 46 Nifty stocks ending in the red, with just a select FMCG stocks and some pharma names bucking the trend in today's trading session. And the sell-off, as I mentioned, was across the board. Metals, media, realty, auto, PSU banks, all of these indices saw drops of anywhere between up to 4% or even more, with metals and real estate being the biggest sectoral laggards in today's trading session. The key point also to watch out for today was the India VIX, and at one point of time the VIX was up almost 52%, and that was the biggest single day jump that it had seen since August of 2015, eventually ending 42% higher and above the mark of 20. That might be a cause of concern as well. There were of course global facing stocks that took a bit of a beating in today's session. Tata Motors was one of them, 7.5% lower, the top Nifty loser, and the other one was Samvardhana Motherson as well. That stock ended 10% lower, of course, because of the relations to the Japanese markets as well. 600 stocks, almost 600, 580 to be precise, on the BSE ended on a lower circuit in today's trading session. And of course, as I mentioned, there were select FMCG and pharma names that bucked the trend. Marico was one, Glenmark Life was the other. Devyani International, after its earnings today, ended in the positive, so that was a good sign. And lastly, on the commodities front, the crude oil prices have fallen to a lowest level in 6 months, and of course copper prices are at a 4-month low. There were specific sectors that bore the brunt of the sell-off today. Real estate was one of them. Almost every index constituent ending lower. The top losers there being Suntech Realty, Brigade Enterprises, Godrej Properties, all of them seeing losses of between 5.5% to 6.5%. Railway PSUs are bearing the brunt as well. IRFC, IRCON, RVNL down at least 25% now from the peaks that they made last month. Defense PSUs, a similar story playing.
Welcome back. Well, the markets continue to remain under pressure. Today is actually a disappointing trading session because we started off well in the green and we couldn't even hold in the green for the time being. We're deeply in the red, particularly at the Nifty Bank. But Nimesh is with us. Nimesh, what's the sense you're getting today? I mean, yesterday was a weak trading session and building down on yesterday's losses, we're down another 80, 90 points.
Well, down largely because of selling pressure. We saw a large sell figure yesterday and that trend of FI selling continues in today's market as well. That's the overall sense. I guess that's the reason why we have given up most of the early morning gains, and even the global markets look a bit wobbly, right? It's not like everything is clear now, and we are back to the positive thing. So I guess the time being we'll have to consolidate in these levels is the overall feedback. And as I said, there is selling pressure from larger FIs. Look at the Bank Nifty; it's down almost 900 points from the day's high, and that's again backed by FIs selling. Across private banks as well as PSU banks, there is selling pressure from larger FIs, including the domestic mutual funds as well. In fact, there is a chatter as well that maybe some domestic mutual funds has started seeing some bit of redemption pressures as well. So I guess that's going to be the key, right? The domestic money is what was helping the markets to hold on, and if that gives up, you might see correction in the broader market stocks. Also, the selling pressure. I was just looking at the list of stocks where there is selling pressure. Most of the names where there is selling pressure is all the stocks are above the 2 plus average mean. So all the expensive stocks is where there is selling pressure from the larger FIs. So it looks like there is a valuation call as well as far as India is concerned. So that's something to track going forward. Both the FI money has been a seller, but if the domestic money is slightly on the sidelines and they don't invest, I guess we'll see a bit of correction in the expensive stocks. That's the sense from the flow perspective. I guess real estate is a sector to watch because of the anticipation of some relief in the finance bill. If that has to come, you might see some further reaction. But broadly, it's selling pressure, and largely banks and the expensive names is where the FIs and DIs seems to be selling.
Well, Nimesh, the bulls will be hoping for a time-wise correction. They wouldn't mind it now because it appears that price-wise correction is suddenly taking over. So let's see how that goes. But individual stocks, what are you picking up?
Well, a lot of stocks which are buzzing in trade despite big selling pressure. So the first name is NTPC. Well, the stock is under pressure because of the overall markets, but for the last couple of days, there is very strong delivery-based buying happening. I understand a leading long-only fund is an active buyer in NTPC at this level. So that's the first name. The second name is BEL. Under pressure today, largely on the back of the big BOFA downgrade, where they have downgraded all the industrial names, but also there is selling pressure from larger FIs as well as some domestic mutual funds as well. So I guess that's the reason why BEL is under pressure today. The third stock is GMR Airports. We've seen a bit of a pullback in that stock from the yesterday's low, but there is small delivery-based buying as well from larger FIs in GMR Airports. And the last is Protein eGovern. I've been covering for the last few days now. Again, the stock is under pressure today on the back of soft Q1. But from a flow perspective, I guess one of the leading NBFC, which is owning close to 3%, that's completely cleaned out now. So their selling is largely over. And some HNS have bought as well in the last many days. So bit of under pressure today on back of earnings. But again, there is flows from larger HNS. They're looking to buy at lower levels.
Yeah, that's right. And a couple of these stocks, strong hands coming in there, but delivery is something that the street ultimately will go according to. But Nimesh, just one more stock I wanted to ask you about. Patanjali, we saw a large trade in the last few minutes. Any clue about that?
Nearly 24 lakh shares is what I checked. There was a large block of 24 lakh shares. Looks like some HN investors were sellers in today's block and a single buyer, likely a US-based fund, was a buyer in today's block. So I'm not sure whether it's more than 5%, 0.5%, so disclosures will come or not. But in case the disclosures come, it would be interesting to watch as to which US-based fund has bought in today's block.
All right. All right, Nimesh. Thank you very much for that. So that's all the buzz from dealing rooms today. Let's go back to Mitesh and take final stock of the market and any trades that one can look at. So the good news is that this decline, it's been arrested. It's not become a free fall, but it's still about an 80-point drop on the Nifty. Mitesh, final trades?
So we have a STBT on M&M that's closing below yesterday's close, so slightly negative, and the setup is also turning negative. So M&M is something which I would recommend selling with a stop or taking a STBT position with a stop at 2648 for targets of 2605. And Britannia would be a reverse BTSC kind of a trade. Keep a stop at 5835 and 5900 plus would be the target area.
Okay. Got that, Mitesh. Thank you very much for that. Let's also get you some previews, right? Because we'll essentially have numbers coming through from Lupin, which is later today. Ekta is here with what to expect from Lupin's first quarter. Strong numbers are expected, by the way. Ekta, over to you.
Well, for Lupin this quarter, the street is anticipating a revenue growth of around 7 to 8 odd percent, margins of around 19 to 20 odd percent, and profit of around 560 odd crores. Now, the expectation is that the company is expected to report a single-digit revenue growth this time round. The sales are likely to be capped because of a high base in the same time last year. However, the street is expecting a pickup in terms of sales in the US on a sequential basis. So last quarter, they did around $209 million. So this quarter, the street is anticipating maybe a pickup to around $220 million. Spiriva Generic, which is that inhaler that they launched, sales are estimated to be around $35 million. To watch out for the contribution of this drug, which is used for an overactive bladder, Mybetriq Generic, which is expected to contribute this quarter for Lupin sales. Now, for the domestic market, expect growth to be around 10 odd percent. India was up around 8.3% in the previous quarter. Margins should remain around 19 to 20 odd percent. So the margins have in fact been tracking 20% for the past 2 quarters. Commentary with regards to US sales margin outlook would be key for Lupin this time.
All right, Ekta, thank you very much for that. With that, we take another quick break, come back with the markets on the other side.
Even if the non-farm payrolls labor market data in the US was a bit disappointing, we're really not seeing other economic indicators at all pointing to a recession. And also keep in mind that the labor market is a lagging, not a leading indicator. So we really want to be looking more, say, at PMIs to get a sense of how well the US economy at least is doing.
Plethora of events shape up over the last few days, and it's obviously difficult to make sense of everything and put the pieces together. There will be, there are different factors which have been affecting different regions, whether you take Japan or US or maybe even emerging markets for that matter. I think as far as the US is concerned, what we read and what we probably still share as a view, and probably is a continuation of what we, in a way, expecting that, we will probably try and see some correction as far as the inflation dynamics out there are concerned, and some bit of slowing of growth as well. But in the meanwhile, I think what is happening is quite unexpected lines. In a way, I would say that because there was this expectation that in the second half of the year, we will probably try and finally see some possibility of rate cuts emerging.
India, I think it would be less a growth scare. People have been talking about valuations for Indian equities for a very long time. Nonetheless, the market kept going up, and if anything, recently compared to many other global markets, it still performed relatively well. But I think now that question is going to become much more pertinent to investors when they see a much less supportive global environment for risk. Markets with high valuations are going to be one of the first things that they look at.
Big miss on the US jobs data has triggered recession fears. It's actually the first time labor market data, monthly jobs data in the US has been such a big miss in this particular cycle. And remember, till last week, expectations were that it's going to be, a very moderate soft landing, which will allow the Fed to cut rates. And it's all very well orchestrated. But this could mean that, it's not all under control. And the Fed perhaps is even behind the curve with what they want to do as far as interest rates are concerned. As a result of which, US money markets are now pricing in a 50 basis point rate cut in September and a total of 125 basis points rate cut through the course of 2024. So the benchmark Nikkei is down over 20% in the last 3 days now. And you look at the USD JPY, that has fallen 20 yen to a dollar in the last 1 month. So basically, the currency has gone from 162 to 145 from the beginning of July. That's a massive move for a currency like that in such a short time span. The last time we had this magnitude of a rally along
Welcome back. The Nifty is currently below 24,000 by a smidge, down 60 odd points, while Asia closed up with strength. Europe right now is in the red. The French index CAC is down 0.6%. The DAX is a cut of about 1/3 of a percentage point, and the FTSE too is down nearly about 0.5%. So the problem is global. And earlier today, in fact, through the day, we've been chatting with global experts on the state of the global markets, where we are headed, on the U.S. Economy, and whether the U.S. economy is on the brink of a recession. Listen in to the experts as they weigh in.
For the first time, we saw that wage growth was much slower than the past, and more importantly, that the layoffs were turning to happen. Yes. And so it's a combination of the details, not so much as the gapping down, but the details that brought about the change, that now we have downside risk on inflation. Remember, wage growth is much slower, and we have downside risk on labor markets. Now we have 50 in September, 50 in November, and then every meeting, not every quarter, every meeting we have 25, so that by the end of July of 2025, we reach a terminal rate of 3% instead of 10.26.
We don't think the Fed will need to cut as aggressively. And I think that's been a factor. You know, we talk about the yen carry trade, and look, the Bank of Japan hiked rates. We had expected that, but it happened at a time when we had a confluence of factors affecting markets. And clearly the carry trade unwinding, which has been very, very severe indeed. And we know that Japanese investors had a huge amount of outflows into emerging market carry and higher carry trades globally. But I do think we've seen probably the brunt of this move in terms of carry trade unwinding. We've already seen a lot of position shifting, and I think positions are moving closer to neutral.
The market is beginning to recognize recession. We saw the yield curve uninvert for, it was just a hot minute today, but boy, that really got the market's attention. The fact that the 10-year yield was finally where it should be on the yield curve, if you will, the yield curve steepening. So I think we're getting enough signposts to suggest that if the U.S. is going into recession, that we've seen the best we're going to see out of stocks.
The mid-cap index is now down 0.7%, and from the day's high, it's a fall of 1,500 points in the mid-cap index. Pull that up, the mid-cap index, and lots of individual names are hurting. You've got PFC, which is now reacting to weak numbers. Siddharth Khemka from Motilal Oswal Financial Services is now joining in. Siddharth, Nimesh was just telling us about Protean eGov. This is a stock which has been a big outperformer. Influential market men have been buying Protean eGov because it's a play on India's digital stack, the digital infrastructure stack. But this quarter's numbers have been disappointing. Revenues are down 11.5% quarter on quarter, year on year also down 11%. Profits are down 34% year on year. So numbers have not matched up, and considering how much Protean eGov stock has rallied, you are seeing a correction. Have you studied Protean, and is this correction a buying opportunity?
So Rima, we have not looked at Protean. We don't cover the stock, but if you look at some of these digital plays, the likes of CAM, CDSL, and some of the other companies, I think they would definitely have some bulkiness in terms of lumpiness, in terms of the nature of the revenue recognition, and that is what is hitting them. If we, from our coverage universe, to play the digital space, we definitely like some of the capital market themes, for example, CDSL and CAMs, which are on play on the direct equity as well as through the mutual fund route. Numbers we are there for all of us to see the sharp rise in the demat account openings, the sharp rise in the SIP books. So both of these, I would say that figure out among our digital plays or to play the financialization of the things.
Okay, I said good afternoon, good to see you, Vin. Well,
Okay, so that Bharti Airtel is on the back foot post their Q1 numbers. The stock is down close to about 1.5%. Nothing in the conference call has also gotten the stock higher. Where do you stand on Bharti Airtel?
Yeah, Rima. So I think overall, if you look at Bharti Airtel, yes, we believe that more or less the numbers
are pretty good and in line. There is some concerns with regards to ARPU being lower than expectation, which is impacting margins. But we believe that the core growth in India is pretty strong. Plus, the Africa business growth is definitely picking up. And the home business, that is where we see a silver lining, a 5% Q-on-Q EBITDA growth, led by 5% subscriber addition. That is a new growth driver. Capex is moderating and deleveraging continues. So overall, we are in a positive view continues on Bharti Airtel. We have a buy rating. So our target price was 1650, which will get revised after the today's con call.
Okay, all right. What about insurance companies, Sid? What's the view out there? You know, the stocks had a big run. Nothing negative came out of the budget. There were fears, other fears as well that were surrounding these companies. They rallied a goodish bit, but today they're some of the biggest losers. Preference are there, and would you look to buy insurance?
Hi, Nigel. So good to see you. So if you look at insurance, I think definitely the numbers are improving, and the consistent growth in the quarter has been good. And some of these, so recently post numbers, we have also upgraded HDFC Life Insurance, which was a neutral for us to a buy. A lot of these stocks have run up in the recent last few months, and I think definitely closer to our target price. Our preference is SBI Life, which has been the most efficient player. We see a strong growth both in the annual premium as well as in the VNB margins. Continues to remain the most efficient with the ROEs in excess of 20%. And a strong growth of about 18 to 20%. So that remains our preferred pick. Target price is 1900. HDFC Life has seen improvement in its numbers because of the change in mix that is helping improve margins. Valuations were expensive, which came down, and now we have a target price of 750 on HDFC Life.
Okay, all right. So that we're getting close to the close of what's been a slightly volatile day once again. So if we see the screen right now, the Nifty again has managed to pull back from the lowest point of the session. So what was looking like an almost 100-point cut about 10 minutes, 15 minutes ago is looking slightly better because we're, trying to inch back towards the flat line. Still about 20 to 25 points gone from the Nifty. If we talk about the weak areas today, then it has to be financials. HDFC Life, the stock that we were just discussing, is ending with cuts of about 4.5%. SBI Life is the second weakest stock on the Nifty with about a 3% drop. State Bank of India, HDFC Bank, Axis Bank. So it's all these financials, Bajaj Finance, all of these stocks on the weaker side. Then some profit taking continuing on a Mahindra and Mahindra. There's been weakness on some PSU names like BPCL and ONGC as well as Coal India. On the upside, it's a move to safety. So Britannia, HUL, Cipla, a lot of these pharma and FMCG names, they stand out, as does IT, by the way. A lot of IT names are up about 1 to 2%. LTI Mindtree, Wipro, TCS, Tech Mahindra. This is where the investors were pretty much gravitating.
Okay, let's get through the mid-cap action then. On the way up, Indraprastha Medical, not a stock we often talk about, but 20% upper circuit in a weak market on the back of strong Q1 numbers. Symphony, good Q1. It's also a seasonally strong quarter for them, for their water cooling business. So Symphony, 70% jump in their revenues year on year, 50% quarter on quarter, stock up 19%. And then you've got the textile makers. So Gokuldas Exports, Kitex Garments, KPR Mills, Arvind, across the board, big gains. BLS International, where the company's margins expanded by 600 basis points on a year-on-year basis, also ends up with a gain of about 10%. First Source PCBL, that's Philips Carbon Black, from the Sanjeev Goenka Group, continue to come in for buying. On the way down, disappointing numbers from Sirma SGS Tech, that's down 8%, and Marico too. Perhaps the Bangladesh impact, because numbers were fine, but Marico down close to about 6.5%.
Okay, well, I think we're going to end with a cut of about 60-odd points. So 23,998 on the Nifty, and the Bank Nifty will by close, be above, actually almost at yesterday's low, just a 15-20 odd point difference, almost exactly at yesterday's closing, yesterday's lowest level. So actually, which is worse off, because yesterday the market made a low and then bounced. Today we're closing at yesterday's lowest level. The mid-cap and small-cap indices will also just sort of quickly come up on your screens. We're going to end about 0.75% lower. Here as well, the mid-cap index is leaving off absolutely at yesterday's lowest point. And the small-cap index is also doing something similar. So except the Nifty, the other three indices all are coming off and sort of ending down between 0.5% to 0.75%. Well, it's back to tracking some of what is happening in global markets, because that will set the tone once again as we come back in tomorrow's session. From all of us here, it's goodbye. Thanks for watching. Our Dreema and I'll take you through Markets Forward, which is coming up after a quick break. Interest rate differentials between Japan and the US around 5%. It was back in 1998-99. And of course, we had that sort of LTCM crisis back then. Now, fears of yen carry trade unwinding is essentially reason number two. So, I mean, people borrowing in Japan, very low interest rates, investing around the world. And of course, the yen moving so sharply upsets plans. Stops are hit and there is a forced unwinding which takes place. So that is reason number two. Number three, and this went unnoticed under the radar for the first couple of hours when we began trading, but NVIDIA, the big reason why US stock markets have done so well, is reportedly delaying its next AI chip Blackwell by at least 3 months. And it was not a coincidence that the Taiwanese market was amongst the worst performer in Asian markets today. And also sort of take a look at the fact that Nasdaq continues to underperform the S&P. So that is, I mean, I think you could blame it on the NVIDIA story there. And number four, I don't think this was a really dominating driver, but geopolitics, right? The political news website Axios reports that, attack by Iran and Hezbollah against Israel could start as early as Monday. I would say that, what was happening with the currency markets and fears of a US recession were the dominating drivers. This, of course, I mean, if it were to come through and it's a big one, could hurt at the margin going forward. Market fails to hold onto intraday gains, ends at the day's lowest point, tracking geopolitical tensions and global cues. Nifty and Sensex end mildly lower. Financials lead the fall. Nifty Bank ends over 0.5% in the red. 22 lakh crore rupees of investor wealth wiped out in the last 3 sessions.
Sources say the government prefers grandfathering till July as relief to counter the removal of indexation benefits for real estate, also considering if people should have the option to choose between the old and new capital gains tax regime. No final decision yet.
The political upheaval in Bangladesh is a fresh spot of bother for consumer companies like Marico, Imami, Bajaj Consumer, which have exposure to that market. Indian garment makers stand to become beneficiaries of the disruptions as global companies may look towards Bangladesh plus one as a supply chain route. Hello and welcome to a fresh new edition of Markets Forward, your go-to program where we aim to summarize today's trading action and of course look ahead into tomorrow. It's been all global, which has been the head, which has driven the tail, which is of course what's been happening here. I'm Prashant. With me, my colleague Reema Tendulkar. Reema, hi.
Hi, and we're going to be with you with all the big news, the key developments in the Dalal Street, top corporate voices, top global voices, and what you need to track ahead of tomorrow's trading session. But first, the market action. You know, when you woke up in the morning, US market, I mean, there was just so much promise, right? Asian markets were higher and Asia closed up higher. But the end is very, very different.
End is different, but Reema, actually, to be fair, the US ended down. Nasdaq was down 3.5%. S&P was down 3%. It was not as if the markets were higher. It was just that things were much more orderly. The panic that we saw across through in Asia yesterday, it did not percolate down to the US market. It was not indiscriminate. Markets ended lower. And as sort of we began the session this morning, Nikkei rebounded. I mean, I think it ended about 10% higher, almost nearly erasing yesterday's losses. But then after that, there was limited follow-through to the European session. And I think US, and the market, of course, was also tracking what the US futures were doing. So Nasdaq futures, for example, middle of the day were up about 1.5%. In the morning, they were up more. But then they slowly started to give back gains. Dollar JPY also started to sort of go up a little bit. And that, I think, is the reason why at the margin, because this is a globally driven sort of risk-off, you had the market here also giving up gains. I mean, I said this in the morning at 8 o'clock, that at some point in the day, and it was looking like we'll start 200 points higher at that point, that at some point we will see negative red on the screen. And then maybe more volatility. And I think that has come to pass. I mean, we've spent bulk of the day trading well. And then, of course, there was a slow tapering off which happened. But we end just 0.25% lower. The Nifty is not so bad. Actually, the Bank Nifty needs watching because the Nifty Bank has ended at yesterday's lows, absolutely at yesterday's lows. And same is the case for the mid-cap index and the small-cap index, both which have ended at yesterday's low. So I think we've got some crucial levels here which will need watching. And of course, what needs watching more than anything else is more stability in global markets and maybe even a positive screen when we come back, outright positive screen when we come back tomorrow morning. That'll be nice. Reema.
Well, let's just put the context of today's intraday fall. The Nifty fell nearly 400 points from the day's high. The day's high today was 24,382 and the Nifty ends below 24,000. On the mid-cap index, we're down 350 points at close. From the day's high, it's a near fall of 1,500 points. And on the Nifty Bank, again, a cut of about 350 points, ending at the day's low. The Nifty Bank, too, has sold off 1,000 points from the day's high. In terms of large cap action, insurance companies were under pressure. Bharti Airtel's numbers were nothing exciting. The stock ends down 1.5%, and then private sector large cap names. On the way up, metals saw a bit of buying, a rebound. IT also rebounded. Britannia was the top gainer on the show. We'll discuss more stocks, but before that, let me tell you what we have for you on our show today. We start with the top movers and shakers of the day with Hormuz. The stocks on our radar include Shree Cement and Vedanta post their Q1 numbers. And then the political turmoil in Bangladesh has intensified, bringing several stocks into focus. Also, CNBC TV 18's popular segment, D Street Chatter, on the show, where Nimesh will join in to tell us why BEL was buzzing today. And then we'll get you up to speed with the big market events to watch tomorrow. But first, it's over to Hormuz. He's at the big wall with the top stock movers of the day. Hormuz.
Absolutely zero confidence at higher levels for anyone to stick their neck out and say that the sell-off is well and truly over for good, and it reflects in the stock price action of today. But the one theme that was very dominant in today's session was the impact that the companies having exposure to Bangladesh would have, and Marico saw that 6.5% lower, ending at the lowest point of the day is the stock there. But the apparel companies had a very good day. Gokaldas, SP Apparels, Vardhaman, even Kitex Garments ended over 15-16% higher. So a good day for them over this potential Bangladesh plus one supply chain theme. The earnings impacts, they were impacts on both sides of the spectrum. BLS International 10% higher, BEML Another loss. Receivables also increasing year on year, 6.5% lower. PFC's numbers came out just before market close, 5% lower. Schneider Electric and Symphony, after the buyback that they announced, 19% higher after the result announcements as well. The selling pressure continued in PSUs. They had opened higher, but then all of them cooled off from the highs of the day. In HAL, down for the 6th day running now. Cochin Shipyard, Garden Reach, the selling pressure there continues as well. And LIC and REC also ending lower in today's session. PSU Banking Index was the top sectoral laggard in today's session. Almost all index constituents ending lower with losses of anywhere between 2 to 3%. And lastly, there were a lot of movers that moved on very strong volumes, with Cera Sanitary Ware being one of them. First Source Solutions continues to move higher. These RPSG group companies along with PCBL. Patanjali Foods had a block deal. Welspun Corp and Sundaram Finance were some of the other volume movers in today's session. Back to you guys.
Okay, all right, Hormuz, thank you very much for that. So that's a pretty comprehensive look at what happened today. Let's bring in Siddharth Khemka of Motilal Oswal Financial Services, who's with us. We also have Ruchit Jain on the charts. Gentlemen, great to have both of you here. Thank you for your time. Ruchit, let's start with the price action first. Nifty Bank, mid-cap, small-cap indices closing at yesterday's lows. Nifty, of course, ending slightly off it. What do you make of the price action, and what's the likely trajectory near term?
Hi, very good afternoon, Prashant. Well, Prashant, the short-term trend looks a bit of corrective in nature, which could continue going ahead. So primarily, it's not just the daily chart, but if I look at the weekly charts also, we have a negative crossover in RSI on the weekly chart after a long period of time. And on the daily chart too, there was a negative divergence seen. So I think we have not yet retraced that 38.2% retracement also, which is usually seen in a normal course of correction too. So that 38.2% retracement is coming around in Nifty around 23,600 to 23,500 kind of range. So we think that the near-term pressure would continue. Today also we witnessed a positive opening, but clearly selling pressure has been seen at higher levels in intraday pullback moves also. So 23,500 to 600, I think that's where the major support for the markets for short term is placed, and we should head in that direction during this week itself.
Okay, let's get to some of the big movers of the day now. It's earnings action actually. Shree Cement came out with a weak set of numbers, while Vedanta's numbers were largely in line with expectation. Nigel joins in with the details. Nigel.
Well, let's start off with Shree Cement first. When you're trading at those sort of valuations, it's always a problem. A bit of a miss could result in a sharp reaction in the stock. And in fact, these numbers were very, very disappointing. So it was a top-down miss that we saw on Shree Cement. To run you through a few numbers, the volume growth was close to around 8%. Which was encouraging because that was a little bit better than what we were working with. But since the top line was a miss, in spite of having better volumes, told you that the realizations were sharply under pressure. A rough estimate tells you that the realizations were down by close to 6% on a year-on-year basis. And that's what led to the EBITDA number as well, missing our estimates big time. So two factors played out because of the operational miss. One was that the realizations were weak. The second factor was the other expenditure was sharply higher. The power and fuel cost, though, there was some kind of a breather out there because that was down by close to around 7%. The management says they continue to focus on adding capacity. The problem is they're doing it organically. Some of the larger peers, they're being very aggressive in the inorganic market, which could see further pressure on Shree Cement. So these numbers go down as a miss. For Vedanta, the numbers actually were bang in line with what the street was working with. The top line growth was close to around 6%. You had the EBITDA number that jumped up by more than 55%, and margins improved dramatically on a year-on-year basis because of the cost benefit. They've been focusing on reducing the cost of production, and also LME prices were sharply higher on a year-on-year basis. The profit number, though, did come in lower because the same quarter last year, there was an exceptional gain in the base year. So that explains why, despite you seeing a growth on the EBITDA number, on the bottom line number, in fact, there was a bit of a degrowth. And what stood out really in this past quarter for Vedanta was the aluminium business. Just a few quarters ago, they were doing 2,000 crores of EBITDA per quarter. That number has jumped up to more than 4,000 crores. Obviously, there is a benefit of LME pricing as well, but the cost of production itself has come down to around $1,700 on a per ton basis. The other factors that played out, debt was higher because of capex that they incurred as well as the dividend payout. And also they have said that going ahead, the demerger is well and truly on the cards. So Vedanta in line, Shree Cement, a bit of a miss. Back to you.
Thank you very much for that. Siddharth, Shree Cement, and how does it compare with the rest of the cement majors?
Yeah, I think rightly highlighted results were very weak on back of the realizations, especially weak realizations led to the EBITDA being much lower while the overall volume growth was about 8% up, in line with our expectations. The realization was down 9% versus realization was down 6% on a Q-on-Q basis versus our expectation of a flattish realization. So I think overall, if you look at cement companies, the volume growth has been pretty strong. Some of the companies have reported a weak realization, and on back of it, the EBITDA per ton coming below. But overall, Shree Cement, the expectation for this year is not very strong. We are expecting an earnings decline of about 8 to 9% for the year. Valuations being high, we have a neutral rating. Some of the better ones, for example, Ambuja, where the capacity addition and consolidation is helping. Dalmia Bharat, again, ramping up strong capacity. The regions that they are there, again, very strong demand regions. So these are some of the stocks, apart from Ultratech, which continues to be a leader and very strong numbers, EBITDA per ton being higher than our expectations for Ultratech. So large cap, we like Ultratech. And within the mid and you can say large mid caps, we like Ambuja and Dalmia Bharat Cement.
Okay. I got that. We'll come back to you, Sid, in just a bit. But I want to highlight one more story which was playing out through the course of the day. This is, offshoot of the political turmoil in Bangladesh and how it is likely to affect different companies differently, right? FMCG companies hurt on one hand, but on the other hand, you've got garment and textile apparel makers which stand to gain. Mangalam is here with what is going on. Mangalam.
Well, let's talk about companies on the basis of stock price movement right now. And the biggest loser is Marico, understandably, because nearly 44% of its international revenue comes in from Bangladesh. Remember, this number a couple of years ago was 51%. They're looking to reduce their exposure to Bangladesh to about 40% of international business. But international alone accounts for nearly 25% of their sales, making it nearly double-digit contribution coming in from Bangladesh. Remember, up until the numbers yesterday, the stock was fairly well bid, good numbers, good commentary. So some sort of long unwinding also further pressurizing the stock, which is currently down 6%. The other one that is on our radar is also Trent. Of all the suppliers that it has, Bangladesh accounts for one of the three major countries. So you have, Hong Kong, Thailand, as well as Bangladesh. Jubilant Foodworks, less perturbed by this issue, largely because 28 of Domino's stores are in Bangladesh, which roughly accounts for just about 1% of the consolidated revenues. And the street is eyeing improvement in domestic business to more than make up for any sort of loss that may come by in Bangladesh. And that's also the case for a lot of these other FMCG companies, the likes of Dabur, Imami, and others, where the Bangladesh exposure is less than 5% of sales, and in most cases about 1 to 2% of sales itself. The other company that I'm also looking at is, all these garment companies. It's exciting times where, last year we were talking about China plus one. Now global suppliers global buyers may go ahead and look at India as an option, which is Bangladesh plus one. And that explains why a lot of these garment makers are doing well in today's trading session. But be mindful of the fact that, we also export yarn to Bangladesh. So some of these cotton yarn exporters may get a hit, a mild hit as disruptions come about. So not every textile company benefits from this. Garment makers definitely are expected to benefit.
Okay, Mangalam, thanks very much for that. Ruchit, names like Gokuldas Exports, anything caught your eye among the names that Mangalam mentioned?
I think two stocks within the entire space are still looking quite good in spite of today's up move. One is Gokuldas Export, because this stock, even during the corrective phase of last 4 or 5 months, which turned out to be more of a time-wise correction, and today's breakout just seemed to be resumption of its broader degree uptrend. I think the stock has potential to rally towards 1160 to 1200 kind of range in the near term. And another name, I think KPR Mill has given a decent breakout today from a consolidation, that too supported by very high volumes compared to its daily average volumes. So I think, yes, some stock-specific outperformance could be expected from this space, because of these news flows. And Gokuldas and KPR Mill, these are two stocks where, chart sectors still looks quite bullish from current levels.
Got it, Ruchit. Sid, anything you like in that space, you have coverage on?
Prashant, we don't have coverage, unfortunately, on this space. Some of the retail companies are there, but they are not the beneficiaries.
Okay, all right. Just a quick word, Ruchit. Autos have been selling off. The auto index has been sort of down and out. I think it's now, today it was down about 0.8%. In the last 4 sessions, it's down 9%, the auto index. What's happening here, and are there any trades?
So Prashant, if you see last 6 or 7 months, I think there has been no correction in the Nifty auto space. In the month of March, the Nifty auto index was trading around 20,000 from where it had rallied towards 27,000 without any meaningful dip. So the momentum readings went in the overbought zone in this setup, and I think this global markets correction, led to this sell-off where the overbought setups are cooling off. So I think still some more downside could be seen. The Nifty auto index has major support around the 100-day moving average, which is around 23,500 kind of range, still about 1,000 points lower from current levels. So I think one should not be in a hurry to do any kind of bottom fishing. This is although it seems to be a corrective phase, but I think still some more correction would be there in the short term before the stocks bottom out.
Siddharth, would you bet on Bangladesh +1 as a potential big benefit to the Indian textile majors? And if yes, which one is best placed?
So, Rima, I think these are early days. We just started hearing this term today itself, Bangladesh +1. Till yesterday, I don't think anybody would have expected this. Bangladesh has been a big competitor for the Indian textile companies, and they have large cost efficiencies, which Indian companies are yet to build up. So I would say, yes, India would definitely benefit gradually, as has been the case with China +1. There are a lot of other regional countries that have benefited from China +1, which would tend to benefit from this Bangladesh +1 as well. But again, some of these garment manufacturers, some of these textile companies, they are the best bet. Although we don't have coverage, but some of the large efficient players like a KPR mill, I think could benefit out of it. Another company is Vardhman Textiles. I think these are some names that comes to mind while not under coverage, but these are the companies that could benefit from Bangladesh +1.
Well, I tend to agree with that assessment. Maybe too early, right? Whatever happens, right? I mean, Bangladesh exports are textile exports are sizable and they're very large. Yeah. So whoever is in power, whoever it is, I mean, they could. It's the primary source of forex earnings for that country. They'll try and stabilize that ship. So yeah, I mean a bump, but maybe a temporary one. But for today at least, I mean the market wanted to latch onto that theme. Sid and Ruchit, great speaking with both of you. Appreciate you joining in. We'll take a quick commercial break here. We leave you with some market voices that we got through the course of the day. This is of course on the global macros. This is Mitul Kutecha and Jahangir Aziz. Listen in. We are back on the other side.
So the way in which we had been talking about the Fed is that, look, as long as inflation is coming down and the Fed is feeling confident that inflation is going to meet its 2%, 2.5% target, then the Fed should start cutting rates because the Fed has kept rates at a very restrictive level. The issue is that if that's the only thing that's happening, then the rate cutting cycle would be shallow, calibrated, and extended till the end of 2026.
We don't think the Fed will need to cut as aggressively. And I think that's been a factor. We talk about the yen carry trade, and look, the Bank of Japan hiked rates. We had expected that, but it happened at a time when we had a confluence of factors affecting markets. And clearly the carry trade unwinding, which has been very, very severe indeed. And we know that Japanese investors had a huge amount of outflows into emerging market carry and higher carry trades globally. But I do think we've seen probably the brunt of this move in terms of carry trade unwinding. We've already seen a lot of position shifting, and I think positions are moving closer to neutral.
Welcome back. You're watching Markets Forward, and it's time now to take a look at the big corporate voices of the day. So first up, BLS International soared a whopping 10% on the back of a strong Q1. The company's margins expanded by 600 basis points year-on-year to 27%, a multi-month high. The management told us that this margin expansion was led by higher service charge levied from new customers, and there was also a change in regulation in a few countries which mandated a shift away from partner-run model, which basically is profit sharing, to self-managed model. The company also went on to say, the management, that the margins at current levels are sustainable, and the aim of the company is always to expand and improve margins.
Well, Motherson wiring gained about 1%, and this after a strong first quarter. The company's management told us that they were optimistic about industry growth, adding that the firm was growing in double digits, and they continue to expect to maintain that particular growth rate. All right, well, it's time for our segment, D Street Chatter, stocks where Nimesh is picking up buzz one way or the other. Nimesh, what do you have?
Hi, Prashant. You know, the markets ended at days low, largely on back of selling pressure, but some individual names which are in focus. The first name is NTPC. Strong delivery-based buying has been marked for the last couple of days. I understand a leading long-only fund is an active buyer and accumulating NTPC at lower levels. So that's the first name. The second stock is BEL. The stock ended at almost days low after opening higher, largely on back of sell flows. There was a BOFA downgrade as well on the stock, largely on back of valuations, and there is selling pressure from domestic mutual funds as well in BEL. The third stock is GMR Airports, recovered from the day's low, and there was delivery-based buying as well, though small in terms of quantity, but some domestic mutual funds seems to be active buyers as well in GMR Airports. And the last name is Protein eGovern. The stock was under pressure on the back of weak Q1. In fact, from a flow perspective, I understand an NBFC, which was owning close to 3%, that's been completely cleaned out in the last many days, and some large HNIs have bought as well. But the stock was under pressure, largely on back of weak Q1 earnings.
Thank you very much for that. And before we wrap, we get you some of the key market events to watch out for. Bamakshi is standing by.
Well, absolutely, Rima. Lots to watch out for the trading session tomorrow. Let me first start off with the earnings that are expected to come through. First up is Apollo Tyres, Coromandel International, Godrej Consumer, Kim's, Dr. Lal Pathlabs, Lemon Tree Hotels, Pidilite, Radico Khaitan, Sula Vinyas, as well as Uno Minda are some of the names that will be in focus on the back of their numbers tomorrow. But apart from that, AGMs, lots of them in focus. Cummins India will be reacting to the commentary that comes from the management, the AGM as well as its numbers. Bata India, DLF, Radico Khaitan, Pidilite, Sobha, Coromandel and Aavas Financiers are some of the other names that will be in focus on the back of their AGMs. It is also important to monitor some other cues. The FM will be speaking on the finance bill. That will be an important one to monitor. We will be watching out for how the realty stocks react to that. Bank of Japan's summary of opinion will be presented, and China's trade data is also expected to come through tomorrow.
Right, Bamakshi, thanks very much for that. So events as we return tomorrow. It's a wrap on this edition of Markets Forward. From all of us here, it's goodbye. Thanks for watching. More coming up on the other side.
Usually in a session like this, when there is a sell-off across the board, you may wonder that a dip would get bought into, as has been the trend, but sadly that was not the case in today's session. And the benchmark indices, both the Sensex and the Nifty, saw their biggest sell-off since the 4th of June, and as a result of which 15 lakh crore worth of investor wealth was eroded after today's sell-off. And the sell-off was across the board, with 46 Nifty stocks ending in the red, with just a select FMCG stocks and some pharma names bucking the trend in today's trading session. And the sell-off, as I mentioned, was across the board. Metals, media, realty, auto, PSU banks, all of these indices saw drops of anywhere between up to 4% or even more, with metals and real estate being the biggest sectoral laggards in today's trading session. The key point also to watch out for today was the India Wix, and at one point of time the Wix was up almost 52%, and that was the biggest single day jump that it had seen since August of 2015. Eventually eventually ending 42% higher and above the mark of 20. That might be a cause of concern as well. There were, of course, global facing stocks that took a bit of a beating in today's session. Tata Motors was one of them, 7.5% lower, the top Nifty loser, and the other one was Samvardhana Motherson as well. That stock ended 10% lower, of course, because of the relations to the Japanese markets as well. 600 stocks, almost 600, 580 to be precise, on the BSE ended on a lower circuit in today's trading session. And of course, as I mentioned, there were select FMCG and pharma names that bucked the trend. Marico was one, Glenmark Life was the other. Devyani International, after its earnings today, ended in the positive, so that was a good sign. And lastly, on the commodities front, the crude oil prices have fallen to a lowest level in 6 months, and of course copper prices are at a 4-month low. There were specific sectors that bore the brunt of the sell-off today. Real estate was one of them. Almost every index constituent ending lower. The top
Well, hello and welcome to Business 360. I am Ashmit Kumar, and here are the headlines that we're tracking this evening. Sensex and Nifty end in the red for the third straight day after failing to hold on to intraday gains. 22 lakh crore rupees of investor wealth wiped out in the last 3 days. The Indian rupee weakens to a new record low for the 5th straight day. Demand for US treasuries and the dollar push the rupee closer to the 84 mark against the greenback. An uneasy calm on the streets of Dhaka after Prime Minister Sheikh Hasina resigned and fled to India. Bangladesh president dissolves the parliament. India's external affairs minister says border guards are on high alert and India is monitoring the situation of minorities in Bangladesh. The political upheaval in Bangladesh is a fresh spot of bother for Indian consumer companies like Marico, Emami and Bajaj Consumer. Paint maker Kansai Nerolac may feel the pinch too. On the other hand, Indian textile companies expect more order inflows. Infosys seeks 10 days to seek reply to a pre-show cause notice from the Central GST Enforcement Authority. Sources say 10 foreign airlines operating in India also get GST notices worth 10,000 crore rupees. International Air Travel Association calls the levy flawed and warns that it could dampen India's aviation potential. CBI lodges an FIR against Hindalco 8 years after registering a preliminary inquiry. Alleges violation of environmental clearance granted for coal mining in Odisha from 2000 to 2013. The FIR also names Chandni, then director in the Environment Ministry, for allegedly providing undue benefits to Hindalco. Sources say the government prefers grandfathering till July as a relief to counter the removal of indexation benefits for real estate, also considering if people should have the option to choose between the old and the new capital gains tax regime. No final decision yet. Ola Electric's 6,000 crore rupee IPO receives twice the number of bids for the shares of offer. Institutional investors fully subscribed to the issue on the last day. Akasa Air will grow by 50% in this financial year, says founder and CEO Vinay Dubey, as it enters the third year of operations. Adds that the path to profitability will be on par with the finest companies without providing a definite timeline. That's an exclusive. Fears of an escalation in the Middle East intensify after US troops are attacked in Iraq. Israel bombs the West Bank, killing 8 people. More than 39,600 Palestinians have been killed so far, according to the Gaza Health Ministry. Wrestler Vinesh Phogat stuns the world #1 and defending champion Sasaki of Japan with a dramatic last gasp victory enters the quarterfinals. Defending champion in javelin Neeraj Chopra easily qualifies for the final. Well, here's a top story this evening. Bangladesh Prime Minister Sheikh Hasina's iron fist rule of 15 years that saw stifling of opposition voices, crackdown against journalists and allegations of human rights violation has come to an end yesterday. Hours after Hasina tendered her resignation and fled to India, the army chief said that an interim government would be put in place. The students' body, which has been at the forefront of the protest, said that they want Nobel Prize winner Mohammad Yunus to serve as the chief advisor for the interim government. Today, the Bangladesh president dissolved the parliament. He also ordered the release of opposition leader and BNP matriarch Khalida Zia, who is currently serving a 17-year sentence in a graft case. Yesterday was the culmination of months-long protests by students and activists. It first began largely as a peaceful movement against a High Court ruling in favor of reinstating 30% quota in government jobs for descendants of freedom fighters. But it gradually transformed into a full-blown movement against the government after the Hasina government began a brutal crackdown against the protesters. Over 400 protesters have been killed since yesterday. Protesters stormed the PM's official residence, the parliament building, as well as vandalizing the premises. Back in India, the government has called for an all-party meeting to apprise political leaders of developments in the neighborhood. Speaking at the parliament later, External Affairs Minister S. Jaishankar said that the government was in continuous touch with the Indian community in Bangladesh through diplomatic relations. However, the government is yet to clarify on whether or not Hasina has sought asylum in India.
On 5th August, demonstrators converged in Dhaka despite the curfew. Our understanding is that after a meeting with leaders of the security establishment, Prime Minister Sheikh Hasina apparently made the decision to resign. At very short notice, she requested approval to come for the moment to India. We simultaneously received a request for flight clearance from Bangladesh authorities. She arrived yesterday evening in Delhi. We are in close and continuous touch with the Indian community in Bangladesh through our diplomatic missions. There are an estimated 19,000 Indian nationals there, of which about 9,000 are students. The bulk of the students, however, have already returned to India in the month of July.
Well, for more on that and the latest on what the on-ground reality is as far as Dhaka is concerned, we're joined by senior journalist Salahuddin Shoaib Chaudhry, joining us from Dhaka. Also with us on this panel is Aneek R. Haq, a barrister from Bangladesh, also with us on the program. Mr. Haq was one of the lawyers representing petitioners seeking an order for the police to refrain from firing on protesters. Mr. Chaudhry, Mr. Haq, thank you so much for joining us. Mr. Chaudhry, let me come to you. We've seen different emotions which mark different stage of these protests that we've seen over the last 1 month. There was first initially a sense of frustration, then a sense of extreme anger. Since yesterday, we've seen a sense of euphoria taking over the protesters, taking over the students, taking over the country. The fear that many are expressing is that this could next translate into a sense of majoritarianism, a sense of extremism, also resulting in perhaps attacks on minorities, which are already being reported, not being verified, but reported so far. What are you picking up from what's on the ground? What is the mood at this point, 24 hours after Sheikh Hasina has resigned?
Thank you very much. Actually, since the Sheikh Hasina resigned yesterday and she fled the country or left the country, so there is in the name of celebration, there is vandalism in the official residence of the Prime Minister and also in the Parliament House and many other places. And until now, we are getting report of attacks on Hindus, Hindu properties, Hindu homes, Hindu temples. So when this kind of the acts are continuing, just now we have received an information that Bangladesh police has set forward 9-point demand, and until their demand will be met, they will go for a strike. This is a condition. On the other hand, the leaders, the conveners of the anti-dress discrimination student movement, they are coming up with their own proposal for an interim government with Nobel laureate Mohammad Yunus as the head of their proposed interim government. And they are also saying, very interestingly, they say that the tenure of this interim government should be 3 to 6 years, because they are not only demanding holding of an election, they are demanding a reform in various places in the country or in the state system. So this is something happening in one hand. Other hand, Khalida Zia has been released from the prison, and the president has resolved, as he was saying, the parliament. So BNP is now demanding holding of the election within the next 3 months. And they are also demanding formation of the interim government immediately. So this is a very kind of the confrontational situation. And if you are getting information from Bangladesh media, Tariq Rahman, BNP's acting chairman from London, he is giving statements, and they are trying to give an impression that BNP is a ruling party. So, I mean, it's a kind of the chaotic situation, very chaotic in Bangladesh.
Chaotic situation. Let me take that across to Mr. Haq. Mr. Haq, similar question to you, that the apprehension coming from various quarters is that the degree of anger that we had seen against Sheikh Hasina will now translate into that public momentum and public opinion consolidating in the hands of people on the extreme end, or the other extreme end, which in this case would happen to be Islamists, extremists, fundamentalists. That is the apprehension. Is that a valid fear? Is that the momentum that you're also seeing in Dhaka and other parts of the country?
No, sir. I humbly disagree on this point. We have seen some sort of vandalism in the ruling parties. That was the Sheikh Hasina's home, and very deplorably where our Bangabandhu used to stay. That was a museum and all these, and in the parliament. But at the same time, when this was done, after that today, we have seen that the things that has been snatched away from there are slowly being returned. And today the students actually started cleaning the parliament and restoring them. The students themselves started this. At the same time, there has been some stray incidents which we've been hearing or seeing in the Facebook, that some sort of like goons have been trying to attack the homes of Hindus and temples. But right then, in the evening, when these things started breaking out, people started revolting against that. And I have seen myself that students of all the madrasas and the students, they have surrounded the temples to save their Hindu brothers. And I have actually been talking, and we have been all night. I myself have been standing near a temple where I have seen that all walks of people from the backgrounds of Muslim or Hindu, they have been there trying to stop the vandalism over there. So I believe that, yes, there has been some incidents, but at the same time, people are coming into their senses and stopping these and protecting our minority.
Let me then ask you a follow-up question. Let me then ask you a follow-up question with respect to the road ahead. We are looking at an interim government. We're yet to have a final confirmation from Mohammad Yunus whether or not he's agreed to lead that formation or whether he's agreed to assist in the form of a chief advisor. We're still awaiting a final word on that. I just want to get a word in, Mr. Haq, from you on the role of the army. The historical lessons that the subcontinent teaches us is that anytime the army takes a role which is front and center, it doesn't usually end well, and that's the apprehension, that's the fear here as well. Are we being too trusting in terms of placing all the trust? Is the country being too trusting of the army, trusting the benevolence and the graciousness of the military leaders at this point?
You see, the situation in Bangladesh was such that even we have welcomed the army, anyone but Sheikh Hasina, that was sort of like the mentality over here. And now actually from what I am getting from the students' movements and they have taken help of the army to depose her, but they do not want army to be in power. That is exactly why probably what we are getting, that the advisory body that is being prepared, that there is no influence of army. They're trying to make sure of that, and people also want that, because the experience in this subcontinent when the army comes to power is not really good, and people have taken a lesson from that, and they are not at all willing to be under the army rule. So yes, army has been sort of like dependent upon, but they are not dependent upon for ruling the country, running the country. That would be left with, not with the politicians at this moment, rather from the civil society who has experience in all these.
Right. Mr. Chaudhary, coming to you now again, just to get some facts from you. You're there on the ground. Will you be able to assist us in terms of what the situation looks ahead for the composition of this interim government? A lot of speculation, a lot of questions. We were hearing names of Dr. Salimullah Khan last evening. This morning, that name has turned into Muhammad Yunus. We are yet to get a final word from him. What does the composition of this interim framework look like? Or what will be the mandate of this interim government? When are we likely to see elections?
You see, just a few hours ago, Mr. Sharjiz Alam, one of the key conveners of the student protest, he in a Facebook post said that Islam will be the ruling law of Bangladesh and Quran will be the constitution of the country. And when I just picked up his Facebook post and tweeted on my Twitter account, and it was already reported in some media, and he quickly removed that post. But whether he has quickly removed that post or what, but it shows their intention of turning Bangladesh into a neo-Taliban state. And their tendency is like that. And as we just heard that Parliament is being cleaned. No, Bangladesh Parliament has been devastated, completely ransacked. It is not cleaning is not enough. It is ransacked. It will need a lot of money to rebuild or refurbish the whole thing. So Parliament is ruined. And when Parliament is ruined, democracy is at risk. And I don't see any possibility of any democratic atmosphere in this country, even in the distant future, no.
Mm-hmm. Interesting thoughts, those. A lot of question marks being raised here, a lot of chaos there as far as Dhaka is concerned. Dramatic visuals coming out of Bangladesh at this moment. We'll, of course, continue to get you the latest from the developments from India's neighborhood. Mr. Haq, Mr. Chaudhary, appreciate you joining us with your time and perspective. With that, we're heading into a very short break. But coming up, Sensex and Nifty end in the red for the third straight day after failing to hold on to intraday gains. More on that when we come back.
Suntech Realty, Brigade Enterprises, Godrej Properties, all of them seeing losses of between 5.5% to 6.5%. Railway PSUs are bearing the brunt as well. IRFC, IRCON, RVNL down at least 25% now from the peaks that they made last month. Defense PSUs, a similar story playing out there as well. Mazgaon Dock, Cochin Shipyard, Garden Reach, all of them ending lower, almost 5% or more. And metals having a meltdown in today's session. The metals index also was down nearly 5%, 6.5% lower for SAIL, similar for NALCO and Jindal Stainless, 7.5% lower in today's session. So all in all, red across the screen, and there was no sign of any sort of support at lower levels.
My wife, for instance, and she's been such a big contributor in what I've become eventually. I think some of the soft skills actually, and these are aspects, and the ability to without getting sort of stressed, being able to manage many different things. I'll just give you one example. When I was a CA, typically, and many of the advisors, the Indian Economic Service actually are women. They would be in a meeting with me maybe at 3:30, 4 or something, and they'd get these calls actually, and they would be, because they're in a meeting with me, they would be, declining those calls. If the call comes twice or thrice, I knew this was actually either their kid or their mates calling basically for what needs to be made for dinner. Yeah. And so because that's exactly what, my wife, so when I was at ISB, it's the rare occasions when she was not instructing our kids or the maid to actually say what needs to be cooked. My kids would call me up. I would be at a loss actually.
Believe in your strength, right? What is your strength? Carry that, right? It is your deep technical knowledge, your perspective, because that's where the new ideas generate, right? So keep focusing on that. That is one thing that will give you a purpose. Second thing is networking, right? Network with people whom you come across, building the network where you can share your ideas, express them, trash them out. That is one thing which is going to be very, very helpful as you go ahead. Third thing, I will have to say that keep learning, right? Our industry is about change. So it's a lot of innovation every day. Even actually, sometimes it is impossible to catch up with everything. So keep learning. Wherever is an opportunity, learn it, right? And the last but not least, resilience, right? Don't get disheartened by a failure, right? Failures will happen. Learn from it.
Welcome back. Let's begin with a quick look at the stock market action for the day. A day of volatility on the Lal Street as Sensex and Nifty failed to hold on to intraday gains. In fact, both the indices ended at the low point of the day, closing in the red for the third straight session. In the last three sessions, investor wealth to the tune of 22 lakh crore rupees has been wiped out. Global cues were mixed today. European markets remained in the red, but Asia saw some bounce back. Japan's Nikkei gained 10% today after plummeting 12% yesterday. Shares also bounced back on Korea, but no such luck in Hong Kong and mainland China. The Indian rupee, meanwhile, weakened to a new record low for the fifth straight day. Demand for US treasuries and the dollar pushed the rupee closer to the 84 mark against the greenback. An IT major, Infosys, has sought 10 days to respond to pre-show cause notice sent by the Central GST Authority. This comes a week after the company was sent the notice to the tune of over 32,000 crore rupees by the Directorate General of GST Intelligence. Sources tell us that the notice was sent after proper assessment and due diligence. And well, speaking of GST, the Directorate General of GST Intelligence has sent show cause notices to 10 foreign airline companies operating in India to the tune of over 10,000 crore rupees. We have learned from sources that Emirates has been sent a notice for allegedly evading taxes worth 7,500 crore rupees, while Etihad has been sent a notice for 1,660 crore rupees. The tax authority has claimed that these notices were pertaining to unpaid taxes on import of services by Indian branches from their head offices. And meanwhile, opposition parties staged a protest in the parliament against GST on health and life insurance premiums. Union Minister Nitin Gadkari wrote a letter to his colleagues in the finance ministry, particularly Nirmala Sitharaman, seeking removal of the GST. West Bengal's Chief Minister Mamata Banerjee has also made the same demand. Now, opposition leader Rahul Gandhi has also thrown his weight behind the demand to scrap GST on health and life insurance products. And also importantly, the CBI has now registered a case of corruption against Hindalco Industries and a former director of the Environment Ministry. 8 years after registering a preliminary inquiry, the agency is probing allegations that Hindalco violated the green clearance for coal mining in Odisha from 2000 to 2013. Abhimanyu Sharma is joining us now with more details. Abhimanyu, tell us about this CBI case. Why are we seeing this case move forward 8 years after the preliminary inquiry?
The CBI is probing the alleged violation of green clearances granted for coal mining in Orissa between 2000 and 2013. It's also probing the alleged bribes to officials from the Ministry of Environment and Forests. A corruption case has been filed by the CBI naming Hindalco Industries, then Director of MOEF T. Chandani, and several others as accused. Now, interestingly, the issue dates back to the duration between 2011 and 2013. The preliminary inquiry was filed in 2016 and the FIR was filed as late as 2024. Now, according to the FIR, Hindalco Industries had allegedly violated the environmental clearances granted for coal mining in Odisha and had mined 3.045 million tons of excess coal than the permitted capacity. Then Director of MOEF has also been allegedly misusing her office as per the FIR. She granted further environmental clearances to the private company to double their coal mining capacity in prohibition of the rules laid down by the ministry in critically polluted areas. It remains to be seen how early any action would be taken in this case and whether any former officials or any private persons would be questioned in course of time.
Right, Abhimanyu, thanks a lot for that. Now, Akasa Air will grow by 50% this financial year. That's the word coming in from founder and CEO Vinay Dubey as it enters the third year of operations. Speaking in an exclusive conversation with Shireen Bhan, Dubey confidently added that the airline's path to profitability will be on par with the world's finest companies without providing a definite timeline. Take a look.
What should we expect realistically in terms of capacity addition for this financial year?
So this financial year, we've said that we will grow by 50% compared to the last. Last financial year, we grew 300% compared to the previous. So 50%, 300%, these are numbers that we haven't seen before for an airline at this stage. And by the way, we're not talking about going from 1 to 2. You know, these are on a pretty fast base. I mean, I think we've talked about it before, but Akasa in its first year has broke, every conceivable record globally in the 123-year history of global aviation. So 50% in this particular fiscal year.
And when we last spoke, you said that you were also looking at doubling pilots. What is the position on that front? Are you still going ahead with that plan?
Yeah, in fact, Shireen, this is, as Belson talked about, we're building not just a brand for our consumers, but being employee-centric from day one is something we've talked about, right? We've talked about being, having service leadership, cost leadership, employee centricity, and building this on a platform of world-class safety. So employee centricity has been a super important element of who we are. I'm happy to report that we've got over 800 or approximately 800 pilots already with Akasa. So at this point, we've actually stopped pilot hiring.
Okay.
We've got, and part of the reason we've been able to attract pilots is because of our employee centricity, the patterns that we offer, the lifestyle patterns that we offer our employees, the focus we've got on training, the new generation of aircraft that we're flying, we're very, the respect and transparency with which we hope we treat them, and not just pilots, but all our employees. So at this point, specifically, we're no longer hiring pilots, and we will be that way for some period of time.
Okay. And the legal issues that you had with pilots, is that a thing of the past? And what have been the lessons learned from that experience?
To be honest, I think we're all of that is well in the past. And for us, we're just, focusing on making sure that that we continue down our path of being employee-centric. And so that's where we are today.
Well, you can catch that entire conversation with Vinay Dubey and Belson Coutinho of Akasa Air with Shireen Bhan at 7:30 p.m. right here on CNBC TV 18. And with that, it's a wrap on this edition of Business 360. More news and updates continue right here on CNBC TV 18.
One particular moment, so I actually come from a very humble background. My father lost his father when he was just 7 years old, and just completed school. I was the first person in my, clan to go to university. So when he first came to campus, and I took him to the library, the Vijay Kelkar library there. I remember him actually being very emotional and saying, at least in my next life, I get the opportunity to study in a university like this. So that moment is something which is etched in my memory. I'll be absolutely honest, I did not even know what a chief economic advisor is at that time. If somebody said I'll be X, Y, or Z, or even executive director, I don't think even I knew what the International Monetary Fund was.
I came here in 1991. 1991, that was my first year of college. I came here for inter-IIT. So I remember this campus especially because this is one thing that I think especially the women need to hear. So I was, good in table tennis, but I became the captain because my captain dropped out. And I came here and we were playing and I won the first game. And then all the men started booing me.
Are you serious?
Yeah. And so I realized the power of mind, right? Like, I was better than the player that I played against, but I lost. And I think that was my first lesson that I learned, which is that, you might be better, but sometimes, your circumstances make you believe you're not, and therefore you lose. So I think that's one thing that everybody needs to do, and I think coming back to this campus...
We have to correct that. We have to give it a big round of applause now to make up for what happened in the past.
Yeah, but my coach also gave me gajar ka halwa, so it was okay.
today she is the director for the mission that actually saw India's first private rocket being launched. So tell us a little bit more about that, Saranya, and what you did that all under 30.
They gave me an opportunity to be the vehicle director for the mission. So it was a huge learning for me to build. We started off the company by at least when I went in, I didn't know anything about the rocket building. So to building a vehicle which can actually fly, it was amazing.
Not just actually fly, it's actually flown.
Yeah.
So congratulations to you and to the entire team at Agnikul. You know, I know for many of the students here in the room, you're a role model, but you talked about Naveen being the initial role model for you when you got started. But let me end by asking you, who do you look up to today? Which are the companies that you respect and admire? And, you know...
Hello and welcome to Commodity Champions. I'm Anisha Gupta. Well, India's gold sector gets a new self-regulatory body. The organization, which has been set up with the help of World Gold Council, is aimed at boosting consumer confidence. The Indian Association for Gold Excellence and Standards has been tasked with ensuring free, fair and sustainable practices in the industry, along with regulatory compliance. The association will establish a code of conduct and introduce an audit framework created by the industry itself. It is set to be operational by early next year, and the adoption of the organization's code will be entirely voluntary for companies. To understand more about what the body aims to do, I'm joined by Sachin Jain. He's CEO of India for World Gold Council. Sachin, I thank you so much for joining us. And there's so much to talk about in sense of gold. But first of all, about this new body that has been formed, and as the press release suggests, that it will be operational early next year. Why do you think it was needed?
Manisha, thanks so much for getting me on. And it's such an important step that we as a world, as the gold industry is taking. And I'm really proud to share that this is the first time there will be a self-regulatory organization in the gold business anywhere in the world. And the first step is going to be in India. That gives me a lot of pride. And the fact is that, self-regulation as a concept is a area envisaged and promoted and suggested by the government of India. And it exists already in various industries. The fact that we're now trying to implement the same in the gold business is not something that we started thinking about it just now. It's been an endeavor and a conversation for very many years. We've, amongst all the researches we've done with the end consumer, the consumer on the street who's willing to consume gold, there is, in all the researches come out, there is a trust deficit. And in order to, sort of minimize the trust deficit, in order to almost organize the industry better, to have one voice of the industry, a self-regulatory organization is a great step. And if I were to explain to you what that really means, is that it's between an association that exists between the industry and the government regulator. And this self-regulation, which, as you mentioned, is voluntary, is around a code of conduct, is based on an audit framework. And what it'll do to the end customer is that you can put your hand on the heart, and when you see that logo of IAGES that you just now talked about, which is India Association for Gold Excellence Standards, you could be rest assured that the business integrity and the business process in this enterprise is well taken care of. So the intent to provide, as you said, more transparency, but really more confidence into the gold business.
Sachin, also, various Indian associations are part of it, and many of these associations, whether it's the IBJ or GJPC and the other ones, have their own members, and they also do some verified checking in all their members as well. There are various schemes run by all of them. Would you say that with the formation of IAGS, you will perhaps supersede all of those?
Well, intent, Manisha, is not to supersede anybody. Everybody comes in as a specialty of what they do. The intent of IAGS is to be across the value chain. So the membership is open to people right from bullion trade, refinery, trading, manufacturing, retailing, digital play. So it's through the value chain of the gold business.
And Sachin, is there a cost of joining this? Is there a cost to all of this?
Well, the cost will be to get the audits done. And yes, there will be a cost around it. But the intent is not the cost and hence the governing body. The intent is really to create a future where, and we believe that industry at large does a great amount of work based on integrity, based on the rules and regulations. The core objective of IAGS will be to, one, recognize people who are doing a great job and, garner their interest. Secondly, give a roadmap to people who want to accelerate and do things better. So, for example, this is not an organization for only big players in the industry.
Okay.
So hence it's a big boys club. Any and everybody in the gold business can be members of it.
Sachin, I've been in the industry very, very long time. So have you been? And we do realize that various self-regulatory programs like these have been brought earlier as well into the system. Haven't really worked and worked. What makes you think that this will for sure work? Is it because all the associations have come together for the first time ever?
Well, that's certainly one, Manisha. I think also the need of the hour is that by end of this this year, 70% plus of our country will be millennials or younger. And as an industry, we got to gear up to have right answers and right solutions for the new age consumer. That's number one. That'll be the core driving factor. The interest of World Gold Council here is to provide the seed, provide the infrastructure, provide enough support, not just for year 2024, but also for the years to come forward, where we will be ensuring that the right investments are made, that the name of IHS, the logo of IHS is gaining a lot of popularity and is well understood by the end consumers. So while it's about creating something, and you rightly said that there have been a lot of initiatives like this, the difference really here is that the governing body or the governing board of this association on one side will have the associate representation, but also will have independent board of directors, which will guide the process forward. And secondly, we'll be investing huge amount of energies and money to communicate and made aware of what IHS is to the end consumer. So that really walk into stores which stand for integrity and hence have the IHS logo.
All right. So I actually want to come back to the consumer-centric part of this. And in the last 5 or 6 years, we've seen hallmarking come in a very big way. We've seen more organized players, more organized chains opening up as well. There is more transparency. People are aware more about certification when it comes to diamonds and various other things as well. We've seen IPOs come in. So yes, in that sense, the industry really seems to be growing with leaps and bounds. When it comes to directly to the consumer, what is it that the consumer now can look forward to with IGS? Knowing that that your participant or your member is clearly clean in that sense.
Well, I think, Manisha, for different verticals, as I mentioned, different parts of the value chain, the different layers of code of conduct that every player will have to adhere to, and the audit will happen by independent body, which will be done through auditors. So it's pretty serious in that sense. And I can assure you that the way it's framework, it's incorporating the big and the small, the geographical variation of rural and urban, and big to small and everybody else. Now, what that will do is will almost create a framework of understanding or being sure that right business practices are followed. So while you're talking about hallmarking, yes, of course, that's industry norm now, but taxation paying. Are you providing, is there no child labor in our business? Are you providing enough infrastructure for your laborers? Are you providing, proper billing standards? So all of these things, which will be important for a consumer at large.
Sachin, well, that's about the new organization. Of course, we'll keep an eye on that as you have more framework and more guidelines to share with us as well. I mean, as you said, this is going to add another layer as also the part being that more associations are coming together for this. So I'm assuming that there would be more harmony within. And when you're talking to the government, it would be one voice. I mean, that is something that was clearly needed within the industry here. But let's talk about the gold prices also. And that clearly has been one of the top stories too. The global market seeing a decline and, of course, the duty cut within India as well. Has all of that stabilized? The premium that we saw in the prices a few days ago, would you say the markets are now more settled?
I think markets, Manisha, will be settled, I think, in a little more time, because also this is compiled with the global volatility that's happening and the financial markets going up and down. So that's one part. I think the custom duty cut has been a very welcome move. It almost gives a great throughput to the Indian consumer to actually consume more gold. And a lot of comparatively with this, the cut of all the smuggling grey channel, I think the Indian industry will operate at a parity. And lastly, when we look at the overall numbers as to what does the gold business contribute, there'll be a fair number that includes every part of the gold business. So I think with that given, we foresee that these quarter 4 with the festive season coming in, And also right now, in the next one or 2 months, we're seeing a lot of preparation happening by the industry and the jewelers as such. We think that Q4 will be a very important quarter, very buoyant quarter for the business.
Oh, absolutely. Next week is IIJS and all eyes onto that one as far as the industry goes. But a final question, Sachin, and there still is this fear about GST. I mean, some pockets of people are still talking about that there could be a hike on that. Your sense on that? And the two, what's your sense on the import number now? And as you said, that the festival season could be looking at a higher demand. So if compared to last year, what kind of demand numbers are you looking at?
Sure. So Manisha, to answer your first thing about GST, I think it's a lot of conversation that we are doing as an industry, within the industry, by our industry. I don't think there's any indication that's coming from the government of India yet. The last time when the GST numbers were, or the numbers was getting set, there was a great amount of consultation that the government of India did with the industry at large, what it's going to be for the gold business, what it's going to be for the diamond business. And I foresee that even if any change is going to come, it's going to go through a lot of conversation at the right level. So I think we're sort of shooting the gun a little too ahead, and we should focus on, as an industry, focus on the opportunity now, the corrective measures, and the very important strong measure that the government has taken, and garner the benefit of that. That's part one. Your second point about what we envisage as the import number. If you reflect on Q2 and the results of Q2, we've ended the Q2 at almost about 149.7 tons of consumption, which is, with the combination of investment demand, which went up by 47%, which is huge, and also 17% drop in jewelry. Now, that was the end of Q2, where with the price of gold, we saw a slightly dampened demand of the end consumer on jewelry. Now, with this change of correction, now our earlier envisaged number for the year, which was around 700 to 750 tons, I think we will still get to that same number, perhaps at the end of that number. And hence, I think that even with this slightly slowdown in Q2, it's going to get picked up and we'll get to the same numbers minimum at 700 to 750 tons at the end of the year.
All right. So strong numbers coming in, and of course a lot of euphoria after the prices have declined, and why not, because we're heading into the festive season as well. Sachin, thank you so much for joining in and talking all things gold. But with that, we have to take a very short break. But coming up, the crypto markets have improved after a near meltdown on the back of sell-off in wider markets. A discussion with Dilip Shenoy, chairman of Bharat Web3 Association, when we return.
Specific that you would like to emulate in your style of working?
The one individual that I have, I wouldn't say seen in very close quarters, but seen from some distance as part of my work in CII, but I truly admire is Mr. Uday Kotak. I think he has built a franchise in a bank that is truly outstanding. And to do it in one generation, and the quality of talent and the kind of ownership that that talent takes is remarkable.
Finance Minister Nirmala Sitharaman is just a few hours away from marking a new record. The CNBC TV 18 coverage of the Union Budget starts right now.
Hello and welcome to CNBC TV 18 Motilal Oswal Budget Headquarters.
markets have not just grown, they've broken several records in the last 25 years.
India's contribution to incremental global GDP was as low as 0.2% 25 years ago.
Welcome back. You're watching Commodity Champions, and the cryptocurrency market has improved after a near meltdown on the back of sell-off in wider markets on Monday. Bitcoin fell below 50,000 to Feb lows as investors fled risk assets. Meanwhile, Ether's 25% decline in a single day was the most since May 2021. Well, the rising tensions in the Middle East and concerns about the strength of global economy ate into investors' confidence. The bloodbath led to over $1 billion in liquidation in crypto futures market. Bitcoin prices have fallen by over 16% in the past 1 week, while Ether has seen a slump of more than 24%. Joining us to talk about crypto markets and, of course, various issues at hand is Dilip Shenoy. He is chairman at Bharat Web3 Association. Mr. Shenoy, hi, thank you so much for joining us. First of all, in the price moves itself, and of course, every global asset was declining, and so were cryptocurrencies in that sense. But the way the global markets are right now and the prices have moved, what's your sense on what really could be the step ahead?
Well, Manisha, thank you for having me here. And, as you know, BWA does not really look at the crypto prices as such. But since you asked the question, I think, Sunday and Monday events were unprecedented in the world, right? So given that, it actually affected every market, and the crypto markets were no different. You will see, while week on week, as you're showing, and day on day, or from a 6-week high price, the prices decline. But I think the signs are that there'll be some stability before there will be some recovery going forward. But again, a lot depends on what happens in the Middle East and in other parts of the world, because that could trigger different reactions from a different set of people.
Oh, well, absolutely. And let's also talk about concerns at hand and within Indian markets on what really has conspired with WazirX, nearly $230 million of a highs there. Of course, the exchange has been coming on yet and again with various kind of solutions, haven't gone down so well with the participants and public at large. What's your sense on what the learnings are from the global markets on this one, and how would India or how would the exchange now look at it?
So I think, Manisha, that the response from the exchange is one thing that, I'll just briefly talk about, but let's talk about the future. I think the exchange is trying to gauge what the investors in their community want, and therefore they've conducted polls, etc. And you'll see some more of that happening. The good point is that the exchange, like all the other hacks that happened earlier, is looking at paying back their investors in full, but it makes some time going forward. And it's a process that is going on, and it's not appropriate to comment at this stage, excepting that they are engaging with their stakeholders and they're trying to find a solution going forward. There are two lessons in this, and this is what you actually talked about. The first is that, okay, what is this whole cybersecurity and the security issues there? So what we at BW have done, we've actually written out to all our members, and members have started nominating their representatives on the chief IT security officer, CISO group, and we're going to look at sharing best practices, look at global best practices. BW is also reaching out to its international partners and trying to see how we actually address this issue collectively going forward. And that, getting out best practices, looking at self-declaration, getting and posting things so that the customers know what the state of action with each of the exchanges is, right? And it may be with other companies as well, which are consumer focusing. The second is that, as you're aware, that we've got our consumer code, right? We had developed a consumer code that was really focused at the whole issue of anti-money laundering and the FIU kind of compliance and the consumer, etc. We are putting together the whole our legal team, legal committee, and the compliance subcommittee are getting together. They're actually the meeting will happen, maybe in a few minutes from now, must be happening at this point of time, to look at getting in inputs and collectively looking and updating our consumer code and actually looking at how to address such issues so that these things are known before something actually happens like has happened in the recent past.
And that's not just it, because Mr. Shenoy, there was another news report that I was reading that there also has been a tax show cause notice which has been issued to Binance. I mean, this is all source-based really, at about $86 million in India. And Binance has challenged it. And this is a notice that covers from June 2017 to March 2024. I mean, as you said, there's work being done within Indian market so that we can look at legal and compliance issues here. How would you read this story as well?
Well, the issue really here is that if you're operating in India, you have to comply with the Indian laws. As you're well aware that we have a 1% TDS, we have a 30% tax, and there's no offsetting of losses. And I think if you're serving customers in India and they are trading on your platform, then on the commissions that you make, the GST authorities believe that tax should be paid. So they have actually issued a notice, and as you have said, Binance has actually challenged it, and I think now we will see how it goes forward. But the BWA stance has always been that, please, if you're operating in India, please comply with domestic laws. If you have to deduct TDS, please deduct TDS. If you have to pay GST, please deduct GST. In fact, our members, we have a lot of members who are in the taxation field who work with exchanges and consumers to help them file the returns and meet the requirements of the IT Act. As you know, there's a special section where you have to declare the assets. The calculation of tax on this has now more or less been automated, so you can actually do this. So the BWA's effort is really to get all its members and everybody operating in the community comply with the local laws and be there. And if there's some notice and the company is challenged, we'll have to wait for the outcome of things here.
So, Mr. Shenoy, as a lot of work is being done, but this is not, it never promised to be an easy path to begin with. When you look at the Indian markets and when we look at Web3 and blockchain and crypto for that matter, how would you look at India participating into this? Where do you see the challenges? What is the outcome anticipated of this? And how do you see the vision ahead, road ahead from here?
So I think, Manisha, there are two aspects to this entire thing, right? As Chris Dixon puts it very nicely in his book, Read, Write, Own, there is the investment, which he calls the casino thing, and there's a computer, right? And the computer applications which is what is a very interesting part for India. And the linkage is very simple, that India has 12%, upwards of 12% of global manpower in these areas. We have over 1,000 plus startups in this space. And there are lots of small applications. We must understand that, we are somewhat like the early days of IT, where the only thing you could have was maybe the early versions of Excel or Word, etc., not the sophisticated versions that you have now. And then the applications are developing. So there are many applications. Many state governments are using this technology to do pilots in their states, and from areas of tokenization of land records or tokenization of real estate. The caste certificates in Gadchiroli were quoted by the Niti Aayog as a very good example. In UP, you have now filings or FIRs on the blockchain. You have over 35 to 40 applications in approximately 18 to 20 states, right? And those are that are known. There's many more things happening in different states, right, where this is happening. And if you look at Web3 and you look at the metaverse space, right, and the AVGC space, there's a lot of, almost all states are looking at state-level policies, etc. here. Now, what's going to happen in the future is, like we moved from Web 1 to Web 2, where it took some time to move, all Web 2 applications initially and more new applications. The challenge that is happening now is a lot of people are trying to convert Web 2 applications to Web 3 applications. But there are a lot of new applications which are there where Indian startups around the country are doing, and they're doing pilots and testing it. And I'm sure we could actually get world beaters. Even if we could layer 2 technology, right? Polygon is actually an Indian company. Okay, and it's up there amongst the best companies. A lot of people don't know that Brave, which is competing among the top 4, browsers, is actually based out of, was set up by Indian founders, although they have set it up outside of India. And therefore, the statement recently by the finance ministry that they're looking at coming out with a policy to regulate this space is very, very welcome. We will be working fully in partnership with them to ensure that India can actually add nearly close to $1.1 trillion if we actually give good support to this sector going forward. And that is where I think all companies and the youth of India can actually do that. So Indians spend a lot of time on using their phones and using the web, etc. Today, there's very little opportunity for them to monetize it. But Web3 gives the opportunity where people will be able to monetize it and earn while sitting in India, and will create a lot more entrepreneurial opportunities going forward.
Absolutely, Mr. Shenoy, we hear that, but I also get your point about best practices within India, full compliance to the Indian laws. And as you mentioned, that there are 35 to 40 applications in 18 to 20 Indian states which are using Web3 and blockchain. I mean, that perhaps is the way forward. But as of now, certain issues, and as you said, the community clearly seems to be working towards that. But thank you so much for joining in and putting in a light on all of those matters. But with that, that's completely out of time on Commodity Champions. Thank you for watching.
Over the last 25 years, CNBC TV18 has closely followed the remarkable ascent of India's pharmaceutical sector.
There was a time 25 years back that it was all about the FIIs. If FIIs would buy, markets would rally. If FIIs would sell, market would fall.
Earlier, we were net importers of steel.
From IT services to SaaS, from consumer electronics to space tech, from mere programming to AI ML.
Cars, two-wheelers, three-wheelers, commercial vehicles have significantly become much more expensive than they were 2 decades ago.
Discounting is high there, but their focus is squarely on the 125cc segment.
Now it is contributing 16% of incremental global GDP.
Now we are looking at exporting the steel that's made here in India.
Welcome to the first ever India Business Leader Awards.
Cars, two-wheelers and vehicles generally being manufactured today are much lower on emissions and much higher on safety.
India's technology industry has been at the forefront of cutting-edge innovation over the last 25 years.
It's the retail which is the driving force for the market right now.
Clearly, we have arrived on the global economic stage.
Great way to celebrate our own 25th year with new milestones being achieved on the Lal Street.
21 years of the Nifty from 1,000 to 10,000 today.
Sensex and Nifty hit a record high.
The Nifty rallying to a record high.
We invite you to join us as we persist in leading coverage of the pharmaceutical and healthcare domain, documenting India's expanding expertise in medicines.
25 years of excellence and unparalleled growth.
CNBC TV18, embarking on a quarter-century of excellence.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From from chronicling the stories of India's startup universe to becoming a success story in itself as India's longest running show on startups and entrepreneurship.
Well, hello and welcome to Business 360. I am Ashmit Kumar, and here are the headlines that we're tracking this evening. Sensex and Nifty end in the red for the third straight day after failing to hold on to intraday gains. 22 lakh crore rupees of investor wealth wiped out in the last 3 days. The Indian rupee weakens to a new record low for the fifth straight day. Demand for US treasuries and the dollar pushed the rupee closer to the 84 mark against the greenback. An uneasy calm on the streets of Dhaka after Prime Minister Sheikh Hasina resigned and fled to India. Bangladesh President dissolves the parliament. India's External Affairs Minister says border guards are on high alert and India is monitoring the situation of minorities in Bangladesh. The political upheaval in Bangladesh is a fresh spot of bother for Indian consumer companies like Marico, Emami and Bajaj Consumer. Paint maker Kansa and Aerolac may feel the pinch too. On the other hand, Indian textile companies expect more order inflows. Infosys seeks 10 days to reply to a pre-show cause notice from the Central GST Enforcement Authority. Sources say 10 foreign airlines operating in India also get GST notices worth 10,000 crore rupees. International Air Travel Association calls the levy flawed and warns that it could dampen India's aviation potential. CBI lodges an FIR against Hindalco 8 years after registering a preliminary inquiry. Alleges violation of environmental clearance granted for coal mining in Odisha from 2000 to 2013. The FIR also names Chandni, then director in the Environment Ministry, for allegedly providing undue benefits to Hindalco. Sources say the government prefers grandfathering till July as a relief to counter the removal of indexation benefits for real estate, also considering if people should have the option to choose between the old and the new capital gains tax regime. No final decision yet. Ola Electric's 6,000 crore rupee IPO receives twice the number of bids for the shares of offer. Institutional investors fully subscribed to the issue on the last day. Akasa Air will grow by 50% in this financial year, says founder and CEO Vinay Dubey, as it enters the third year of operations. Adds that the path to profitability will be at par with the finest companies without providing a definite timeline. That's an exclusive. Fears of an escalation in the Middle East intensify after US troops are attacked in Iraq. Israel bombs West Bank, killing 8 people. More than 39,600 Palestinians have been killed so far, according to the Gaza Health Ministry. Wrestler Vinesh Fogart stuns the world #1 and defending champion Sasaki of Japan with a dramatic last gasp victory. Enters the quarterfinals. Meanwhile, defending champion in javelin Neeraj Chopra easily qualifies for the finals. Well, in fact, we have a special for you. Let me go across to, in fact, Prashant Nair for a special conversation with the co-founder of Ola Electric, Bhavesh Agarwal.
Ola Electric, India's largest pure-play electric two-wheeler company with over 46% market share, is now making it to the public markets. It's coming to the last street. The near $700 million IPO has gotten a good response, with the total issue having been subscribed over 4 times, nearly 4.5 times. At the price band of 72 to 76 rupees per share, the company would be valued at nearly $4 billion. What are Ola's prospects? And as investors And as Ola Electric becomes public, I mean, I think the question which everyone will want to know is what is the road to profitability? Those are natural first questions which people will have on their mind. So let's bring in Bhavish Agarwal, the man of the moment. He is, of course, founder, promoter of Ola Electric and a bunch of other companies as well. But for now, we're here to talk about the Ola Electric IPO. Bhavish, great to have you with us here. Thank you very much for your time. Appreciate it.
Prashant, thank you so much for being for getting me on your show. Very excited to be here. Obviously, a momentous day for all of us here at Ola, and very excited to speak to you.
Congratulations from all of us here. So, over 4.5 times nearly. And the numbers could change, they could go up. Were you expecting this kind of a response? What are your thoughts?
So, Prashant, we had very good engagements with investors all through our process in this, right? The road shows and even in the last few weeks after the prospectus, etc., was filed. So we were expecting a good response. And we also decided to price it in a way that a broad spectrum of investors across institutions, retail, HNIs see this. And I think that's what has ended up a very strong performance, like you said. If I use a cricket analogy, I think the pitch was tough, but the batsman hit a century.
And by the way, you also had a bit of global market turbulence, right?
Yeah.
And that can't be good for a primary issuance, any primary issuance, not just yours. But it's, of course, things look a little more settled, and the issue has, of course, gone through in a good way. So let me begin by asking you, and I'm sure you understand investors, and you got this question from investors who you were pitching the IPO to, etc. And now you'll have to answer to the public market. So let me prepare you with that. What is the road to profitability, Bhavish, as far as Ola is concerned? Look, the opportunity is there. It's a multi-decadal theme. You're the largest player. But what is the road to profitability here as far as Ola Electric is concerned?
So, Prashant, that's a question many people have asked us, and I've answered in multiple forums. I can't give a specific answer, as you know, but I would tell investors that just wait for our Q1 results, which will be out soon after the listing on 9th August, and you will get to see the financials then. But thematically, if I tell you, if you look at our business in FY24 over FY23, we grew revenue 90%, and our revenue in FY24 ended up at around 5,300 crores. And our adjusted gross margins went up significantly from, I think, 7% to 16%. And our EBITDA went up from negative 43% to negative 19% in just 1 year. So this shows you the kind of improvement the financials already in the public domain showcase. And this is because, in manufacturing businesses, there are two themes I want to leave with your viewers here. In manufacturing businesses, as you grow scale, and you've seen very significant volume and revenue growth, your cost structure, the factory investments, etc., don't scale linearly with it. So your margins keep expanding as you grow to a certain level of scale. And we are in that process of growing our volumes and our revenue to kind of grow into the volume of investments, capacity investments that we've already done. Secondly, our core strategy has been to vertically integrate. And our margin improvements over the last 2 years has been driven through this kind of vertical integration of manufacturing and technology into different EV components. And the heart of that, the most important one of that, is the cell itself, the lithium cell, which is actually, like the prospectus says, going to be ready by early next year for commercial production. The trial productions and the factory is already complete. And that, as you know, cell is the biggest part of the vehicle cost. So once we make that in India, once we make that in Ola Electric, that will further improve them.
You give us a tease, right? Q1 earnings will be out shortly after the listing. So obviously the numbers are going to be strong. Obviously you can't go into specific details, but some of those numbers that you mentioned, which is over FY23 to 24, gross margins, and I have the numbers here, went from 3% to 13%. EBITDA margins improved from minus 48 to minus 25.
Yeah.
At what point, and you, by the way, said in an earlier interview to the channel here, that you will turn profitable in the near future. So again, without putting this quarter of that year, what is near future? In the ballpark.
So Prashant, again, I can't give you a timeline on this, but I can say that, again, if you look at our volumes, FY24 volumes were almost double of FY23. And Q1 of FY24, the volumes are in public domain in the government Vahan portals, and you can see how they've grown quarter on quarter, year on year. So there is a point when the volumes hit a certain level where hence the margins or the EBITDA gets to a break even and a beyond level. Beyond this, I can't share, but our focus is to drive growth and profitability both as we build this company to the future.
So in FY24, you sold 330,000 units and you generated revenues of about 5,000 crores.
Yes.
Could you, without going into the sort of at the net level, at a top line level, what should we expect in FY25?
Again, too early for me to give any expectations or guidance. But if you see quarter on quarter, our our quarter one numbers over same time last year are high. July, which was again in Vahan, we I think grew 110% year on year over last July. So these are all volume numbers in the public domain due to the government Vahan portal. So this gives you an indication of what kind of growth we are seeing in our core scooter business. And we've also told the market that we are working on motorbikes. We have our annual product launch event on 15th August. Every year we do it on 15th August, Indian Independence Day. So stay tuned. We will be announcing some very exciting stuff on 15th August, which is just about 10 days away.
Okay, no, absolutely. And we will be sort of tuned in for that. Now, one of the investors, actually not one, but two investors that I spoke with who have actually put money on the anchor side, yes. They told me that, the way costs and the reason, one of the ways to profitability could be the in-house battery cell manufacturing, which you're undertaking, right? You spoke about being vertically integrated and how that perhaps is a lever where you can bring down costs significantly. So,
absolutely.
Give us a sense. How much of a lever is that? We're talking about in percentage terms. As opposed to the cost of cell now, once you're fully there, you get to some of these. So 5 gigawatt hour. Eventually you want to go to 20. What is the leverage available on this front? Cell manufacturing.
So good question, Prashant. And I think for all your viewers and investors also, it's important to understand that, just like in the ICE era, the engine was the heart of the vehicle. In the EV era, the cell is the heart of the vehicle. And hence, 4 years ago when we began this company, we decided to focus on making our cell in-house. And if you look at the amount of cost contributed by the cell, if a vehicle costs 100 rupees, the cell costs about 30 or 35 out of that. This is like an average across multiple companies. So the biggest single cost item is the cell, which all of it in India today is imported by all companies. There's no domestic manufacturing. The first gigafactory is what we have set up. We have already completed the gigafactory. We have commenced trial production, and commercial production will commence early next year after about 7-8 months of quality testing and process fine-tuning. So once that happens, you can assume the entire margin that global cell companies make, as well as a 5% duty that cells have when they come into India. All of that money we will save when we start using our own cell in our vehicles. That'll not be fully there on day one because there'll be a transition period of all our products moving to our own cells over the course of next year. But step by step, all that margin on 30% cost, assume saving 20-30% margin, all of that will eventually come into our books.
Sorry, is that you said 20 to 30% savings as opposed to not using your own manufactured cells? Is that what you're saying?
So if you think of the cell cost as 30 rupees on a 100 rupee vehicle, out of the 30 rupees, globally, the companies make about 20-30% margins, the global cell companies. So that's the margin that we will keep if we make the cell ourselves.
I see. Got it. There is also talk that as far as lithium battery supply chain is concerned, there is huge amount of, again, this is coming in from, China is, of course, the number one player. A lot of overcapacity and sort of consolidation, which is happening right now. And that's a global industry. Could you give us a sense of how this is likely to impact some of these plans at all, if at all, that is, Bhavish?
Prashant, cell as a component is a technology-oriented component. So what happens is it's not a commodity that is traded in the market. As technology improves, every couple of years the cost comes down and performance improves, like we see in chips, etc. So 10 years ago, the cost of the cell was $1,000 a kilowatt hour. Now it's about $100 a kilowatt hour. And 5 years hence, it might be $50 a kilowatt hour. And that's linked to both capacity growth in global supply chains. It's linked to technology improvements. It's linked to more lithium mining in the world. These are the three vectors that reduce the cell cost. Now for us, because we are a consumer of lithium cells and we're not in the lithium mining business. We are in the business of taking the processed lithium and other cathode anode components and assembling a cell and then assembling a vehicle with that cell. So for us, any input cost reduction actually helps. It doesn't have any concern to us in our input cost or in our output pricing in that sense.
And since this is such an important area for you, Bhavesh, is the technology itself settled, or as you say, I mean, it's still in the evolution stage? So there could be some dramatically new technology which comes. And how fast will you be in your factories where you're making these cells be able to pivot to anything new which comes, Bhavesh?
The point with technology-oriented components, Prashant, is to actually be investing in R&D and creating that technology lead and IP in-house. So if you're doing that, you're actually able to lead the technology wave and not just be a technology taker, but rather be a technology maker. So, similarly for us, since we are not really it's not like we are looking to invest in manufacturing only when the technology is settled. The manufacturing part of our investments are actually agnostic to technology changes, largely. It's only the actual chemistry, etc., which depend on technology and where we do our own IP creation, so we control our technology. So in that sense, the risk is lower for us and the capital for the manufacturing is largely protected.
So let me give it one more push. You would agree this much, right? This is the biggest lever you have. I mean, as this comes to scale, cell production comes to scale within Ola, that is the biggest lever you have, because everything else is external, right? You don't have control over government sort of programs to boost EV sales. I mean, it may happen. The current one is expiring in September. We perhaps will see a new one. I mean, a lot of it is what competitors are doing. All of that is sort of outside the purview of what you can do. What you can control is sort of saving costs on the cell side. Would you say that is the single biggest lever you have?
Prashant, I would say the vertical integration of manufacturing of all EV-centric components is the broad single lever. Cell is one important part, motors is another part, software, electronics. There are a lot of components which go into an EV which were not there in ICE vehicles. And that drive more than half the cost of the vehicle is driven by these new to automotive components which are new in EVs. Now, we are by far the leader in vertically integrating all of these components into our manufacturing and technology. And cell is absolutely the centerpiece of that. So that is one important lever. The second lever I would actually just underline again is just increasing penetration and scale. As we continue to scale our scooter portfolio, and now we have about 5-6 products in scooters, and as we add on let's say other two-wheeler portfolios, motorbikes, etc., and hence as our utilization in our factories, etc., our supplier utilizations go up, that will also further improve margins. On government subsidies specifically, I think in general now the industry is less dependent on the FAME subsidy. 2 years ago it used to be 60,000 rupees a vehicle. Now it's 10,000 rupees a vehicle, and yet the industry is growing. So that I think in general the industry has baked into its cost structure rejigs as well as business model design.
But to that point, penetration has struggled, right, over the last couple of years. I'm not talking about Ola, but EV penetration over the last 2 or 3 years. I mean, it's in that broad 3 to 6-7% kind of a range.
So penetration, Prashant, should be seen in a segment because if you see between two-wheelers and four-wheelers, and within two-wheelers, scooters and motorbikes, right? Now, four-wheelers have been a little slower. They got off to a slightly sharp start and then kind of plateaued after that. Because in four-wheelers, yet the cost structure for EVs has to come down to the ICE level. But in two-wheelers, all of the action has been in the scooter segment. Motorcycles is still early. We are coming out with our products later this year, but largely early. And hence, in motorcycles, penetration is largely zero. In scooters, actually, the story is very different. 3 years ago, when we launched our first product, penetration was, I would say, 1 to 2% electric. Now, penetration is about 15% electric in just 2 to 2.5 years, which is a very significant jump. And as we have launched sub 1 lakh rupee scooters, we've seen our own volume growth. If you see our volumes in October last year to July, I think we have almost doubled our volumes in that period with our sub 1 lakh scooter launches. And I think I see that continuing over the next few quarters.
You said that the subsidies from the government are not that crucial anymore, Bhavesh, for EV adoption, for further penetration?
I said they're not as material in today's sense because FAME has reduced from 60,000 to 10,000. And yet the industry has grown. I have been public about my perspective and our Ola's perspective that we do feel the government, the FAME subsidy should continue for a couple of years more so that the industry gets a kind of a smooth timeline to engineer their way out of it. And I think generally that's what the government has also indicated, that FAME 3 will have a certain continuing subsidy at the current levels for the two-wheeler industry. And I think that's reasonable.
Let's talk about share of market, Bhavish, right? I mean, you're the clear leader, but you got so many well-funded ICE players, incumbents, traditional two-wheeler companies who've got big plans in this particular segment. You've got the first mover advantage. You've got, cell manufacturing in-house. Is it your share to lose in that sense? Because you're starting at a high 46% share.
Yeah.
What should we expect? I mean, internally, the ambition would be to grow it, but walk us through the thinking here.
Yes, 2 points. Firstly, I was not the first to market, actually. I was the last to market. Ather was there before us. TVS had its electric vehicle before us. Bajaj had its electric vehicle in the market before us. So we were the last to market. And in that sense, we learned from everybody else's mistakes, the kind of products that they had built, which consumers didn't want, and the kind of manufacturing, supply chain, distribution strategies they had. So we built a very different strategy. We built a vertically integrated manufacturing strategy. We built a vertically integrated front-end distribution strategy, and a much more focus on technology, which drives margins for us and keeps cost down and keeps innovation high. All of this has helped us to get to this leadership position in the e-two-wheeler market. But when I look at market share, I don't look at the e-two-wheeler market at all. I don't think my competition is with the current level of electric two-wheeler players. And these are all good companies. I respect them. I think they've brought in some products. They've had some mixed results, sometimes up, sometimes down for their market share. But our focus is actually to penetrate and take EVs to a much higher share of overall automotive in India. And that's where we focus on. And I believe if we keep innovating with both technology and bringing more and more products to the market, which Indian consumers love, market share is an outcome of all of that, right? In the end, that's what matters.
Now, so that 46% market share in electric two-wheelers, that is the number. I mean, the FY25 till date number. So I'm just wondering, I mean, as you're expanding capacity, but you will have more options for the consumer. You accept that, right? Over the next 1-2 years or so in the two-wheeler space.
We already have enough options for the consumer. Like I said, I was the last one in the mix. We had a lot of we had enough companies, the Hero Electrics and the Amperes, and then the big guys, TVS, Bajaj, and other startups like Ather, all in the market before me. I was actually pretty much the last guy. But we have got something right in our strategy, which has allowed us to become, in just 2 short years, by far the market leader. And but like I said, my focus is not on the 46%. I'm looking at the future. I'm looking at the EV penetration in the market. And if we bring good products at the best price points for consumers, we will continue to retain or probably even improve our market leadership.
So what I'm trying to do is get to a size of market, say by FY26. I mean, I think you've already done that. You expect penetration to be this much. I mean, the number of industry units sold. What would your share be? And then eventually you would want to build in those numbers. I mean, I'm sure you've had these discussions with investors, and I just want you to share some of this. Sure. I mean, in terms of just projection, not exact down to the last decimal numbers. Yeah,
if you look at the market again, Prashant, like we said, two-wheelers, scooters is already at 15+% penetration. And, if you see how over the last 2.5 years it's grown from, let's say, 2% to 15% in 2.5 years. Now, looking ahead, let's say a couple of years from now, that 15 could be, again, these are third-party reports. People are saying in 4-5 years, it'll be about 40 to 50%. People might discount that or say it might be higher. It all depends on how the market plays out. But broadly, I think the journey of EV penetration is
Which is how many units then, total industry EV?
Overall, scooters today is about, let's say, 1/3 of the two-wheeler market. The two-wheeler market is 20 million. The scooters is 7 million. So if you say in 2 years, 30% is electric. So that's about 2 to 3 million in just scooters. Motorbikes will begin their journey when we launch our products later this year because there are no other good quality products in the market. And then that also will have a similar penetration journey. But the reason, Prashant, for your viewers, there's a very simple way to think about this. ICE vehicles and ICE fuel are both inflationary. Petrol ke daam upar hi jate hain, if I say that, right? As Indians, we know 50 rupees se 100 rupees ho gaya पिछले decade में जो भी है. Petrol का दाम एक direction में जाता है. Dusra, the vehicle cost itself, because of emissions compliance, also only goes up. BS4 to BS6 has increased vehicle prices for the same vehicle. Now, for EVs, pretty much the reality is the reverse on both fronts. The vehicle cost itself, because of emissions compliance, also only goes up. BS4 to BS6 has increased vehicle prices for the same vehicle. Our Prime Minister has launched the rooftop solar scheme, where he has a vision that he wants to make power and transport free.
No, absolutely.
Yeah, so the cost of transport will go to zero in India as more and more solar at homes gets deployed. Secondly, the cost of the vehicle also goes down because the cell price is only reducing. So this story only ends in one way, in one end, in my view, and that's why our focus has been to purely focus on EVs, not transitionary technologies like hybrids or CNGs, and build very strong leadership competencies in EV.
You know, out of that 2 million number, 2 to 3 million number that you said, right? This is by F5 27, 28?
There are different third-party reports, Prashant. So if you see, people are saying by FY28, 40 to 50% of the overall two-wheeler market will be electric, not just scooters. So that will make it about 8 to 10 million units in 5 years from now. That's what the Red Seer report that we've put in our prospectus says. And you can say, okay, there'll be different stages of penetration in scooters versus motorbikes. So blended, that's where the market could be.
Okay, all right. Now, sort of allow me to sort of come in once again on the cost side, right? I'm just trying to, because when you release those numbers, and I hope we get a chance to chat again post the numbers, a lot of the focus will be on some of these line-by-line items. On the cost side, with scale, presumably in manufacturing businesses, economies of scale start to set in. But you're also expanding your sort of fixed cost base in a very large way. So what is the interplay there? I mean, wouldn't fixed costs overall go up in a more permanent kind of a way?
See, our fixed costs fundamentally will not expand in line with our revenue. The revenue growth will be higher than, let's say, fixed cost expansion. And specifically, if you see, most of the fixed costs might expand in the cell side of things, whereas the automotive, we have already had a fairly large deployed capacity where we'll grow into that. There are two different ways to look at financials as our volume increases. One is the gross margins, and you'll see gross margins that reflects the vertical integration and to some degree the scale, hence our procurement leverage with our suppliers. The second is the operating leverage we get below gross margins, which are EBITDA margins with increasing scale of revenue. And you'll be able to see both these as we start reporting quarterly results in the future.
You know, at a EBITDA level, you had a loss of 1,300 crores. At what point will you go? Will you come closer to this being close to zero, and then you tick on the other side? Will it be
again, Prashant? Yeah, I can't answer that straight. But if you see, our EBITDA percentage in FY24 was negative 19%, whereas in FY23 was negative 43%. So that's a 24-point improvement in just 1 year, with revenue doubling. So if I'm sure you and your analysts and your viewers especially can do their own forecasts.
Got it. Bhavish, we'll leave it there. Great conversation. Thank you very much. And I'm sure this is one of the many occasions we'll have to speak with you. We look forward to those announcements on the 15th of August, as you said, where you, I think, unveil a new product line, perhaps. And of course, after that, first quarter results. Thanks very much, Bhavish Agarwal, for joining us with that chat.
Thank you, Prashant.
Thank you. Well, that is Ola Electric, which makes its way to the public markets. That's it on this special show. It's a wrap on the broadcast. Stay with us. More news and updates follow after a quick break.
Action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV 18 and cnbctv18.com. CNBC TV 18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV 18 weeknights at 7 p.m.
informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV 18. Now streaming live 24/7 on YouTube.
Even if the non-farm payrolls labor market data in the US was a bit disappointing, we're really not seeing other economic indicators at all pointing to a recession. And also keep in mind that the labor market is a lagging, not a leading indicator. So we really want to be looking more, say, at PMIs to get a sense of how well the US economy at least is doing.
Plethora of events shape up over the last few days, and it's obviously difficult to make sense of everything and put the pieces together. There will be, there are different factors which have been affecting different regions, whether you take Japan or US or maybe even emerging markets for that matter. I think as far as the US is concerned, what we read and what we probably still share as a view, and probably is a continuation of what we, in a way, expecting that, we will probably try and see some correction as far as the
Welcome to the Citizens Monetary Policy Committee meeting. The global events may change things dramatically for the Reserve Bank and for its Monetary Policy Committee, which announces its decision on Thursday. Whereas during the June policy, the Fed was expected to cut rates by just 25 basis points once in 2024. Now the markets are expecting a 125 basis point cut in 2024 itself. So what should Reserve Bank and its MPC do? As always, CNBC TV 18 Citizens Monetary Policy Committee meets to give us an idea of the issues before the RBI. I have with me Chairman of our committee, Dr. Pranab Sen, and members Shamikanti Ghosh of SBI, Sajid Chenoy of JP Morgan, Shamiran Chakraborty of Citi, and Sonal Verma of Nomura. Gentlemen and Sonal, thank you very much indeed for joining us. Sajid, first delineate the global scenario for us. Will it not be a pressure on the RBI and MPC?
Lata, good morning. I think this is the biggest change between the last monetary policy meeting and this one. We've been making the case for global resilience for the last 2 years now. The global economy has been remarkably resilient. But that resilience was predicated on two phenomena. One, that